Hello everyone, good morning, good afternoon, good evening to all of you. Welcome once again to this live analysis at whatever time zone you are right now. फिलहाल अगर देखें अभी मार्केट को क्रूड ऑयल और नेचुरल गैस कल के लेवल है, कुछ भी चेंज नहीं हुआ है क्रूड ऑयल में। कल काफ़ी देर साइडवेज गया, रेजिस्टेंस एरिया से थोड़ी बहुत सेलिंग आई थी, फिर नीचे सपोर्ट एरिया था, वहाँ से एक सार बाइंग देखने के लिए मिली। रेजिस्टेंस पे कल क्लोज हुआ था, थोड़ा बहुत सेलिंग कल थोड़ी बहुत तो आ गई थी। आज हल्का सा गैप डाउन ओपन हुआ है और वापस थोड़ा बहुत रिकवर कर रहा है। अगर ये ब्रेकआउट करता है मेरे अकॉर्डिंग तो फिर ये काफ़ी ऊपर जा सकता है, क्योंकि कंसोलिडेशन बहुत ही स्मॉल रेंज के अंदर काफ़ी टाइम से हो रहा है। सो देयर इज अ वेरी हाई चांसेस इफ price gives the breakout in crude oil, we will see a sharp upside move. नेचुरल गैस को देखें, कल थोड़ी बहुत सेलिंग आई थी, रिकवर किया वापस उसी 4 आवर टाइम फ्रेम पे साइडवेज चला गया है। लास्ट ट्रेडिंग सेशन है 1:30 हो गया है, लंदन सेशन इज ओपन। एक्सपेक्ट करते हैं थोड़ा सा वॉल्यूम आना चाहिए। बाकी शाम को फिर 6:30 न्यूयॉर्क सेशन ओपन, 8 बजे यूएस मार्केट और फिर 8:30 पे कंज्यूमर सेंटिमेंट का डेटा इंपॉर्टेंट है गोल्ड और सिल्वर के लिए। बाकी निफ्टी और बैंक निफ्टी की बात करें, मार्केट बुलिश था मॉर्निंग से। आज आरबीआई की रेट कट का डिसीजन आया, आरबीआई ने रेपो रेट कम कर दिया है 0.25 बेसिस पॉइंट से। तो उसका एक पॉजिटिव इम्पैक्ट हमें मार्केट में देखने के लिए मिला। इंडियन मार्केट ने एक अच्छा रिस्पॉन्स दिया उसके कंपैरिजन में। निफ्टी स्पेशली बैंक निफ्टी चलो उसकी वजह से गया है, निफ्टी थोड़ा सा ध्यान रखना भी है, रेजिस्टेंस की ओर हिट करने वाला है। ठीक है, वापस से आज लास्ट ट्रेडिंग सेशन है, ओवरनाइट पोजीशन रखते हो तो ध्यान रखियो, रेजिस्टेंस को वापस हिट करने के काफ़ी करीब आ गया है 15 मिनट टाइम फ्रेम पे फ्यूचर, निफ्टी फ्यूचर। सो वी नीड टू सी कि लास्ट नेक्स्ट जब मार्केट ओपन होगा नेक्स्ट ट्रेडिंग सेशन में, क्योंकि कल और परसों तो मार्केट बंद है, सैटरडे संडे मंडे को जब ओपन होगा तो किस तरह से कहाँ पर ओपन होता है। ओवरनाइट कोई पोजीशन रखने से पहले ध्यान रखना कोई न्यूज़ ना आ जाए, स्पेशली अगर बाइंग साइड पे कोई बुलिश पोजीशन बना रहे हो। ठीक है, फ्रेश ट्रेड के लिए थोड़ा सा वेट करेंगे। क्रूड ऑयल और नेचुरल गैस में कोई क्वेश्चन रहेगा तो कमेंट बॉक्स में पूछ सकते हो। बाकी निफ्टी भी मॉर्निंग पे फ्लैट ओपनिंग के बाद बुलिस, और बैंक निफ्टी तो चलो बुलिस था ही। लेट्स सी, अब देखते हैं ये। और कितना ऊपर जाता है, बिकॉज रेजिस्टेंस को हिट किया है। कि अब अगर सेलिंग आई तो फिर परसों का जो लो का लेवल है 26,000, वो शायद ही होल्ड करेगा प्राइस, फिर नीचे ही सीधा 25,700 ही दिखता है अगर ये लेवल होल्ड करता है। निफ्टी की मैं बात कर रहा हूँ। लेट्स मूव ऑन टू द क्रूड ऑयल एंड नेचुरल गैस। देखो क्रूड ऑयल में जैसा मैंने बताया अभी, ये मल्टीपल टाइम टेस्टेड लेवल हो चुके हैं क्रूड ऑयल में। मैं फिर से एक बार रिफ्रेश कर देता हूँ लेवल को। फ्रेश लेवल, वी नीड टू सी फ्रेश लेवल नाउ। नेचुरल गैस में भी वही हायर टाइम फ्रेम का ही रेजिस्टेंस है, 15 मिनट में तो कोई रेजिस्टेंस क्रिएट ही नहीं हो रहा है। क्रूड ऑयल में थोड़ा सा एक्सपेक्टेड है, अगर ब्रेकआउट मिलता है तो एक मोमेंटम अपसाइड पे आना चाहिए। एक बार लेवल रिफ्रेश कर देते हैं, नए फ्रेश लेवल। तो दिस इज़ द लास्ट लेवल नाउ। अगर ब्रेकआउट मिलता है 5470 460 के ऊपर प्रॉपरली, तो एक बड़ा मूव करना चाहिए। बाकी मल्टीपल टाइम टेस्टेड लेवल इन 15 मिनट टाइम फ्रेम, बाकी सपोर्ट भी कल का काफ़ी टार होल्ड कर चुका है। तो अब वो लो लेवल भी मुझे लगता नहीं होल्ड करने के चांसेस हैं इसमें ज़्यादा। इसको भी मार्क कर लेते हैं, कल जहाँ से बाइंग आई थी। ये सपोर्ट ही मल्टीपल टाइम टेस्ट हो गया है, ऊपर रेजिस्टेंस भी मल्टीपल टाइम टेस्ट हो गया। इस रेंज में काफ़ी टाइम से रुका हुआ है प्राइस। जिस साइड ही ब्रेक करता है नीचे और ऊपर लेवल ऑफ नेक्स्ट सपोर्ट और रेजिस्टेंस के फिर काफ़ी दूर ही है। तो एक आखिरी बार यहाँ से सेलिंग प्लान करेंगे, क्योंकि नीचे भी इतना सपोर्ट ले चुका है लोअर एंड पे। जो बीच वाला सपोर्ट है 5300 वाला, 5 टाइम यहाँ पर भी सपोर्ट ले चुका है। रेजिस्टेंस की बात करें, रेजिस्टेंस भी 1 2 3 4 5 6 टाइम ये भी ले चुका है रेजिस्टेंस। तो चांसेस हैं ऊपर का ही ब्रेकआउट होगा मोस्टली। लेट्स होप। इस बार इसमें सेलिंग का टारगेट रखेंगे तो थोड़ा बड़ा ही रखेंगे, बिकॉज अब ये नीचे वाला भी इतने बार टेस्ट हो गया, ये दोनों में से किसी ना किसी एक साइड पर जरूर ब्रेकआउट या ब्रेकडाउन की कोशिश में प्राइस रहेगा। मोस्टली मुझे बुलिश ही लग रहा है क्रूड अभी तो, पर इवन दो रेजिस्टेंस है फिर भी। हल्का सा पुल बैक देगा तो बाइंग ही करेंगे। ठीक है, प्राइस अगर हल्का सा पुल बैक देता है एक वापस बाइंग का प्लान करेंगे। ऊपर रेजिस्टेंस कोई अगर है बाइंग में तो ट्रेल कर सकता है। क्रूड ऑयल में हल्का सा एक पुल बैक आता है तो एक बाइंग का प्लान करेंगे छोटे से एसएल के साथ, ज़्यादा बड़ा एसएल नहीं। ओके, ऊपर क्रूड ऑयल में ध्यान रखना, ऊपर रेजिस्टेंस जोन भी है, तो यहाँ से एक वापस सेलिंग का प्लान रखेंगे आखिरी बार, मल्टीपल टाइम बिकॉज टेस्ट हो चुका है। देखोगे, नेचुरल गैस को देखोगे कहीं से कल से वही 4 आवर के रेजिस्टेंस जोन पर ही है। दिस इज स्टिल अ 4 आवर रेजिस्टेंस एरिया। कल से इसी जोन पर रुका हुआ है प्राइस, ना नीचे जा रहा है ना ऊपर जा रहा है। कंसोलिडेशन कर दिया रेजिस्टेंस पे, बट स्टिल ट्राई कर सकते हैं सेलिंग का। मुझे लगता है अभी भी जब तक ये लेवल ब्रेक नहीं होता तब तक, चाहे स्लो आए या फिर फास्ट आए, सेलिंग होनी चाहिए। 4 आवर का टाइम फ्रेम है, तो वी हैव टू कंटिन्यू सेलिंग फ्रॉम द सेम जोन। देखो इसमें कुछ कर नहीं सकते, 15 मिनट में कोई रेजिस्टेंस बना नहीं है, या तो 15 मिनट में कोई रेजिस्टेंस बन जाए और उतने पीछे के लेवल्स वो भी नहीं कर रहे, तो वापस से वही सेलिंग का ही प्लान करो। वी कांट डू एनीथिंग एल्स अदरवाइज इन दिस जोन। एसएल बड़ा होगा तो क्वांटिटी कम रखना, टारगेट बड़ा रख सकते हैं। इस रेंज को ये ब्रेकआउट ही दे दे बाहर, तो फिर नेक्स्ट लेवल का वेट करें। 15 मिनट में देर इज नो सच रेजिस्टेंस देयर, ओनली 4 आवर रेजिस्टेंस, जहाँ पर प्राइस काफ़ी टाइम से रुकने की कोशिश में है। थिंग इज दैट नीचे सपोर्ट इतने ज़्यादा बन गए हैं कि अब प्राइस नीचे जा रहा है तो होल्ड नहीं कर रहा है कंटिन्यूएशन में।
कहीं सीलन की बूंदे आपके घर में भी संगीत बनके ना गूंजे, इसीलिए घर बनाएं ACC Gold Water Shield सीमेंट के साथ।
News when you want it with Bloomberg News Now. I'm Caroline Hepker.
And I'm Stephen Carroll.
Germany's ruling coalition faces a key vote today that could threaten the country's political stability. A group of around 18 lawmakers from Chancellor Friedrich Merz's CDU party have rebelled against the government's pension bill, which is due to go to a final ballot in the coming hours. Although it's unclear how many lawmakers will reject the law, with a majority of only 12, the German leader has little margin for error. Here is Germany's Deputy Bureau Chief for Bloomberg, Jenny Tier.
If the bill doesn't pass, of course, this would mean like a major disruption, like a huge, massive crisis for the German government. I mean, if you take a look at the polls, the far-right party, Alternative for Germany, is ahead in some polls. And I mean, Merz doesn't want new election coming up. So, I mean, this would be a catastrophe for Germany, I think.
Jenny Tier speaking there as the co-leader of Merz's coalition partner, the SDP, hinted this week that if the pension bill doesn't make it through, it could spell the end of the coalition.
European countries are looking to lower the length of their borrowing as an overhaul of the Dutch pension system reduces demand for longer maturity bonds. According to the European Central Bank, the Netherlands makes up about 65% of pension funds' sovereign bond holdings across the euro area. Adopting shorter dated borrowing in the eurozone would follow similar moves in the UK and Japan. Such a shift will likely lower interest payments. However, it leaves governments more exposed to yield rises as they return to the market more frequently.
Now, in corporate news, Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and its HBO Max streaming service to Netflix. According to people familiar with the discussions, Netflix is offering a $5 billion breakup fee if regulators don't approve the deal. A tie-up between the world's dominant paid streaming service and one of Hollywood's oldest and most revered studios has the potential to bring seismic change to the entertainment industry. Sources tell us that if the talks go well, a deal could be announced in the coming days.
Jane Street's record results this year have been boosted by its savvy bets into the AI boom. The US quantitative trading giant lifted its third quarter trading revenue by about $830 million, with the surge of Anthropic reported to make up the vast majority of those gains. Bloomberg's Freddie Filston has more.
Jane Street's investments in Anthropic are beginning to pay off. The AI firm's valuation has more than tripled since the beginning of the year, increasing to $183 billion as of its latest funding round. Jane Street's also benefited from investments in the cloud computing company CoreWeave, in which it holds roughly 7% of outstanding shares. It's put the firm amongst the top Wall Street performers in terms of trading revenue, despite a recent high-profile dispute with India's regulator. In London, Freddie Fulston, Bloomberg Radio.
Lastly, the Booker Prize-winning author Salman Rushdie has warned that the banning of books in parts of the US is contributing to unexpected amounts of pressure on free expression around the world. Speaking on the latest episode of Bloomberg's The Michelle Hussein Show, the novelist said that it's more important than ever to protect views that we disagree with. Commenting on the book bans, he says he could never have imagined the present culture of censorship in the US.
It's more important than just the fact that this or that title that you happen to be fond of is banned. It's a question of what would happen to a generation of children if they grow up ignorant of the history of the country. That's dangerous.
Dangerous
Dangerous
to whom?
Because it is a very plural society, a very diverse society. And if all you hear is one version, which is the version of the dominant race, then that's potentially very destabilizing.
Salman Rushdie went on to cite figures from the advocacy group PEN America that there are currently around 23,000 active book bans in the US. The US Department of Education has dismissed criticism of book bans as a false narrative, defending what it sees as a common sense procedures by which to evaluate and remove age inappropriate material.
Those are your top stories on the markets. Eurostoxx 50 futures are 0.2% higher. FTSE 100 futures up by just 0.1 this morning. The euro is trading 0.2 stronger against the dollar at 116.61.
That's news when you want it with Bloomberg News Now. I'm Caroline Hepker.
I'm Stephen Carroll, and this is Bloomberg.
Hello and welcome. This is the Michelle Hussein Show. I'm Michelle Hussein. I speak with...
There are not too many people who love Microsoft Excel. If you try to imagine like the most depressing version of a modern workplace, so kind of gray carpets, high-walled cubicles, sad salads, Microsoft Excel on computer screens. Even though a lot of people despise this thing, I think you could make an argument that it is the single most important piece of software.
Thailand, where the craftsmanship of Thai silk.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. Has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett...
So when the 95-year-old announced he would retire at the end of 2025...
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping the Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that A competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. Both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing $100 million, $200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high-growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years, and
LGT's investment.
You're being sold an AI future where you're obsolete or irrelevant. That vision is wrong. At Palantir, they're building AI that helps workers and unlocks their full potential. American workers are our nation's greatest strength. AI shouldn't eliminate them. It should elevate them. Palantir is here to tell their stories. From factories to hospitals, AI is freeing
people. Listen and subscribe to The Michelle Hussein Show from Bloomberg Week.
We're talking about crypto, whether we're talking about private credit, whether we're talking about payments, it's this goal, this dream of like, let's chip away at some of these bank businesses or these businesses that were associated with some sort of legacy institutions. The banks, they mostly seem to be doing pretty well still, but there's this dream that they can all be sort of like disintermediated away, or that each one of these functions that they do can be better done somewhere else.
Yeah, so let's see. I have been in financial journalism for almost 20 years now, which is kind of crazy.
It is crazy.
Makes me feel very old. But for as long as I can remember, someone has been trying to either reinvent bank lending or reinvent the payments space. And I guess I can see a few reasons. So like genuinely, some payment architecture is really old fashioned.
Yeah.
Especially in the US where, you know, sometimes you still have to write a check for something, which blows my mind. The US didn't get chips for a really long time, chips and credit cards and stuff like that. But also, if you think about the payment and lending and financial market just in general, it's one of the biggest out there, right? Like you're talking about all the economic activity, basically. And so if you can get a tiny slice of that through interchange or fees, then you can see how people, you know, people are really interested in that space.
No, completely. And we know that there are a lot of fintech companies for a long time. I mean, some of the most, you know, the earliest internet success stories, period, were, you know, this is definitely nothing new. And of course, one of the first ever was PayPal, which recognized that with the internet was going to come all kinds of new opportunities for payments and sort of quasi peer-to-peer, literal peer-to-peer transactions, et cetera. PayPal is still, of course, extremely important part of the payments infrastructure. But yeah, there's so much going on. But to your point, lots of companies have gotten those little slices and made incredible fortunes.
Yeah. We also did an episode on Buy Now, Pay Later a couple months ago. And there are clearly some interesting questions brought up by the expansion of that space. And you and I talked about how wherever you go on the internet nowadays, you get like, you know, probably at least 2 or 3 little buttons that offer you installment loans on your purchases. And obviously the concern is whether or not people are taking out credit that they shouldn't necessarily be. There's a big discussion about that. And also the transparency of the credit that they're taking out.
Right. And we'll get into this. There are pros and cons, I guess, relative to credit cards. But one thing with credit cards is that there is decades and decades of data on them. And we know how they're used, and there's really good risk profiling and scores and all this, like credit scoring and all this stuff. BNPL is sort of more novel. And so therefore, to what degree do we know how as an asset or as a function it performs across different cycles? Do we know the cohort of people who use BNPL as well as we know the types of people who use credit cards? Seems a little bit, at a minimum, a bit more ambiguous.
Absolutely.
Well, we've hinted at what we're going to be talking about. I mentioned PayPal. We talked about BNPL. We are going to be speaking with one of the original members of the PayPal Mafia. We're going to be speaking with Max Levchin. He is the founder and CEO of Affirm, one of the biggest BNPL companies publicly traded. So, Max, thank you so much for coming on Odd Lots.
Thank you for having me. I'm a big fan of the show.
Thank you.
It's a bit of a privilege to be here.
Thank you for saying that on the recording. It's so we always love hearing it, but we love when it's on the public record as part of the episode. Thank you so much. Where did you get the idea to start Affirm? What prompted it?
A two-sided coin, both sides bad, of personal experience, actually tying neatly to the PayPal story. So I came to the U.S. at 16 from Soviet Union. And so you can imagine I understood very little about borrowing and credit and things like that. And so I got my first credit card on campus at college at 18. Didn't fully understand what I was signing up for. Certainly didn't read the fine print where it said 0% asterisk, don't worry about it. Borrowed a bunch of money, financed my first startup from that very same credit card, promptly got into more that I could afford to pay for. Startup failed. Eventually got some nasty calls from collectors, paid it off, and 4 years later or 5 years later, took this little company, PayPal, public, was basically independently wealthy overnight, went to buy a fancy car that, as I richly deserved at the ripe age of 23, I wanted to show off to my then girlfriend, now wife, and was declined for credit. And not only did I feel completely screwed by the moment when I found out that you're supposed to make the minimum payment, and by the way, interest accrues into principal, and this seemingly low APR is actually not what it seems to be because I missed some date of the specific amount that I was supposed to pay. It's bit me again 5 years later, where it's like, oh, by the way, it wrecked your credit rating too. So you can't get a loan for anything, even as you're sort of proudly sticking a finger at the article in the newspaper saying, the company public, youngest, whatever. And so that was the thing that stayed with me. For years, my friends would prank me at restaurants. They would ask the wait staff to tell me that my credit card was declined, which by then was a different credit card. But and I would turn deep purple and basically be like, oh my God, like it happened again. Like what? And eventually I knew it was a joke. But I was in my mid-30s when I realized that that's now more likely a joke than that credit score bite from 18. And so in my late 30s, I sat down with a friend from high school, college, and PayPal. I have many of these friends who I met when I was just getting my feet wet in America, and ultimately we built this amazing company together. And asked them the obvious question, 20 years too late: why didn't we try to fix that yuck that comes with having credit cards as a young person? And he said, I don't know, but we built so much great AI at PayPal fighting fraud and doing all these really interesting things. Surely we could do a better job scoring credit for young people like you were at 18 and then 23 than what currently happens. And that was sort of the seminal moment. And a couple of years later, we started a firm.
So I have a bunch of questions already. Firstly, what kind of car was it? Did you get it in the end?
I had to pay cash for it. I actually wired money. And it would begin like an 8 a.m. visit to a dealership, ended up like, it's 5 p.m., your wire hasn't cleared yet, you can't drive off the slot, and it did, drama. At the time, don't judge me, it was a black hardtop Mercedes convertible.
Oh,
and
no judgment at all.
I'm judging a little bit.
I was really young. I was very much trying to impress the girl who's now my wife and the mother of my two children.
It clearly worked.
It worked. It
Yeah.
worked.
Okay, another question. So you mentioned...
I just want to say, I love those Mercedes. I think that's one of the, if I have some rough conception, no judgment at all, I think those are great design cars. Anyway,
should we just talk about cars?
Yeah, we could.
Okay. Well, you mentioned the underwriting process, and this in my mind is supposed to be what makes the buy now, pay later BNPL model different, right? Like the underwriting process is more technologically driven, perhaps more nuanced. Talk to us about what you do differently versus, a credit card company or a bank or someone like that.
Sure. And you're pulling in a thread that's going to take a long time to unwind. I'll try to be pithy, but this is where the rage kicks in. So one of the things that happens with credit cards at the very core, they tell you a bunch of things they don't actually want you to do. So credit card business model is accrual of interest into principal. So this exponential function of you're signing up for APR X, but you don't actually know what's going to cost you, is all the fact that as you make the minimum payments or whatever the payments you're making, whatever you haven't paid off, the interest that you've accrued folds right into the principal, and it compounds and compounds and compounds. And so the longer you take to pay it back, the more it will cost, which seems obvious, but it's impossible for most mere mortals to predict. And they love it when you're late because there are late fees, which are fixed. And so the less you spend, the higher the percentage the late fee represents. So it's this sort of amazing business model, which is why one of your recent episodes puzzled over how are these rates so high. The rates themselves are actually not the problem. The problem is the structure. As you fold interest into principal and pay and pay and pay late fees, it can be extraordinarily expensive. And so from the very beginning of a firm, we asked the question, how can we make a product where you don't have this weird misalignment of interests, where the lender tells you, please pay your bills on time, but what they're saying sotto voce is, but not too on time, and ideally take as long as possible, because that's when we make the most money. So the obvious answer is, of course, obvious. Make a plan that you commit as a lender that you'll never change, and don't charge late fees. And that's it. If you agree to those design principles, you are not going to make more money if someone is late, and you're not going to make more money if they take longer to pay you back. Obviously, you'll make less money because getting money to lend isn't free either. We have to pay for our sources of capital as everybody else does, which means that it immediately rotates you sort of 180 degrees where you say, I only want to lend money when I have a lot of conviction the person is going to pay me back on time. Because if they don't, I am just going to lose money. And so we put those two principles down in the ground very, very early on. It's like literally written down to the foundation of the company. We will not misalign ourselves with our borrowers. From that came a lot of things like, hey, we need to understand your cash flow. We don't really care what your credit rating is. Maybe you gamed it, maybe it's inaccurate, maybe you're an 18-year-old immigrant. Does not matter. We need to understand what your actual capability is. We have to have the right to tell you you are overextending yourself, not just once every few years when you renew your credit card agreement, but for every transaction. You have to be able to underwrite and decide yes or no for every single moment that you create these payment plans, because that allows us to not lose money because we are aligned with you. When you pay us back on time, we'll make some money. If you don't, we're just going to be worse off. And so that is the foundation of a firm's take on BNPL. Many people have come along since and sort of changed the model a little bit. They introduced late fees, all kinds of other fees. We never have and never will. But even with those modifications, the model is still better than credit cards because of this individual underwriting moment. And in our case, no fees of any kind.
Just to be clear, so let's say I wind up at some website and maybe I want to buy like some Nikes or something like that, and I see the Affirm option. How do you know how good of a credit I am in that moment?
So it's not a effort-free thing for you to use Affirm. You'll have to click on Affirm, and we will ask you, if we've never seen you before, we'll ask you to provide some information for us. That information will allow us to tap into the standard set of records that the credit bureaus aggregated about you. If there's enough data there for us to use our custom credit score, we'll render a decision based on that. If there's not, we'll actually say, hey, we don't fully understand your personal financial situation. We would like to have a peek at your bank account cash flow and decide how your cash ebbs and flows relative to your ability to pay us back. All of this is made possible with really good new technology. So this takes seconds, even though it probably takes about as long to do as it takes to describe it. But we'll look through your personal financial state of right now and make a decision, not just whether it's a yes or no, but also how much of a risk you have of that financial situation changing, and that prices the credit.
Do you use any creative data points? You mentioned checking against the type of item that people are buying. So that's one thing I imagine could be interesting. Like if people are buying groceries on installment, does that mean they're more of a credit risk than someone who's, I don't know, buying a computer or a big ticket item? And then the other thing I'm very curious about, and I think I've told this story before on Odd Lots, but I remember going to see a startup that eventually failed, and they were in the peer-to-peer lending space, and they described some of the stuff they were doing with underwriting where they were like trying to measure people's impulsiveness by how quickly they moved a slider for a loan and stuff like that, which freaked me out a little at the time.
It would freak me out too. So no, we do not do telemetry as a input variable into underwriting. So before I get into what we do use, it bears mentioning that the variables you use in underwriting is a very, very highly regulated domain of lending and underwriting. There's lots and lots of laws going back quite far, things like Fair Credit Act and many other sort of subsequent additions to both federal and state level law that prohibits you from using kind of the obvious things you wouldn't want people to use, like your race or your gender or your age or your creed cannot be a factor. It's actually a federal offense to do that. And so we don't do any of those things. We go as far as to say if it correlates to some of those things, we also couldn't use it. And that too is a subsequent law as well. So first of all, we're very, very thoughtful about making sure we don't step into a prohibited territory. It's called prohibited basis is the fancy term in the industry. What we can use and what we do use, as you mentioned, merchants share with us what's being purchased. Despite the burrito gate that sometimes comes back in the press, people don't actually use Affirm to finance Mexican food or other cuisines. They do sometimes use Affirm for groceries, but it mostly is, or almost entirely really, is for things like I'm throwing a giant party and I need several $100s worth of foodstuffs, and that's a lot to pay down with my debit card, so I'm going to use Affirm instead. So the average size transactions for us is roughly $300. So it just gives you a sense for what people use Affirm for. So that's just, apropos where it's being used. What we glean from the information about what's being purchased. One good mental model, which this is like an approximation, but a decent one, if the useful life of the item is meaningfully shorter than the time it takes you to pay it back, you may find yourself questioning the quality of the item long after it's disappeared. And so a natural question we should be asking is, what do we understand about this item, but also maybe these items' history of quality before we say, oh yeah, sure, buy this thing that's going to be out in 6 months and pay for it over 2 years. So maybe the most useful thing I can say about actually what new variables we've introduced into our underwriting, vast majority of them, in fact, all of them actually, influence the decision we make by 1 or 2% at most. Anytime someone tells you, I found this magic variable, and if I just look at that, it's like 30% better underwriting or 5% better defaults, they're lying probably to themselves more than to you, but they're definitely lying. Anything like that just immediately becomes brittle. As the macroeconomic reality changes, as people suddenly don't care about the item or whatever it is that they found that's this magic bullet of like, suddenly I know who's a good risk, it just disappears. And so you actually want lots and lots of subtle factors that are also compliant with all the various regulations, helping you shape a score.
Is selling you a future where you're obsolete, or worse, identical. At Palantir, they're witnessing something different and revolutionary. From reindustrializing the nation's defense base to shipyard workers building faster and frontline workers boosting productivity, AI is transforming work across the nation. AI is not replacing American workers or flattening them into conformity. It's unleashing what makes each one irreplaceable: their judgment, their craft, their creativity. When American workers become more powerfully themselves, they own the future. Palantir, making Americans irreplaceable.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan. Then that $75, I'm going to put that into an index fund. Okay. And so you make money because the retailer is paying you a cut because that you've brought someone into the door. So talk about, how is that cut determined? How much are they paying you for that? And how competitive is it against other potential BNPL companies or perhaps new entrants that haven't come into the market yet? Talk to us about how that price is formed.
This is my question too, because when you go to check out, you see buttons, and the buttons, I presume, don't mean that much to people. You just click one of them. So how do you differentiate yourself?
So we've been around for nearly 15 years. And the way we've differentiated ourselves, by the way, we basically don't advertise. When you see us at checkout, that's when you learn about a firm at some point, and then you come back to use us again. And we have incredible retention rates. People who have used a firm a couple of times, basically with some 90% probability, will come back to use a firm again. Not necessarily the next week. In fact, we average something like 5+ transactions per year. But when it matters to them, they will use a firm. And the way we differentiated ourselves is we were there for them when they needed us. And if they ever stumbled, our best customers are the ones that email us or call us and say, hey, I was late to pay my bill, something happened, what's the late fee? And we tell them there isn't one. That's the moment when they grasp how we're different from the rest of the industry. And that's probably why they come back to us as often and as much as they do. Something like 95% of our transactions come from repeat customers. So just to give you a sense for the loyalty that we've engendered in our user base without ever making promises, on broadcast media, if you will. And so that's why they come back. To the business model point. So first of all, probably worth expanding the aperture a little bit. So we offer both interest-free and not interest-free loans. The pay in 4 that Joe described is exactly as it sounds. So in our case, there are no fees of any kind. So if you see a $100 shirt and you say it's going to be 4 payments of $25, that is it. You can take a decade and you wouldn't be able to use a firm pretty soon after you went well past the window of repayment. So the punishment for being late for too long is, hey, you need to pay us back actually before you can do this again. which I think stands to reason much more than actually let us hit you with a $38 late fee, but that's sort of besides the point. So that's one form of transaction. We also have what we call longer-term zeros, which is for a $1,000 fancy suit, you could potentially get a loan from a firm for 24 months or even 36 months, which will also be zero. In both of those cases, it's the retailer that's effectively paying your interest. Time value of money becomes even more expensive in 36 months, so you've nailed the business model there. In some situations, the retailer just doesn't have the margin or isn't interested in paying your interest. And so they'll say, look, you're going to use credit card, you'll pay some interest. If you're going to use a firm, it's okay for us to have this transaction happen if you are willing to pay interest to a firm. And in that scenario, you will see both the principal and interest. We'll calculate it for you, both the rate and the dollars, and we'll show you a schedule. And before you commit to any of that, you will see and agree to the schedule that we agreed on. In the latter case, the consumer is paying us something. The merchant is probably paying us something, significantly less than what they're paying us if they're absorbing the cost of interest, the cost of time value of money. The business model is really, really simple in our case to understand. The value is fixed. So whoever is paying us almost doesn't matter. That has to cover the fixed cost of underwriting, servicing, all the usual bits. Leave a little bit for us to actually be a profitable company, which we are, and also absorb the probability of default, which, by the way, sort of all the way back to this alignment of incentives, an easy check. Like, so it worked. Like this whole idea of like, oh, you're just not going to profit when people stumble. Our delinquency rates are about half the industry of credit cards. That should give you a sense for we don't make nearly as many mistakes, or perhaps we are not willing to let people go late because we don't benefit from it. Back to the business model, that's how it works. The competitiveness of this industry is just like any other competitiveness of any payment industry. Payments are notoriously a competitive world. There's actually never been a monopoly in payments, full stop. There's a fun puzzle I sort of used to do this at cocktail parties, like name a monopoly in payments. It turns out there has never been one.
Interesting.
That sounds like an Odd Lots cocktail party.
Yeah.
There's a reason I'm a fan of the show, right? I listen to you opine on all sorts of esoteric things with great gusto. And so I think will tell you everything you want to know about the competitiveness of the space. But we have decided from the very beginning that we want transparency and honesty with everyone involved, with our borrowers. That's why we say everything up front. That's why we tell them, here's your disclosure on exactly the rates and the schedules. With our merchants, we tell them, here is the price you will have to pay us if that's what you're paying. If you don't want to, that's fine. We will probably not be the right one for you. We won't make it up elsewhere. We're not going to take it out of the consumer's hide when they least expect it. That's just not the brand. There are definitely cheaper providers out there. There are plenty of brands that'll say, we're just like a firm, but way less expensive for merchants. What that really means is that's because we charge all sorts of hidden fees. We have all sorts of other ways of taking it out of consumer skin. What this means practically with 15 years of experience is consumers, as they cast their eye over the list of buttons, they say, well, the one I want to use is the one that's not going to get me if I stumble. And that makes for 24 million active users in the last 12 months. And we feel like we've kept our promise and the consumers keep coming back.
Just reiterating Joe's question, though, on the merchant side, again, I imagine they're getting offers from a bunch of different installment lenders, BNPL companies. And I don't think do they care much about the underwriting? It's not really their problem. It's your problem, right? So I assume the thing they care most about is the fee, which seems like...
They actually care about three things.
Okay.
So they absolutely care about the fee. Like that goes without saying, which can range from as low as less than credit card. So a typical credit card rate today is on the order of between 2.5% and 3%, depending on the size of the merchant. But that's kind of the average in the industry. We will definitely meet you around those numbers at the absolute lowest and goes up all the way to, let's say, low single-digit percentage points when you are subsidizing consumer interest. So we are not a cheaper than credit cards provider. Like that's not, don't want anybody to have that illusion. They care about the rate. More than the rates, they care about incremental sales. So if your next marginal buyer is either a no thanks or it will cost you 5%, if you have the margin of better than 5%, you don't want the item staying on your shelves. You would like to pay this 5% to get the marginal buyer to say yes. And so because of that incentive, which I think is easy to follow, you do have lots and lots of merchants that say, all right, so what I really care about then is the approval rates, which is the second variable we care about. So as people come through and say, hey, I'm not going to use your credit card, not interested in buying unless I have an installment loan, let's say from a firm, they need to know that that rate is going to be high enough. Otherwise, why have a button that just sits there and looks pretty? And so our rates are typically higher than the rest of the industry because we are so obsessed with underwriting, because we have no crutches, e.g. late fees. And so this underwriting thing, we don't really try to explain it to merchants at all. What we do say is look at our approval rates. If you see that our approval rates are meaningfully higher than the industry, you know you're going to get value from this. That's why it's worth paying more than credit cards. And so that is true, and that's what they do. The third piece they do care about, every merchant knows that the second transaction is they want. The first transaction costs them probably more than the margin in it. They're paying Google, they're paying Facebook, they'll soon be paying an LLM provider or a chatbot provider to drive that first transaction in. They want to sell you another thing. So they very much care about if they had sold that first transaction using a buy now, pay later provider, it better not harm their brand. Because if the buy now, pay later provider is harassing the consumer for paying them back or has late fees or has unexpected fees, it's going to accrete negatively to the merchant's brand. And so they actually do care about late fees in a way that has less to do with financial consequences, but more with, will people come back to us and use a firm again? Or will they be like, I hated that merchant, I got into some bad transaction. So they care about all these things through their own lens.
That makes a lot of sense. So let's say I start accepting your premise, okay, this is per se better than credit cards. One reason that people can't just quit credit cards generally is not every place takes buy now, pay later. People want something in their wallet, right? They want something at the restaurant and wherever it is that they know it's going to be accepted. Now, Affirm, you are launching a card, or you have a card, right?
We have a card. It's
Okay.
been around for a couple of years.
So you have a card, but I'm curious. You referenced that recent episode that we did with Itamar Drexler, and one of the things that he said about cards is they're very costly to advertise. The marketing expenditure for the card companies is very high. You mentioned that you don't do a lot of advertising. I'm curious, though, on the card component specifically, if you want to be, quote, top of wallet to consumers, the first thing, I think I've read that phrase.
That's right. I'm laughing because
I'm trying to acquaint myself with the industry lingo.
You're a true insider. That TOW, that's legit.
So if you want to be top of wallet for the consumer in the card, can you do that with an advertising light model, or do you really need to spend to get significant wallet share?
You can. The card is available to our users. So this is not a thing that you'll see on Times Square displays. This is a thing you find out from a firm once you are a borrower, once you're actually in good standing, you qualify for the Affirm card as the, hey, you really liked us, didn't you? This was great. You're transacting 5 times a year. If you want to take us with you to your retail shopping experiences, restaurant or otherwise, we have a way. It's called the Affirm card. It's actually pretty magical. The card is a dual mode card. It switches from debit to credit explicitly as you tell it to. So when you're buying a burrito, we expect you to use the debit mode, which just literally takes the money from your account, and that's it. There's no interest, obviously. It's just a pay now transaction. If you're buying a TV, you can buy it now with Affirm. In the app, you say, hey, my next transaction, I want that to be a 12 months, maybe it's a 0% loan because the retailer wants you to have it interest-free. Maybe you're paying some interest, but you're setting up that transaction in the app, and then your card is ready. When you tap it next time, it becomes a loan automatically. It's a pretty magical experience. It's super popular. It's a thing that we haven't needed to advertise because we went from, we have this card idea to about 12% of our users having one very, very quickly because it's just a really, really good product. Again, our user, their mindset has long been changed from revolving is okay, I don't understand it, but I don't care, to I don't like revolving, I don't want to pay late fees, I don't want to pay excessive interest, this Affirm thing is neat. The card is a logical next step. It's how much more can I
Top stocks.
The entire auto sector is higher today.
Which companies are posting the biggest gains and losses and why?
Understand pretty well the overlap between user bases. So there are 2 prongs to this answer, and this one is worth delving into pretty deeply because this is where we differ from the rest of the industry pretty significantly. So before I get into the stacking part, I'll address the overlap. So we do a lot of studying just externally through surveys. Also, because when we log into your bank account or we ask a provider to log into your bank account and pull in some of your transactional data, we get a glimpse into what else you're spending money on. So we had to have a decent sense for where else you might be using buy now, pay later. And to date, the user base overlap with other providers is quite minimal. So there's not a whole lot of stacking possibility simply because people who use Affirm tend to stay with Affirm. They sometimes stray and use other providers, but it's quite minimal for a meaningfully lower transactional amount. I think we average a significantly higher average transaction relative to the rest of the industry. So far, that's not been a problem. In the long term, you of course can make the argument like, sure, right now you guys are all still tiny, you're growing really quickly, everybody's taking a bite out of the credit card industry. What happens 5 years from now when everyone has signed up for their favorite BNPL and they're now signing up for a second one? The right way to address this problem, and this is the right way, and it's traditionalist of me, but I really do believe it's the right way, is for everyone to report to the credit bureaus. Today, when we tap into one of the three major credit bureaus, we see what you're borrowing and relatively current state of your borrowing from other traditional sources of credit. And it is a variable that we use inside of our own underwriting. Affirm today is the only one that furnishes, that's another fancy industry term, delivers the data of both positive and negative, as in you're on time, you're not on time, to the credit bureaus. The rest of our competitive set, generally speaking, does not, although everyone has experimented a little bit. From the very beginning, we saw the idea of building credit history and improving credit scores for people who are on time as a key value proposition for our borrower. Like, we are not going to be the only lender for our consumers. They need to borrow for a car, they need to borrow for a house one day. That means whatever they're doing with us, especially if they're doing well, which 97% of our consumers are doing really, really well, they're on time all the time, it has to reflect in their permanent record somehow. So we've been furnishing basically from the very beginning. It took a long time to persuade not just the credit bureaus, but also the companies that provide traditional credit scores to understand the data we furnish and treat it in the right way so that when you are on time, the scores go up. When you're not on time, the scores go down, et cetera. And so we did all that work basically on a volunteer basis over the last decade. And today, right now, the state of the industry is if you are a BNPL provider and you're not furnishing data, you kind of have no excuse. We pioneered this. We did all the work. We worked with the score builders and the credit bureaus, and we're now sending all of our data. And so we want everyone to join us because most people do pay on time. Their credit histories should reflect their good repayment, but also people who should not be borrowing should be reflected. And I think that's just really, really important. If I can do one bit of advertising on your show, it won't be for Affirm. It will be all of you out there. If you are in a buy now, pay later industry, furnish your damn data. It will help consumers. And it'll eventually accrete to your brand too. But for now, we are the only major one.
Wait, what's the resistance then? Because it seems kind of obvious if everyone cares about the underwriting, you would want more data out there. So why not provide it?
So I don't want to pretend that I understand all the motivations, but I think a basic inferential thought might occur that if you're making a lot of money from late fees, it's a cool thing to tell your consumers, don't worry, you can just pay me off. And it won't go on your permanent record. And if you don't make any money from late fees, you have no incentive to tell your consumers, oh, it's okay, just pay me something and we won't tell on you. The connection between late fees and lack of reporting is unfortunately the underlying fact. And because we don't make any money from late fees because we don't charge any, we're very pro-reporting.
Just out of curiosity, since you're talking about late fees and credit and all that stuff, here we are recording this on December 2nd, 2025. You take the temperature of the consumer for us. How are things doing? Seeing any signs of growing missed payments or anything like that?
Not as of December 2nd, 2025. Okay. The important thing to understand, I'm asked this question fairly often.
Yeah.
Affirm is a great lens into the financial hearts and minds of North American consumer. We operate in the US, Canada, and now UK. It is a specific set of people. These people are more financially responsible. They made a conscious choice. They picked us not just because it's installment pay and yay, it's convenient. It's also because we told them we don't charge late fees. It's also because we told them, do you hate the asterisk next to the 0%? We don't have any asterisks. One of our core values is no fine print, and we mean it, and on and on and on. And so it stands to reason that Affirm consumers will be probably much later into any kind of a macroeconomic earthquake territory if there was one to come. But as of right now, we feel quite good about our book and also about the US consumer.
I'm going to ask you a question, and I'm going to mention a competitor. I won't make you name the competitor, but I'll just say it in my question, then ask you about it. So one of your competitors, Klarna, recently announced a new dollar-pegged stablecoin, and I'm very cynical. And so when I see like random companies announcing some crypto thing, like sometimes it makes sense, but often it's like, well, maybe is this just a good press release or something like that? And I haven't really looked at the Klarna one, et cetera. But for you, Affirm right now, when you look at, as someone who has been in the internet payment trenches for literally decades right now, do stable coins or anything crypto unlock anything for you right now when you think about the future and you think about opportunities that you can't do with traditional rails?
The short answer is I don't think so. Now, I'm also very cynical, so I think you're unfortunately tapping into the exact same mind flow that you have.
This is our way of luring them to want to come on the podcast and have argue against it. But keep going, keep going.
I am confident that there is some thought that went into the press release. So I don't think it's a pure press release.
I hope so.
I will make.
So, yeah. Tell us about. I won't make you. We're not going to make you speculate on what your competitor, but just tell us from the Affirm perspective.
Sure, I will strawman the reasons why yes. So why not is obvious. I think you probably can do a much better job than I can. The why yes. So there are a couple of reasons. One, in general, if you have a lot of cross-border commerce, foreign exchange, the complexity of just diligence around everything from sanctions to reserve accounts, et cetera, you can squint a little and say, you know what, if we just lived in dollar-pegged stablecoins everywhere all at once, it would be a little bit easier. And I think that's true. E-commerce is not a very significantly cross-border discipline. And so before you sort of say, oh, wouldn't it be amazing if I bought lots of things from Zanzibar and just paid them with Affirm, but they got stable coin as a settlement currency, they'll be very happy because they want dollars and this thing is essentially dollar equivalent. It's a good story. Just most people in the US don't buy a lot of things from Zanzibar. Like they buy some things in other countries, but most of the time, because we all want things shipped to us very, very quickly, we're probably buying it from a US subsidiary that's warehouses somewhere pretty close to the US. And so it's not that big of a market just yet. But in like 5 years, if you see me putting out a press release, it's not because I finally realized that I'm missing out, it's because there's enough cross-border commerce in our scale where it starts to make a difference. That's the best I got in terms of why would you want to do this. The obvious of why not, it's like, well, maybe you want to move money around person to person, but that's not our business. Maybe you want to believe that one day Joe will have a wallet full of stable coins. I really have a hard time imagining you sporting a whole bunch of different kinds of branded dollar-pegged, effectively equivalent stable coins, like a coupon book of I got my Affirm stable coin and my brand XYZ stable coin, and I'm going to choose between the two. Like none of that.
Could maybe solve the what about for like rewards? That's one thing that credit cards currently have. That like I get miles. Like could there be something with if I use this stable coin, I get remitted? But I don't know. I'm just throwing stuff out there.
So for what it's worth, I spent a lot of my time contemplating the reward ecosystem and mostly raging against it because it is one of the less documented wealth transfers. And by the way, the credit card industry in general is a regressive wealth transfer where people who never revolve transactors, like probably both of you and me when I do use credit cards, which is really rare these days, we're paying our bills at the end of the month. We're not paying a penny of interest. I think Joe's on the record saying you've never paid any interest. And so I think that's a nice place to be if you can afford it. Telling people that they should just not borrow and pay it off at the end of the month is an incredibly let them eat cake equivalent for the 21st century payments. Lots of people in America revolve. Half the country revolves at $10,000. And so the idea of those people caring about rewards is sort of preposterous. They do not. They care about making their minimum payment.
Yeah.
People who are figuring out which reward scheme they want to be a part of, I'm just not so convinced that they're going to be expanding their horizons to have more stable coins. Because ultimately they're just getting dollars. In the world of Affirm, people that we serve every single day, 24 million of them in the last 12 months, they really, really care about the interest rates they pay because a lot of them understand that the alternative is revolving. And so for them being told, hey, your reward is a 0% loan is incredibly powerful. And so before we get into using our hard-earned revenue into stable coins, we will just give it back to the consumers in a form of no interest.
So we talked about how you make money, but we should talk a little bit about your cost side as well. And
Sure.
you mentioned funding earlier. So you have to get money from somewhere and you're paying for that money. What levers do you have to pull if the cost of money goes up? And again, I'm aware that we're recording this in early December and everyone expects an imminent rate cut. But in theory, if interest rates were to go up, what could you do to offset that additional cost?
So the most important thing to understand about our business from the capital sourcing part of the game, everyone understands that rates are not super volatile, but if you look back a couple of years, they were very volatile for a brief, not so shining moment. And so we all knew it was possible. So all of our contracts with various lenders of money to us, but also people who will buy our loans, they all adjust fairly gently over a course of a fairly long period of time. So it's not about can we deal with rising costs of credit for us, it's how quickly do they change for us. And of course, we understand that they might change quickly. Therefore, a lot of our contracts stipulate that, hey, if they do move up, the adjustment to our cost will go fairly slowly over a period of time. So the more likely outcome in December is probably a downward motion of the credit rates, or perhaps they stay steady. But just the same as I described, we're not going to wake up to 25 free basis points of incremental revenue. It will eventually come to us in a form of incremental margin, but it'll take its time because these contracts adjust both up and down quite slowly, and we're in no way unique in the industry. Everybody does that. The levers we have to deal with such cost changes are exactly what you would expect. So we will either pass it through to the consumers, and moving up in the increments or down of 25 basis points is not that significant, and most people, I think, generally don't care that much. In some cases, we actually choose to tell, hey, merchant X, you are providing these rates for nothing. You should continue doing so, but the cost to you will go up a tiny bit because the rates have changed. Now, because of time value of money, the merchants pay us in real time, essentially, as the transaction is consummated. The true cost to them is truly de minimis. And so in either of these two cases, so long as the movements are not very violent, it's not that major a component of our business.
I just have one last question. AI. So setting aside the technology for the underwriting, which I'm sure is a very high-tech, data-intensive application, and setting aside that probably many of your engineers on staff are using code generating for that, just putting your tech hat on as someone who oversees a large organization, people looking for how large language models in particular are being deployed in productive capacity. At a firm today, is any of this technology in use in production and saving human hours in some respect or another?
Yes, emphatically so. So we just wrapped up the Cyber Weekend, Turkey 5, Black Friday, Cyber Monday, whatever you want to call yesterday, which was wonderful. And I don't actually have the stat yet because I will get the report immediately after this podcast is recorded. But I'm confident I probably can't pre-announce the results. We report early next year. But we will have handled tens of thousands of consumer contacts. People saying everything from, hey, I just borrowed money from you and I don't understand when my first payment is due, and maybe it's because they hadn't read the email as clearly, or everything all the way down to I just borrowed money and I realized that I need a refund because I actually have no intention of buying this thing, and all that stuff. And a lot of it we try to serve them in real time as they're transacting, but plenty of people contact us right after or maybe sometime after the purchase. A huge percentage of that is handled entirely by AI now. Now, that has not caused us to lay off our wonderful customer service staff at all. What it has allowed us to do is to go really deep into specialization. AI is very, very good today at handling basic questions. It can do cool things like look up your account and say, no, you're not late, you're mistaken, don't worry about it. Or yes, you're late, but we don't charge late fees, so just please make yourself current and we'll move on. All of that can be handled by AI wonderfully. If it's something like I changed my name or I changed where I live right as I was consummating this transaction. There are all sorts of crazy things that come up.
Yeah.
That is something that a human can handle. AI models are not smart enough yet to handle some of these things. And also, frequently enough, we wouldn't want the possibility of hallucination to derail what is a good customer relationship. So we've been able to move our human helpers into a much more sophisticated, much more specific role. So the theme in our customer service for the last year has been specialization, 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 where we train people now to serve very, very specific subset of problems because they can be effective and move faster. And so these tools are actually making them more efficient by letting them focus on just a very specific thing that they're good at. So that's one example. We track all sorts of interesting metrics about AI tool usage internally. The interesting or sort of random factoid, our engineering group is not the single largest consumer of AI tools. I will not reveal exactly who it is. And by the way, like vast majority of our engineering.
Not reveal who it is.
Give us a hint or something.
It's actually finance. Our finance group uses these tools obsessively. I'm cheating a little bit here. So for a very long time, it's not the case anymore, but for a very long time, because we are so AI and ML heavy company, one of the core requirements for any employee, but certainly in finance, was you have to know how to read code and probably write code. And so a huge percentage of what we do in our finance group actually looks a lot like coding and a lot of software engineering. And so, but they're somehow, maybe because it's a smaller group on average, but they're great adopters of these tools. Our legal team uses it all the time. We have literally hundreds of thousands of very custom contracts. Every time a merchant pays your interest for you, they signed up for it contractually. That's a custom contract. Imagine managing 500,000 of these things. They're all carefully written and bespoke, and so AI can read and find errors and corrections, et cetera, et cetera. So one of the things that we're responsible for as a regulated business is we cannot allow merchants to advertise our service incorrectly. We're actually on the hook. When a merchant says something like, hooray, Affirm, interest-free for everyone, it's not true. Some people will actually pay some interest sometimes. We are responsible for finding that and telling the merchant, please stop saying things that aren't strictly speaking true. AI tools are amazing at reading boatloads of advertising copy and saying, hey, wait a second, that is inaccurate. We got to fire off an email and tell this merchant to fix it. So you can sort of imagine a flood of ideas that we had when the ChatGPT moment happened and put it to work for the last few years.
I'm going to end with a sort of theoretical question, a big picture theoretical question. But if you could design the ideal payment system from scratch, complete scratch, using today's technology, there's no legacy card networks, maybe not even legacy banks. What would it look like, and how much of a firm's current business model would survive in that environment?
Well, I think it would look an awful lot like Affirm. Affirm is my personal attempt to build a system that I can be proud about. One of the core things we tell people who join us, one of the reasons we had such a black and white, no late fees, no compounding, no deferred interest, none of the yuck, is because I wanted the smartest people that would have otherwise gone to Wall Street and traded in quant funds to join us and build the system that they could be proud about. It's very hard to be proud about a thing that makes half its money on late fees. And that's why we don't do it. And so what we've built is, biased as I am, is pretty darn great. It really is something that I'm very proud about. And I think the totality of the team here takes an enormous amount of pride in how we went about building this. It is dependent and intertwined with the legacy systems. But even as we go through card rails, to use another industry jargon, or many other systems that have existed when we tap into capital markets, which have certainly been here long before we came about, and everything else in between, we maintain the moral integrity of the product and its DNA all the way through. We might pay late fees if we borrow money to lend. We haven't, because obviously we're on a pretty tight ship here. It will not be passed through. We take an incredible amount of pride in the diligence we exercise within the system, all the way down to leaving a penny on the table for our partners to keep because we refuse to make more money than we said we would. I would love to have a blank sheet design exercise in payments, but I think what would emerge is a system that looks a lot like Affirm, just doesn't have some of the 1980s cruft in it.
Max Levchin, founder and CEO of Affirm. So great chatting with you. Very illuminating, helpful conversation, and I appreciate you coming on Odd Lots.
Thank you so much. And again, I am a fan of the show, and I love being able to see myself inside of a thing that I actually listen to all the time.
Very kind of you to say. Thank you so much. That was great. aggressiveness of the point system, right? So there's people like us who rarely roll their credit card debt, but get frequent flyer miles or other rewards, et cetera. But that's paid for by the people that roll. Now, if a firm is targeting, they're clearly targeting people who are not thinking about points, right? They're thinking about people who really do need to extend their payments or implicitly roll and say, we have a better option. So it's sort of cleaving off. If this grows, the firm is still just a $22 billion company by market cap. But as this grows, you got to wonder, like, if in the maximal version where you've cleaved off a significant number of people who roll, what happens to the points ecosystem for the people like us? Now, granted, I don't think like, oh, what about the poor freaking flyer and all the great rewards you're getting? But
will someone think about the points?
Will someone please think about the points accumulators who never go into debt or who never like roll their debt? But it is interesting to think about if you could like cleave off that, then a big part of the business model of credit card, the legacy card companies, could potentially be unstable. And part of the appeal of going to any credit card that offers a lot of rewards could decline if revolvers move to this alternate payments model.
Yeah, it's a really good point. On points.
Thank you.
That one was a little obvious. I'm sorry.
No, it's good. I like that one. It was straightforward. I actually got this one.
Okay.
Actually, you know what? I really also appreciated that Max had substantive answers for things that they're doing with AI that aren't just code generation. Even if it sounds like the finance department is probably still using it for code generation, like that makes a lot of sense, like being able to proactively scan websites to say who is claiming something that's not true about a firm, et cetera. So maybe there are productive uses of all this technology.
Or sending out millions and millions of contracts automatically.
Totally.
All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can find me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Max Levchin. He's at M. Levchin. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. And for more Odd Lots content, go to Bloomberg.com.
We get the story behind the money to explain how money works.
Hello and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
Tracy, there are just so many credit-related things to talk about right now. All things credit.
I love it. I love it. Credit is interesting again.
This might be one of the only credit episodes that we've ever done where, like, I found the guest. Because I feel like when I think about, like, all the credit episodes, it's usually, like, someone you know. And randomly, I found someone who knows a little bit something about credit. So I was like, oh, let me do it.
The stakes are high, Joe.
I know. I was thinking about that because you're like, oh, Joe, you, like, pick someone who, like, doesn't know anything. No, I don't think that. I think we have a very knowledgeable credit guest, but I'm a little stressed about this aspect.
I believe in you, Joe.
You do?
I trust your judgment. But to your point, there's a lot going on. So obviously, there are concerns around private credit. We've had some idiosyncratic defaults and frauds in the market. And each one is special in their own way.
Right.
But I think the worrying aspect is that they keep coming to light, right? And so you've seen people like Jamie Dimon using the cockroach analogy, which is now famous. And at the same time, you have the connection with AI, right?
Yes.
Which we have spoken about a little bit on the podcast with Paul Kadrowski, all these complex circular financing structures that are driving a lot of the credit boom or have been driving a lot of the credit boom. And then at the same time, you also have the impact of AI on credit itself.
Yeah, that's right. Because in theory, right, like we've talked about this. We did that episode with Joel Wertheimer. That was in a slightly different context. But we've done these episodes about, you know, just the incredible length of deal text, et cetera. And perhaps if there's one area where maybe we could say with some high degree of confidence that large language models could be useful, it is, can we break down this, you know, multi-hundred page agreement so that we don't have to have, you know, junior associates or junior lawyers or junior bankers up till 4 a.m, making sure that every comma is in the right place, et cetera. In theory, this could be an area in which AI could be productively applied.
You know, there was an actual case argued over a comma.
Oh, yeah.
I can't remember exactly what it was, but like you're absolutely right. The grammar, the specific words clearly matter in legal language. I would just add one of the things that's been arguably driving private credit is the boom in creditor-on-creditor violence in public deals.
Yes.
So it was this idea that you could avoid that by having, this private, close relationship with your borrower where you are higher up in the waterfall of payment. So this is important.
It would be really nice if you could upload a credit agreement to ChatGPT and just say, make sure there's nothing in here that would get me in trouble. Make sure there's nothing in here that 5 years later I will regret the placement of a certain
Make
comma.
sure I don't lose money.
Make sure I don't lose money in some technical way. Anyway, so there's just a lot going on. I feel like there's plenty of episodes to do on this. But we really do have the perfect guest, someone who literally sort of sits in the intersection of, I think we identified 3 distinct trends here. We are going to be speaking with Dan Wortman. He's the co-founder of a company called Noetica AI. And it does exactly this. It sort of attempts to use AI to understand credit. So he has a lot of understanding about deals and the text in them. But he also just has a lot of understanding about AI, et cetera. So can talk about all of these things. Dan, thank you so much for coming on the podcast.
Thanks so much for having me. I'm a fan of the show.
Love to hear it.
You guys are kind of like celebrities for me. So it's kind of fitting that I'm here because, at least with folks at Bloomberg, because many people think about us at Noetica like the Bloomberg for deal terms.
Okay, well, let's see if you actually live up to that. No, but so since I said I'm stressed that, this time we're doing a credit episode and I found the guest, give us the quick version of like your career and what Noetica is.
Yeah, so let's start with Noetica. What we build at Noetica is AI-powered software for benchmarking real-time data on what's market in credit, M&A, capital markets deal terms.
Okay.
So said another way, we help folks like transactional attorneys, credit managers, bankers, we help them figure out whether the terms of their transactional agreements, like think financing agreements, merger agreements, prospectuses, and really all other corporate transactions are on or off market by benchmarking them to market comps. So as far as the genesis of Noetica, it was kind of born out of my own experience in my career. So I started my career at BlackRock. I was on a team responsible for coming up with new financial products in fixed income markets. And we were developing these new, interesting, innovative structured products. And I just learned a ton about the capital markets ecosystem. And in particular, just it's a $50 trillion global market.
Yeah.
And it runs on phone calls and relationships. And it's unbelievably antiquated. Then fast forward, I went back to get my GD. I joined Wachtell Lipton, where I did corporate transactions. This was 2017 to 2022. So if you guys remember that time, it was heyday of merger activity.
Right.
So I worked on, T-Mobile's buyout of Sprint, the biggest $30 billion commitment at the time, Allergan AbbVie, UTC Raytheon. And I distinctly remember I was sitting down at my desk. I was looking at a transactional agreement, a multi-billion-dollar merger. And I was looking at a term, and I was trying to figure out whether I should help my client accept term A or term B in this context. And I was stuck. So I called a senior partner on the deal. I said, hey, where's the database of information where I could see exactly how this term should come out and quantify it for my client? And, the answer was that doesn't exist. Now, that was 2.5+ years ago now. I left Wachtell to start Noetica with a fairly simple idea, which is AI enables us to finally quantify what market agreement terms should look like in these markets. Now we work with almost all the top 20 law firms on the street. We're helping them advise their clients on these deals. And this year we're on track to do about $1 trillion of transactions through the platform.
Wow.
And you get 1% of that. So that's great.
Well, talk to us about what these financing agreements actually look like and how traditionally they're sort of judged by both the investors and the lawyers who are looking at them.
Yeah. So when I say deal terms, what I mean is deal terms are really the underpinning of the entire transactional system. The rules of the road. You could think about them like speed limits, double yellow lines, street lights. They're kind of the plumbing that goes into the transactions, putting it in a way that people can understand. Imagine I go sign a lease. Most people are very familiar with certain things, right? Like the rent price, how long the lease is.
Subletting policy.
Exactly. But if deep in that 20-page lease, the lease says, if the weather gets under 30 degrees at any time, you forfeit your right to the apartment. Well, that's a deal term. And that affects whether you want to accept that lease or not. And so it's the same in capital markets terms. To give you a more tangible example.
Yeah.
Are you guys fast food people?
Yes.
Okay. So I'm like a McDonald's guy.
Yeah.
And
Okay, good.
whenever I go to McDonald's, I always order the 10-piece chicken McNugget. I've ordered the 10-piece hundreds of times. There's exactly 3 things that happen when you order a 10-piece. You open the box, you have 9 pieces. You open the box, you have exactly 10 pieces. Or you open the box and you have 11 pieces. Now, if you have 9 pieces, you go to the counter, you say, hey, I'm missing a piece. They give you a piece. You get the benefit of your bargain. If you get 10, you enjoy your McNuggets. If you get 11, what do?
You stay quiet.
Exactly. So you hit the jackpot, right? Now, there's this kind of unwritten rule in American consumerism, which is that if a company that's bigger than you gives you something by accident, then you get the benefit of that as a consumer. Well, in 2020, the exact kind of thing happened in the credit markets, but it ended very differently. Citibank sent $900 million to lenders in full prepayment of a loan for Revlon, and they did so accidentally. Now, they were supposed to just send an interest payment. At the time, the terms of the credit agreement were silent. The governing documentation associated with this loan didn't say what happens in that scenario. Long story short, many funds did not give back that hundreds of millions of dollars, and litigation ensued. But a deal term in credit deals called erroneous payment deal terms started popping up in the market. Noetica's data last clocked that deal term as of last quarter at 90% of deals. So if you don't have that term now in your deal, you're way off market in terms of the way the market actually operates. This is why deal terms are important. These are hundreds of millions of dollars at stake in the context of all of these deals.
There's something very lawyerly about, like, I have to say, I've never counted the McNuggets. I just get it. And so just this example would have never occurred to me because I'm not the type of person that opens a box of McNuggets and starts
And clearly,
counting
you
them.
don't value McNuggets enough.
Evidently not. What are some other deal terms? So that's a great example that, okay, now after that incident, which was infamous, language about this started popping up. What are some other sort of classic, and I'm sure they get much, much more esoteric than that, but what are some other like interesting deal terms that trend over time?
Yeah, so it's really interesting. So there's a whole host of what I would call structural protections in a lot of these deals. These come in a lot of different flavors. Many people talk about them as things like anti-PetSmart terms, things like J-Crew blockers, things like CERTA protections. Let's talk about some of these.
Yeah, right.
Yeah, let's talk about some of these. So anti-PetSmart terms, these are protections that prevent guarantor releases when subsidiaries of the credit group become non-wholly owned. In other words, it prevents value from being transferred away from the loan into some other structure which doesn't provide credit support. Let me put this in a way that most people don't understand. If you were getting a mortgage on your house, pretty simple framework. You take out the debt, you pay your mortgage payments, you pay back the loan. Bank can foreclose on your house if you stop paying the mortgage. But in the mortgage, if it said something like, well, if you sell any part of your home, front door, a window, a shingle, the bank loses the ability to foreclose on the house fully. Well, then what would you do? You would sell a single shingle, you would stop paying your mortgage, and you get to keep your house, and you get the benefit of that. That's what anti-PetSmart terms actually prevent. They prevent the ability for credit groups to actually sell a single equity and actually lose the credit support from that particular equity. So it's kind of interesting what we're seeing in the market right now. We have this really unique vantage point from the point of view of our software where we quantify trends in deal terms over time. And so we can actually very precisely tell you the percentages of deals that are actually getting a lot of these structural protections. And it actually gives us this really unique window into the anxieties and the optimisms that are currently happening in the market. Some people think about this as kind of an early signal of something likely to come. So what are we seeing? Well, we're calling it a flight to fortification. And it's really happening on both issuers and borrowers. And I'll explain what I mean. We're seeing massive increases in lenders getting structural protections in these deals. Basically, these are protections that help make sure their collateral is locked. Things like the anti-PetSmart terms. In return, borrowers are getting the same fortification. In fact, they're getting more economic flexibility. And you could think about it as a way for them to weather the storm. This is how we're seeing it. So things like add backs to EBITDA, more ability to send money to shareholders, more ability to make long-term event spends. Let's talk about the actual specifics of what we're seeing. Anti-PetSmart terms, the one I just talked about, we clocked that at 28% of deals in Q3. That was at 4% in 2023. And Q2 is at 25%. This is the highest we've ever recorded that term. J-Crew blockers, which prevent issuers from moving material IP outside the credit group, that's at 45% of deals now. The baseline from 2023, 15%, and last quarter it was 38%. Anti-STRTA protections, which are lien subordination protections, they actually help secure your place in line if and when some sort of distress activity happens. That's at 84% of deals. That's the highest jump we've ever seen quarter over quarter. It went up from 61%. It's a 23-point jump, and the baseline was 39% in 2023. That's pretty significant for a quarterly jump. And it really signals something about the market. On the quantitative side, we track a lot of stuff too, including the ratios under which borrowers need to maintain specific types of leverage. We saw that at 3.9 times EBITDA in Q2, and it went down to 3.5 times EBITDA. Again, that's signaling some sort of anxiety among the lender group that we wouldn't normally see. Now, you may ask, what are borrowers getting for this? Again, they're getting more fortification. One of the ways this is coming up is in EBITDA add-backs. So EBITDA add-backs, basically there's a very long and complicated calculation of cash flow in a lot of these deals. And the add-backs to EBITDA basically allow borrowers and issuers to add back certain things to count them as cash flow today.
To flatter their balance sheet, basically.
Correct. Correct. One of the more interesting add-backs that we track is what's called a cost savings add-back. So imagine a borrower knows it's going to optimize some cost in the future. If it can reasonably predict that cost, it can add that back to today's cash flow. That cost savings add-back, whether it materializes or not, is added back to today's cash flow. 64% of deals now have cost savings add-backs in them. That's the highest we've ever recorded. For deals with those add-backs being above 20% of EBITDA, that came in at 51%, which is also the highest we've ever tracked on the platform. They're also getting things like excluding lenders that are short in their debt. So, for instance, folks may be familiar with what happened with the Windstream case a few years ago. What happened in that case is certain hedge funds were actually short the debt, the loan that was in default. And that makes them not exactly aligned with the company that has the debt outstanding. Terms started popping up in the market, which we've tracked, which are called net short lender terms, which allow borrowers to exclude those lenders from voting. That is now in 13% of deals, which is the highest we've ever tracked. So you could see the fortification actually on both sides of the market. And it really signals, I think, to us that there's a risk allocation happening with a lot of these anxieties.
Listen now, wherever you get your podcasts.
So the inventor, some people invent great medicine, some people invent some new technology, and someone invents a new deal term that gets propagated across documents for years thereon after.
That's how it works. But Dan, I wanted to ask you something. Okay, so you say there's more fortification in a lot of deal terms, more protections perhaps for both investors and lenders, I guess. One of the things we heard prior to 2020 and then for some years after it was we had this explosion in cov-lite deals, right? Fewer protections for investors because everyone was so desperate, supposedly, for yield for that particular paper. So the balance of power shifted to the borrowers. They were able to dictate the terms. How are investors getting better protections now with, credit spreads still at basically multi-decade lows, which suggests that there's still a lot of demand and that they don't hold all the power in the market?
Yeah, I think about it, and what the data supports that we see on the platform is, I think about it less so as what they're getting, but more about what the terms actually reflect in terms of the macro environment that they're operating in. So, for instance, right now we're seeing this flight to fortification in part largely due to probably a few things. Number one being some of these headline risks that folks have been talking about. And I'm sure we'll get into some of what's going on in the private credit market today. So people flooding into more structural protections because they're worried about their place in line if there is distress. I think number two is just macro-wise, if you think about it in the credit markets, there was a ton of debt taken out in 2020, 2021, 2020, early part of 2022. This leads to a lot of maturity walls upcoming. especially in 2027, 2028.
We don't say upcoming on the show. We say looming.
Yeah.
Looming. Yeah, exactly. There are a lot of looming maturity walls in 2028, 2029 vintage. And you could think about it as, well, that's a macro factor that people are thinking about when they underwrite a loan, because many of these deals actually have 5-year tenor, 7-year tenor, 8-year tenor, in some cases 30-year tenor. And so they're thinking about all these protections in the context of that market. I also think it's really interesting, aside from the credit context right now, we're seeing a lot of structuring in terms happening in M&A markets. So things like regulatory uncertainty, things like tariffs, things like liability management, as we talked about, things like tax uncertainty. I'm happy to go into these, but we're seeing a lot of things in this area. One kind of small example of this, in situations where a buyer and a seller have regulatory uncertainty, which, a lot of folks think about the administration and they're not sure exactly how things are going to play out. You actually see regulatory review in deals get hyper-focused on. And it actually precipitated a new deal term this year, which we tracked in the market. We had an anomalous term detection on the platform. We sent out a note to all of our clients, and it's called a new outside date structure term. Basically what it does is it allows buyers of acquirees, it allows them to lock in their financing for longer and actually extend their financing in the case scenario where regulatory review lags. And that's just an example of the kind of innovation that's happening in the merger markets. In terms of tariffs, we picked up the first tariff event of default in a credit deal ever. It happened in a Superior Industries deal over the summer, which probably is unsurprising to you as an auto manufacturer deal that made a lot of parts in Mexico. That's now in 5% of M&A deals for tariff-based M&A carve-outs and material adverse effect clauses.
Can we talk a little bit about, you're scanning these documents. Google's Ngram has existed for a long time. Tracking the prevalence of a term is not novel technology.
Yeah, Control F exists.
Right, Control F. Yeah, dude. This is sort of like it barely even counts as technology at that point. What is it that when you're talking about the changing prevalence of these terms, what is the actual novelty here that isn't just sort of, document search over time?
Yeah. So Tracy, your husband's a former corporate lawyer.
Mm-hmm.
He would tell you.
Recovering corporate lawyer.
Recovering corporate lawyer, exactly. I am myself as well. One of the things he would tell you is that there's constant innovation in these markets. These agreements are highly complicated. They're very long. They have a lot of what's called long-range dependencies, which is that you may be used to seeing something in a particular area of the document said one way, but in reality, it turns out it's punted to 3 different clauses deep down, and you actually have to go find that information. This is why.
It's also jujitsu between the borrowers and the lenders, right? Because the borrowers are often trying to hide something that's favorable to them, or the lenders are trying to hide something favorable to them. So the structure and the way it's worded changes a lot, to your point.
Exactly. And these are sophisticated parties paying millions, sometimes hundreds of millions of dollars in advisory fees to make sure that these terms look the way they do. Now, that leads to kind of the technological innovation that I think has enabled a lot of this. AI, for the first time, can attribute, in particular, new language models, can attribute more semantic meaning to phrases and language that was impossible with things like Ngrams. And so what Noetica does is it uses a series of language models, including a multi-layered information extraction system, to make sure that it's encoding all the semantic meaning inside all these terms, so that when you look at a J.Crew blocker in the first way, it may be phrased 1,000 different ways, but we can track that term over time. That has enabled the ability to actually quantify for the first time what a market agreement term looks like in these markets. And I think that's why it's so interesting to folks on the platform.
So I know you're not doing litigation, but I guess I'm curious how you deal with, or if AI is helpful with, in litigation, what would be called precedent. But I'm assuming you're building up a big database of all these different deal documents. Is it useful? Is AI useful to go back and look at previous documents in order to shape new ones?
Yeah, exactly. So at Noetica, we are ultimately an AI-powered software company, but we actually have the largest knowledge graph of deal terms in existence. So Tracy, exactly what you said. It's a database, ultimately, of precedent comparable deal terms. And that database, this is going to be mind-blowing, has over 1 billion terms in it. So it's actually the largest in existence. We map that back to deal characteristics. It's the same in litigation, right? So in transactional markets, folks are innovative, but they also want to rely on something that has happened before, or at least in part, they want to rely on something that has happened before. And so folks are constantly looking for ways to tie things back to comparable deal terms. It's the same in litigation. So obviously not my expertise, but the same concept, which is, when you write a brief, you are constantly citing cases that the judge has, relied on in the past. And for lawyers and, outside of lawyers, even just deal professionals generally, bankers, credit managers, people are highly reliant on precedent.
What is your tech stack? What do you build, and how much is it like, you're using ChatGPT's API, et cetera? Like, okay, yes, large language models are good at identifying deal terms or novelty, et cetera. There's semantic meaning of these terms. But what did you actually build, and what do you actually employ in your technology?
Yeah, so we were started in 2022. So we're what you would call AI native. We were started in a system that already language models existed in. However, because of the nature of the sensitive documents and terms that we deal with, especially for, major law firms, financial institutions.
Yeah, this is like a big issue with it, right? That they don't want to just be uploading their stuff to ChatGPT, right?
Exactly. And so we actually utilize adopted language models, open source language models that we adapt on our own proprietary data sets and then deploy in secure environments and single tenant architectures, for individual instances of institutions that deploy our product. And so you could think about it as based on the language models that are ultimately underpinning a lot of the GPTs and the Claudes. However, it's fine-tuned to this particular data set, which makes it obviously much better at handling this exact problem, which is a big problem in the market. Now, we also layer on top of that information extraction models. So for instance, you may know that a term exists in what deal, but you may want to know what terms should exist for a JP Morgan deal or for a B of A deal or for, a particular type of counterparty. And so in those contexts, we actually want to map those deal terms back to deal characteristics. And we actually utilize a lot of models to extract information and marry that with third-party data sets. So that's a little bit about how the technology works. I always think about it from the user standpoint. What does the user really want? The user really wants to know how they're going to advise their client on a particular merger, on a particular credit deal. How often does this come up? You always call your attorney and you're trying to figure out, is this market? Is it off market? And that's what our data provides.
Okay, so structural fortifications in deal terms. What are you seeing right now? Because as we started this conversation, we were talking a lot about the recent blow-ups in the private credit market. And if you look at some spreads on certain firms, certain bonds, it does seem like nervousness is creeping back into the market. I see spreads on, it's not private credit, but spreads on CCC rated debt have been creeping up recently. How scared or concerned are people right now?
Well, I recently wrote about this in the Wall Street Journal a little bit, and then folks contacted me and they kind of said, you're causing a stir. And then I saw Howard Marks came out with his letter, which I think was called Cockroaches in the Coal Mine. And it had a lot of the same themes. I think folks who have been around credit markets for a very long time can kind of see a little bit of what's going on. To us, let me just talk about what the data supports. To us, what we see is creditors may be preparing their system for distress.
Okay.
And I'll talk about what we're seeing in the data that kind of supports that. But you could think about it like the evolution of your house security, right? So, first you lock the doors, then, you get a bolt lock, which gives you better protection. Then you add a security system on top of that, an alarm system. And at the end, what do? You kind of count up all your valuables and you insure them if people are going to get into the house. And, for the past few years, we've seen lenders really focus on keeping people out. This is the locks and the deadbolt. And this is what we were talking about with J-Crew blockers. This is making sure you can't structure around me from a liability management perspective. But over the last quarter, something kind of changed, which is we started seeing people and lenders obsessed with lien subordination terms, which is the term that governs who gets paid first when everything falls apart. So this isn't really about preventing liability management exercises that much. It's actually about controlling the recovery when a bankruptcy does happen. And so we clocked that term at 84% of deals in Q3. Biggest quarterly jump we've ever seen from the prior quarter. It's also the highest we've ever clocked that term. So this begs the question of why. Why are creditors so focused on making sure their place in line is
in recovery
is the same? Perhaps it's a reaction to the liability management transactions we talked about. So perhaps folks are thinking that will precipitate. Perhaps it's a reaction to some of the maturity walls that folks understand. Or perhaps it's some of what I was saying in the op-ed, which is folks are seeing that there may be distress events on the horizon, and they want to make sure that if there is, they have the most negotiating leverage as possible.
Out either just quality due diligence or diligent terms?
Yeah, so I think with First Brands is a great example, right? So First Brands is an automotive replacement company, right? So they make things like brakes and wipers and filtration systems. Beginning in 2019, that company effectively rapidly expanded through debt-fueled acquisitions, and it dramatically increased its scale. But I think what First Brands illustrates is something that we might get into with the private credit markets, which is that they primarily funded these acquisitions with large debt facilities. Then tariffs hit in April of 2025, which obviously changed their business because they actually do a lot of manufacturing. And that kind of magnified problems. So you could think about one of the main problems with First Brands, which is also kind of some of what folks are worried about in the private credit markets today, is what's called off-balance sheet financing. What First Brands used is a lot of receivables financing facilities that weren't properly disclosed to a lot of folks that were lending to the company. In fact, I think in that sense, just to give you a sense of quantum, this is over $11 billion of total obligations that they had when they actually started disclosing it in terms of off-balance sheet financing. And, they were disclosing things like $5 to $6 billion of actual debt obligations. And so this led one of the creditor's lawyers to say that $2.3 billion just disappeared. And so that structure, the ability for First Brands to get that debt, was made possible by the private credit markets and how deep the private credit markets have become. Because if you're a big credit manager in private credit markets, you could fund that type of receivables facility to a First Brands. And First Brands could use that facility to then make sure they are constantly continuing to acquire new businesses and keep rolling over the cash.
I have a theory that receivables financing and factoring is to the private credit market what French quants who went to that one really elite school
I like this theory.
are to trading blowups.
I like that theory.
Yeah, thanks. So the other thing we wanted to ask you about, and again, we referenced this in the intro, is we are seeing these really complicated deals that I admittedly cannot keep track of in the AI market where, one company is going to buy chips from this other company, and then that company is going to borrow from whoever and use the chips funding to pay them back. And then that money somehow goes into the company that is buying the stuff in the first place. It is all very circular, all very incestuous in many ways, in my mind. Are you examining those types of deals or just putting on your credit expertise hat? If you see something like that, what are you thinking?
Yeah, well, it's probably helpful to kind of talk about some of the structure of these deals, which I think, again, is made possible by how deep the private credit markets have become. And usually when I do that, I try to think about, let's try to make this a little bit more fun. So imagine for a minute, Joe, you just love pizza.
Yeah.
He does love pizza.
I do. I had it yesterday twice.
There you go. You're a pizza fanatic. You love it so much that you decide to eat pizza every single meal of every single day for the rest of your life. Like you are committed to subsisting on pizza.
Much,
committed to the carbs.
Exactly. So, Joe, you made that decision. You come to me and you say, hey, Dan, I'm going to eat pizza for every meal of my entire life. How about you open a pizza restaurant for me to eat it? It'll be really lucrative. You have a
I see.
captive
I was
customer.
wondering where you were going with this. Tracy, are you this is good actually a very about good analogy, like right? frequent Like you'd have to flyer
have a-
miles and hotel rewards and cash back and using your credit card to get like good seats at the U.S. Open, like all the or dining? Are you good about maximizing that stuff?
Nope, I am not.
No.
I'm trying to be better. I'm finally signing up to a bunch of frequent flyer programs and things like that. But in general, I am not a points strategist.
No,
Some
God.
people get really into it.
I know. I do not. I have a very busy life. I do not have mental energy towards, maximizing points or learning about the newest cards. Like, oh, is this card worth a $400 fee because I can get upgraded to platinum faster this year? I do not want to think about that stuff. I'm not that interested. But I get the impression that means I'm probably paying for someone who is, or something like that. Or maybe, I'm paying these fees on my credit cards or these interchange fees, et cetera. Maybe I'm leaving money on the table by not doing that. I don't know. I find credit cards to be a weird business. Like, I don't really know what Visa does relative to, say, the bank that issues a Visa card, et cetera. I don't know how they slice them. I don't know anything about credit cards.
It's a very opaque business, for sure. And it's a weird business. I would say, it's competitive, but also it's, not that much.
Right.
Everyone's kind of doing the same thing
Yeah.
in many ways. So we should talk about it. It's also, I imagine, kind of sticky in the same way that deposits at
Right.
banks are sticky. We spoke with Joe Abate about that a while back. So
Some
I
people
don't know.
cycle through them a bunch and stuff like that. And there's so much credit card advertising. I don't know what's good or bad or whatever.
Yeah.
Look, I use my credit card as a payments card because I don't carry a balance from month to month. So I don't know anything about interest rates or whatever. I pay it off at the end of every month because I just basically use it for payments, etc. So I just don't know much about them, but they're a huge, major consumer financing source.
Yeah.
And everyone's talking about Fintech and BNPL and all these other things and stable coins and all this other stuff. And it's like, yeah, but the big one, who's talking about the big one? Credit cards.
Well, that's the thing. So points have become a bigger attractant, I guess, to credit cards. And so people are spending more with their credit cards and carrying a bigger balance, which means that the rate that you're paying on the credit card is actually more important potentially than something like your mortgage rate.
Totally. Well, very pleased to say we do, in fact, have the perfect guest. Someone we've had on the podcast before. I think the last time we were talking about Reg Q, which is bank lending in the 70s. I like his work because he goes back to the simple things. Like, let's just talk about how this works. Let's talk about how this works. Because I think we move on too quickly without sort of understanding the basics. Maybe there are stones left unturned. Literally the perfect guest, Itamar Drexler. He is a finance professor at Wharton, and he was the co-author of a fairly recent paper sort of looking at the question of why are credit card rates so high?
And to launch, I would like sincerely to congratulate RT team, a magnificent RT team, and then the viewers of RT for launching your broadcasting in India. Well, actually, you have started to broadcast in the biggest democracy of the world. Sometimes it's better to lose the right to broadcast in the small democracies, so-called democracies, and to launch to broadcast in the biggest one. Stick to the biggest one. Be the best. I would like sincerely to congratulate.
Yeah, so my interest is usually, like we talked about when I was here last time, is monetary policy, macro, and a lot of banking. And I had some students who are co-authors now on this paper. A couple of years ago, I want to talk about Fintech because Fintech is a very popular topic. And then I was thinking, well, how do we analyze Fintech and what's the potential room for Fintech to grow if we don't really understand how the dominant incumbent players, the credit card banks, work? And then we look at this, and I was very surprised to see something kind of simple, which is that the return on assets for credit card banks are just way higher than the average bank. So bank ROAs are typically, 1.2%. They move a couple basis points, very exciting. Credit card banks ROAs, and most banks are not just credit cards, so it's actually even higher than this, are in the 3.5%, often 4%. So I was very shocked by this. Okay, how come it's so high when it's so hard to squeeze out a couple basis points? And then one of the reasons is just they charge really high rates. Like, okay, how did they get away with this? What is going on here? Just very simple question about how to decompose that rate into the pieces and kind of what's left over at the end.
In the spirit of starting at basics, walk us through the revenue that credit card issuers or credit card banks are actually earning, the different types, and who the players are in the system.
Yeah, so let's separate first into two categories. One are people who revolve their balance, and that's what most of the paper is about, because I think that's the more interesting part, and there's more details, and it's kind of the banking part of it. And there are actually a lot of people who revolve. Often I find people are surprised to hear this, but about 60% of the credit card users actually revolve. So meaning that they don't pay in the grace period at the end of the month, and so they're hit with these very high, usually interest charges. And then the other part are what people call transactors. So they're the kind that do pay during the grace period, so they're not.
मीडिया के साथियों, नमस्कार, दोबरे दिन। आज भारत और रूस के
Then there's immediately a percentage taken, people call it the swipe fee, and that is split up into a bunch of pieces. The ones that I used to be aware of, that most people are aware of, is the card network like Visa, MasterCard, Amex. There was Discover, which is now part of Capital One. And there's a whole menu, but basically it's like 15, 20 basis points. Okay. Doesn't sound like a lot, but there's like $10 trillion of purchases between debit and credit cards. Turns out when you take 20 basis points of $10 trillion, it kind of adds up.
Nice business if you can get it.
It's really nice. Actually, you'd be surprised that usually Visa and JP Morgan are the two most valuable financial services firms. They change who's number one. So Visa's, been worth over $600 billion. It's a lot.
Yeah.
And MasterCard's gigantic too. So there's that. Then the majority of that swipe fee, the majority of the remainder actually goes to the bank that issued the card to the consumer. So that's called interchange fee. And again, they don't make this like very easy to tell, but in our data, it's a little over 1.8% on average. I think it's largely been trending up over time slowly. So the bank gets that. So it actually gets the vast majority of that. And then they pay your rewards and things from that. A lot of that goes to just passes through to the rewards and things. And they keep a small portion of it for themselves. But the big part of their business where most of the money comes from that we analyze here is all these people that revolve. They pay an interest rate, and that interest rate now is on average 23%.
Wow.
Which is was like a shockingly high number. I mean, I guess I've seen that. It just, when you work on assets and think the kind of things you guys talk about, bonds pay, 5%. Investment grade spread is not even 80 basis points now on top of it. High yield spreads under 3%. Like, how the hell did we get to 23%?
Yeah. When you hear this number, 23%,
yeah,
and you think about the fact that credit card users can be decomposed into transactors and revolvers,
right?
My first instinct would be, well, the transactors are very on the ball. They're like not credit risks. I've always been just a transactor. I've never revolved. How much of that increased spread can just be explained by likelihood of default from the revolvers, which I presume are perhaps a little more, financially precarious and maybe less financially sophisticated?
Right. So I think if, like me, you didn't know much about this, your assumption, if you ask most financial economists, the first thing they would think is, well, it must be that most of the remainders is charge-offs, right? Defaults. And that's not true. So you can find that pretty easily. So the average charge-off rate on the revolvers, okay, so when you look at it, let's say you look it up online, you'll see kind of, relative to the whole balance sheet, so it includes both groups. And like you're saying, by definition, transactors don't borrow, so they can't default. That kind of makes it go down a little bit, but the majority are revolvers. So if we kind of clean that out, then on average in our sample, it's 5.75% of balances are charged off. So it's not trivial by any means. That's a high number. But again, we were talking about 18% spread. So if you think, it must be about 18% charge-offs, it's not even close. And it's like never been that high. So you might think, well, maybe it's just, that's on average, but sometimes it'll spike to be ridiculous numbers. It does spike, but not for very long periods of time. So the bottom line is it's a substantial chunk of it, but not even close to a majority of it. So, people default, but they don't default that much.
Can I ask one more question on APR and the average there? Did you observe any trend over time? Like, did the rate actually get higher as time went on?
So that's something we haven't spent a lot of time on in this paper, but the answer to your question is this is obviously yes. So if you look at it, I think what can be found online is, again, I think there's something a little misleading there, but that has trended up pretty strongly. I think not as much as if somebody, goes to their computer and looks up, and I'll say Fred from the call reports, what is the average APR? It looks crazy. It looks like it's gone up 10%. It's gone up. We're going to get to the bottom of like exactly how much. I think it's gone up substantially since 10 years ago, let's say. That trend is clear. I don't think it's as much as it looks like there. But yeah, it's been going up actually.
Okay. So you've established default rates for credit cards. And as you said, like this business is about volume, right?
Yes.
So is there an argument to be made that maybe if the world, falls apart, then you have lots and lots and lots of consumers who are defaulting, but, potentially at a low rate of the total, but the volume makes it meaningful for banks?
I mean, we are already looking at as a percentage of assets. So that kind of like valuates it, takes it all into consideration. I think the question, like in our minds, was at first, maybe in a crisis, something extreme happens. In a sense, it does, but this is already the average default rate. So usually it's lower, and then you kind of include this in there. So we'll talk, I guess, a little bit about risk premium, which it turns out to be very clear here and important. But it's, just the average default rate is what it is. So it's not in expected defaults. Again, it's surprising, but at the same time, if you just look at where banks actually suffer default losses, in an average year, not a crisis year, something like 50% of banks' default losses are actually coming from credit cards. The thing is that they're not surprising. They're not unexpected losses. They're kind of the expected, but it's still really big. And the reason for that is even though credit cards only take up about 5% of banks' balance sheet, the charge-offs or the defaults on average bank assets is very low. I mean, I know we have this impression of banks as being these like crazy, like risk-taking lunatics, but actually, I think the right way to look at them is that their average asset is extremely boring and low risk. They do take a lot of leverage, which is only possible because the average asset is extremely boring and low risk. But even after all that, their amount of defaulters is not really that high. So if your average asset has about 40 basis points average charge-off, and this thing has over 5%, then even if it's only 5% of the balance sheet,
you a future where you're obsolete, or worse, identical. At Palantir, they're witnessing something different and revolutionary. From reindustrializing the nation's defense base to shipyard workers building faster and frontline workers boosting productivity, AI is transforming work across the nation. AI is not replacing American workers or flattening them into conformity. It's unleashing what makes each one irreplaceable: their judgment, their craft, their creativity. When American workers become more powerfully themselves, they own the future. Palantir, making Americans irreplaceable.
On the night before Halloween in 1975, 15-year-old Martha Moxley was murdered, but police failed to make an arrest. Until, in 2000, her one-time neighbor, Michael Skakel, was arrested. He was also a cousin of the Kennedys. The Kennedy connection is the reason that most people know about this case. But the deeper I dug, the more I came to question everything I thought I knew. Search Dead Certain, The Martha Moxley Murder to listen now, wherever you get your podcasts, and follow to get new episodes every week.
Other forms of consumer borrowing, right? Like people are very assiduous about making their car payments.
Yes.
I don't know.
Well, up until recently.
Recently, but historically, the perception was people really prioritize car payments, right? Because that's essential to live, and you can't have your car repossessed. Home mortgages, obviously, for obvious reasons. I imagine that a stretched household will miss credit card payments, are more inclined to, if they're going to have to miss a payment, it's going to be there versus some of these other popular areas of borrowing.
Totally. So the other ones are secured and this is unsecured. So in that sense, this is an actual asset that's kind of risky and interesting from my vantage point in that it's unsecured lending to normal people. All the rest of the stuff is secured, like homes are obviously very important collateral, cars pretty much. So the rates on those are much, much lower than these. They're nowhere near, the spread there's nowhere near as juicy. I mean, when I teach students, we go through the hierarchy of borrowing. that the vast majority of borrowing is secured. You have to think, it's crazy for a bank to come to somebody with a medium or lower credit score and say, here, have a line of credit of like $5,000, $10,000. And you can default on it. You don't get shot for that. It's part of the law. It's part of the game.
Yeah.
I was reading an article from Life in 1970 where they were talking about how credit cards are becoming a big thing. And oh my God, these credit card companies are just mailing out applications to Americans. It's like giving sugar to diabetics. That was their analogy. Speaking of unsecured versus secured, I am also looking right now at a website that claims to have invented the first credit card that's based on your stock portfolio. So borrowing against your stock portfolio with the card. I gotta say, the card does look pretty nice. It's made of glass. Maybe that tells you something.
Unintentional metaphor.
Yeah, exactly. Okay, so if it's not about risk premiums, if the rate isn't compensating for something like default, could it be compensating for all the points and benefits that customers are accruing?
So it's not just compensation for expected default. I want to separate that from the risk premium. The risk premium is kind of the compensation for unexpected default, which turns out to be pretty big here. But let's go back and talk about the points and stuff. So I find that people are more excited to talk about points than anything. The term rewards was really a marketing flourish. So in total number of dollars, this interchange was, I mean, again, you have to find exact numbers, but for credit cards alone, I think it was over $150 billion. So like the GDP of a medium-sized country gets transferred as interchange. And we find that about 85% of that gets transferred through as rewards. You could wonder, I think it'd be natural to say, what is the point of this? Why charge people 1.8% and then pass through 1.57% as rewards where, well, at least some people, like I guess you and I, Joe, don't pay that much attention. So I think I have enormous amounts of United miles I'm never going to use because I'd have to actually travel to whatever place to use them. So why is that? I mean, I think it's a good economic question and people have tackled this. I do think it creates a very strong network effect. So you aren't not actually seeing a charge for this. It's the retailer that has to eat it. And if you do not use a card that gives rewards, you're not going to get, in most cases, a lower price. So there's a whole series of litigation and fights over the years, amazing, about what retailers can do to discriminate prices based people who using cards and aren't. And I thought a couple years ago, or the last couple of years, I'm seeing more restaurants give you back a percentage or not charge you a percentage if you didn't do that. But it's a little bit beyond my legal expertise to sometimes understand these, because for the longest time, I think you could give people a discount, but you couldn't do a surcharge. There was some like legal discrimination between those things. And as a result, people mostly don't pay attention to that kind of thing. And so you really want to stay inside the network, and it kind of keeps you there. Even if at the end it would be a total pass through, it still helps for them to keep this business.
You know, it's interesting. There's this crypto company. Have you heard of Blackbird?
Yeah.
It's a crypto thing, and they have a bunch of restaurants you sign up, and you like pay in a coin. I don't know exactly how it works, but I think that they have to, on some way, because in theory, it'd be nice, like, maybe we'll get a little bit into stable coins as like a payments rail in the future, or in this conversation. And I think it'd be a nice way to like circumvent this. But even they, I think, implicitly have to reinvent the rewards model to do it. Maybe you get premium seats, or you get reservations, etc. In order to sort of like bootstrap a new network, you end up having to reinvent a lot of the rebates and the benefits, et cetera, that come with the old network. Maybe we'll get into crypto a little bit more. But talk to us a little bit more then about like the persistence of this spread that can't fully be explained by defaults.
Yeah, so the default, like we said, is like a little under 6%.
Yeah.
Then I'll mention it. So defaults do spike in bad times. So we estimate using kind of the cross section of different FICO scores, how much extra compensation you get as you go to lower and lower FICO scores in terms of extra APR net of the defaults. So we estimate that the risk premium there is accounting for about similar size piece. So there's a risk premium about 5% on average, which is much smaller for, let's say you're an 800 FICO borrower. There's not that much risk premium. But if you're a 600 FICO borrower, the risk premium goes up to 9%. So I think it means something very important. I think the person who's borrowing there may not realize that they are paying a very large risk premium. So if you're a low FICO borrower and you aren't going to default, you're not, you're paying a very high risk premium. and that is because other people default in bad times. Even if you do think you're going to default sometimes, I think one should realize how much of a risk premium you're actually paying for this. So, but now let's go back to something else before we maybe talk more about that, is the other pieces of this. So we talked about interchange and rewards. It's not zero. They do earn a little bit from it. Most of the transactors, what they make off transactors is that difference, because transactors spend, recurringly a lot. Borrowers tend to kind of accumulate, and they don't have that much more room to spend because they've borrowed. So that's not a big portion of the revenues there. Then there's fees. That's another couple percent. It's actually making the puzzle worse. And then the part that turned out to be really big that surprised us is operating expenses, of which marketing, you mentioned this, turns out to be really big. And if
this is the thing that I don't get. So there is so much marketing for credit cards. And as I said, they're all kind of similar in many ways. And I remember this was often the blockage for new entrants from the fintech space trying to get into this business. I remember talking to Lending Club about this back when they were a thing.
Yes.
And they were spending so much money on mail advertisements. And I just don't get why that's the primary acquisition channel and why it seems to be so important to the business model.
It's a really interesting question. Maybe the answer would be like, people listening to this will be like, oh, I knew that. Which is the reason you do it because it works, which means, I mean, this goes back to Joe's question. I think you can see, we do this analysis there, that if you spend more on operating expenses, which I think largely means additional marketing, because the actual operational side of this apparently is very expensive, but there's big differences across these guys in operating expenses. And I don't think it's because their systems are much more. And we actually see no relation between that and default. So it's once you control for FICO. So it's not about screening people for better borrowers. But what it is, it's an effective, apparently at the margin, customer acquisition strategy. So think the following thought process. You could say, well, why don't somebody just cut all this marketing out and just charge a lower rate, and that'll get people.
Yeah, that's your acquisition advertising, right?
But
apparently it doesn't work. So people are not rate sensitive, which is a recurring theme I'm starting to learn when we talk about banks and bank deposit rates. People they're not completely insensitive, obviously, but they're not that sensitive to the rates they get paid, and they're not that sensitive to the rates they get charged on this. So there are actually, this is a surprising thing. The CFPB has a spreadsheet. Well, when there were people still working there, they used to have a spreadsheet that they updated with essentially every single card there is and what the rate on it. And all the cheapest cards are credit unions, and they're significantly cheaper, much cheaper than your average credit card. But I'm sure almost nobody except their customers have heard about them, and that's because they don't advertise much. And you say, well, if their rates are so cheap, why don't people go there? It's like they haven't heard about them, and they don't care that much about the rate, is my inference from this. So the more you pay for marketing and operating expenses in the data, the higher is the average amount you're able to charge people.
That's really funny. Does some of this stuff repel the brain of the academic economist? No, for real. This idea that the borrower wouldn't be rate sensitive, the idea that we're actually paying more to be advertised to, et cetera, because this is their cost, the idea that there are lower cost options out there and all we have to do is search for them and they're available.
Well, also for macroeconomists specifically, right? Because we talk about benchmark rates and the importance of how those feed into the economy. And here we are talking about the credit card rate, which is actually potentially more important.
I'm serious, though. Rates are high because to some extent consumers just aren't paying attention to them, et cetera. Do you encounter people who think, no, there must be some variable you're missing because we're rational and we would seek out the lower rate?
I want to talk to people like you're saying. I haven't really had the chance because when you pitch this to a finance audience, not macro people, and I am a finance president, then they're more open. I mean, credit cards is a thing in finance. People like credit cards, but I think the interaction with macro and monetary is really interesting. So it doesn't bother me because I think it's interesting. I mean, I think it's kind of bad that a lot of people who are usually not in the best shape are essentially adding 6% rate to their credit card because they're paying for the advertising that they responded to. But, that's, you could get it. If you didn't respond to the advertising, you responded to the rate, they would do that instead, but they don't. So, think about, you guys often talk about the Fed lowering or hiking rates. At the risk of sounding heretical here, I am not a huge believer that consumers at all are very sensitive to these changes in the policy rate and the Fed funds rate, even though the standard model works through their intertemporal consumption savings decision. I think most of the evidence is very weak that they care about that. And then the credit card, I think, on top of that is really makes this clear, because if you're paying 23% and you are the kind of person that wants to borrow, I mean, obviously, because you've borrowed, how much is a 0.5% going to matter to you if the Fed hikes? Plus, you could have been getting a much cheaper rate anyway, and that didn't compel you to go looking for it. So I think it kind of puts a big question mark over whether that's really the channel, which is a lot of people have said that, but it's still kind of the main way we talk about those things.
Can we talk a little bit more about competition?
Oh, yeah,
and
sure.
Why doesn't someone just come in with a lower rate and disrupt the entire business?
To give you another example, personal lines of credit. These were all new things to me. I find this, I think where you've put retail people with the financial sector, you actually get a lot of explosions. They're like weird stuff. So that's the place where sort of academics should go looking, and many do. But it's not the place where I, kind of having worked at like hedge fund, market maker, ever thought about these things. You don't think about like the fancy people, like the people who are sophisticated, do all the math. But they kind of cancel each other out. Where the real fireworks are is when you get into the retail sector. And if you look at personal lines of credit from the same companies at the same FICO, they're substantially cheaper. Plus, you get all the money up front. There's something it is still very puzzling that there is almost no marketing there. You don't get marketed a lot on personal lines of credit. And the people who discover them do use them to consolidate these debts and pay them off in one shot at a lower interest rate. It's a very logical thing to do that people don't do. But I mean, just to get back to it, I think we see over and over, and you're talking about BNPL and stuff, this idea of how do you acquire customers and what role the rate actually has there is, I just keep seeing it. It's like a movie. I've seen this before. It's more effective at the margin than lowering the rates. And it explains a lot, I think, of how the finance sector interacts with retail, which is not just like canceling out. So that's the issue. It's like, oh, well, they spend 5% of assets on marketing, then they add 5% to the cost. I guess there's no harm in that. Well, not really, because what people have done is paid the 5% in order to get the marketing. So if you really like the commercials, you should be really happy. But
Get the news whenever you want it with Bloomberg News Now.
Spends over $6 billion a year on marketing. And this is not including the lounges and all this, which there's been like articles about how everybody's like investing like millions of dollars in these lounges. That's a separate category. And Capital One spends over $4 billion a year. So I looked it up, and Amex is bigger than Nike and Coke in marketing.
Wow.
And you think of like those as being the ones that are got to be like the gigantic ones. And Capital One's about as big.
Wait, a personal line of credit.
Yeah.
That's just like a classic. What is that product? I've never looked into one of those.
I haven't taken
is that an unsecured loan from a bank?
It's an unsecured loan.
But this is just like classic bank borrowing. I go to the bank, I say, can I borrow some money?
Surprisingly, I mean, you can look it up. Even like it's so easy to look it up. They offer it's a relatively large amount compared to a credit card.
Yeah,
and you put in your FICO. They give you a rate. The rate's almost for sure always lower than the credit card. I don't get it either, but
one could use these to pay off revolving.
That's mostly what people do, which they should. I had a journalist ask me about this, and I was like, this is a great idea. Like, I should look this up and talk about this. I mean, there's no, how do you explain this spread? I mean, I think largely it's got a lot of this, less of this retail focus to it. But yeah, it's the same companies too. If you go to Amex, you can Amex line of credit. Discover offers a Discover line of credit. Capital One line of credit. It's the same thing.
It's so strange.
This whole conversation, it edges into some, frankly, like slightly uncomfortable territory, in my opinion, because because especially when you characterize something as like, you're kind of end up paying a lot for them to advertise to you, and you apparently like the advertisement because you responded to it, etc. Like, you edge into this territory where it's like, these are not, like, it must be not the most sophisticated base, right? It's like, why do Nigerian email scams have all kinds of typos, etc.? And the theory is because they want to select for people who will be foolish enough to respond to them, because if you go down the chain, they don't want you to be too savvy in asking questions. So like, let's just get all the savvy customers out of the way who would instantly recognize a scam email. And then you like get there. It's right. Like,
are you saying they the Nigerian princes don't pay you? Because
I'm just
I
saying,
think I
like,
might be in trouble.
Like, it seems like there's a filtration process going on where you end up with the base of revolvers where all this money is made, who are just clearly not that financially savvy, because otherwise they would be doing the personal line of credit or not doing these things or looking for that credit union credit card.
Well, I'll say something about marketing. I mean, we all do respond. You know, you guys are very not elitist here, very anti-elitist. So marketing is just a huge industry.
Yeah.
As a finance person, I'm like, we do have a marketing department at the business school, and I'm like, wow, there's a reason.
Yeah.
Because you look at, let's say you look at Alphabet and Meta.
Yeah.
Meta's revenues are almost 100% from marketing, and
Yeah,
Google's are like close to 80%. We're talking hundreds of billions of dollars a year. And all the very sophisticated stuff, and at the end, it's to sell you. It's to sell you advertising.
It works. And I've certainly been taken. I get taken in by marketing all the time.
I'll just say one other thing is, I think the reason that because the ROAs here are high, when we decompose this at the end, it sort of does most. If you take the alpha of this, think of this as alpha relative to the average bank asset, we get that it's about 1%. So how do you get down to 1%? So the risk premium here is quite big. We compare it to the risk premium on bonds. You have to compare it to high yield corporate bonds. And it looks similar for all but the lowest FICO bonds versus, let's say, CCC rated bonds, where the lowest FICO seems to have a big chunk, the risk premium over and above the bonds. I'd actually say the bonds look a little low relative to that, because it's the risk premium on credit cards that kind of rises linearly, and it's the bonds that kind of don't. But for the not so bad credits, it's pretty similar risk premium to high yield bond markets. So in that sense, it's big, but it doesn't look crazy. But I should say, Goldman, I think before they got into credit cards, and it did not work out. So apparently it is competitive in that sense. I think they were eyeing this and saying, this is a good business. You see the highest ROEs by far of all the, if you go look through the banks' 10Ks, some of them break this out. I think JP Morgan, for example, and you see like that's got the highest ROE by far. That it's bigger than the, all the other parts of the bank. So I think they were thinking that. And when we got into it, they paid very high operating costs and had higher defaults than other ones. It obviously did not work out because they turned away from it.
Do you see any signs of rates eventually coming down? It sounds like it's probably not going to be through competition or new entrants like fintechs, but could it be something like regulation? I have vague memories of the Credit Card Act doing something on this front, but could it be something like that?
The Credit Card Act, there were tons of papers on it when it came out, mostly limited your ability to increase rates on existing borrowing.
Okay.
And it sort of put caps on all kinds of fees and charges. And then people were looking for whether banks would move that to something else. I think in the long run, the answer is yes. I don't know if they moved that or it's just something else, but I mean, so far rates, if you could just plot it on Fred, even though I think it's like a little bit distorted, it's been going up and up. I mean, before it starts going down, it's got to stop going up. So they're in pretty strong position. But there is this buy now, pay later. There were lending club kind of things, although they largely crashed and burned. And payments in general, I mean, these companies for payments are huge because there is, it's PayPal, all these guys. This is just to take off a little bit off the top of this swipe fee. And then we're going to get to the interest rates on this borrowing. I mean, I think that there is constantly like movement in this space, but it has not been to drive down. I think it's driven up acquisition costs more than just driven down the actual rates.
Unrelated macro question. One of the reasons I like your work is sort of revisiting some of these like basic questions, which I think is useful. And of course, when we talked to you a couple of years ago, it was like, let's revisit some of what we thought we knew about the 70s and see if that inflation story is a little bit different. Just on the big macro question, these days, rates where they are, inflation sort of persistently warm. A lot of people are like, oh, talk about R star must be therefore higher than it otherwise would have been. What do you think we've learned? We had this very fast rate hiking cycle, 2021 through 2023. I would say many economists would have expected the unemployment rate to rise a lot more, given that rate hike cycle. It hasn't. I don't know.
Or
maybe
spending to go down.
Yeah, or spending to go down, et cetera. But I personally am rarely satisfied by the stories that people tell about how, in fact, those rate hikes translated into lower inflation. Have you yourself sort of learned anything interesting in the last, 3 or 4 years, 5 years of this macro experiment that we have post-pandemic?
I think it's a great topic and question. My inference was that the cycle, I'm in the group that thought that this was largely a supply shock issue, that COVID disrupted supply chains tremendously. I mean, we saw that. And I think if you look, like the New York Fed has this index that they put together on supply disruptions.
Yeah.
This predicted the trajectory of inflation with the 3-month lead very well. I think we had a period where we saw that there was increased employment and yet output was going down. So usually when we talk about productivity and things, there's all these compositional issues. Do you fire the least productive people so productivity goes up for mechanical reasons? But when you have more people being employed and yet output's going down, as it did for several quarters, that can't be the reason. So I took away from it, there's harsh arguments about this, that this was largely supply driven, and how it relates to the 70s, the argument there for different reasons was that it was supply driven due to credit crunches and things. So I tend to think that a lot of the business cycle things and the inflations we've seen, like after wars, we're often switching the kind of production that you do, which is a supply thing. I'm very much in the supply camp, and I think the reason that employment held up and spending held up, because I don't think that this was happening through decreasing demand and getting people fired and so forth. I think it was products, components could ship again, and so people could be more productive with the labor they had. So to me, I'm sure some people very, very highly disagree. To me, that looked like a pretty clear story.
So if you're Jerome Powell and you're worried about inflation going up, and I should just mention we are recording this on
October 29th.
Yeah, the day of the Fed decision,
there's going to be
which is widely expected to be a cut, right?
Yes.
But, inflation's still, somewhat warm, as Joe said. If you're worried about it, should you be looking at credit card rates versus, mortgage rates or benchmark rates or things like that? How should policymakers actually think about this problem?
Between those, I think mortgage rates, that people, do seem very much to respond to. It is a much bigger amount. Maybe they're more sophisticated, sensitive. It lasts with you for a long time. I mean, I think that's much more important, the shifts in those spreads for the macroeconomy than, the credit card rates is just not much movement. I mean, they are literally tacked on top of the Fed funds rate, so that's completely mechanical. Didn't used to be the case 30 years ago, but the spread will move 1-for-1 with the Fed funds rate, except when they expand it by issuing new cards and making rates higher. So I think the mortgage market's much more important for macro kind of stuff. I mean, I don't envy, Powell's job. It's a very hard job now. Not sure. Last time I was at the Fed, I was in the elevator when he got in, but I didn't want to bug him, so I didn't say anything to him. But I got to see him in person.
Jerome, our star's fake. Real good. Going back to you talk about fintech, et cetera. I personally I actually think stable coins are going to be a very big deal.
Yeah.
I do not necessarily think they're going to be a big deal for consumer transactions. It's not obvious to me. My guess is that they'll open up new transactions that we aren't thinking of right now, but not for buying coffee or buying, whatever. But from your research, whether into cards, et cetera, how would that inform or other fintech, how would that inform your thinking about the trajectory of the stablecoin industry?
Yeah, stablecoin, it's interesting, and I've heard you mention this kind of view, which I think is not one I'd considered. I was thinking a lot about consumers. I'll say this, I think for me and some of the people I talk to, my co-authors, stablecoin they're like a puzzle in the sense that maybe not all stablecoin, but the ones that have been around are kind of like a money market fund that doesn't pay you interest. That's how I would summarize them, and that's why I think these are some the most profitable companies ever per employee, because they don't do anything.
Yeah.
So if you give them a bunch of $1 billion, they just take the whole interest. There's some advertising there too, but not a tremendous amount compared to that. And people are happy with that. I don't really get it. But, now they've, like you mentioned, they've started to learn the sort of tricks of the trade. They're going to do rewards. It's better than paying people actual interest. You give them rewards. So from the point of view of consumers, it is kind of a mystery. I mean, I would love to start a money market fund and not pay anybody any interest.
Good luck
but
with
economically, when you don't pay any interest on $1 ever, you've taken the whole dollar. That's what the dollar does. It pays you interest. So the net present value of all the interest of $1 is the dollar. So if they never pay you and you stay there forever, then if they have $8 billion, they've captured $8 billion.
Again, nice business if you can get it.
Yeah, it's a great business. It's weird, but it's a great business.
What's your next research project?
So I think from this credit card stuff, there's definitely interesting things to think about, how people default and how much this marketing stuff affects them. From another point of view is one of my co-authors in here, a former student of mine, we have a bunch of work on adjustable rate mortgages and why they kind of disappeared. So they used to be a big thing and they've kind of disappeared. And I think we kind of understand why. So that's, there's been a lot of discussion about that for mortgages. Why is the U.S. in one camp and many other countries in another camp? But the U.S. kind of used to be in the adjustable mortgage rate camp, at least pre-crisis and stuff.
I remember when the rate hike, when we started surging, there was this popular theory that monetary policy would have more teeth in countries like Canada, Australia, the UK, because so many more households would be more sensitive to faster resets. Has that actually been borne out? It sounds great. As like a theory intuitively that makes a lot of sense. I guess Canadian unemployment has trended higher than American, but the inflation trajectories I think have been roughly the same in those other Anglophone countries versus the US where they had, I don't know, like how strong effect was that? Do you know?
I don't know exactly, but I don't get the impression that it was tremendously different. I think it has impacted consumers. One thing I should note though is there's two senses in which monetary policy can have an effect. One is that it makes people have to spend a lot of money on that, so it's expensive for them. But the other one is that here, and I don't think that's the effect we were going for, but people have just, stopped taking out as many mortgages and don't move. It was a negative effect. I'm just not sure it's a anti-inflationary effect. Right. So it's like if you're going to have floating rate stuff, and that's like the case with credit cards, it shouldn't affect the volume of it that much in terms of producing it, but it's it's expensive for them. And then on the fixed rate one, they just stick to the old stuff, and we don't, mortgage credit's really dried up in a way, but it's not affecting the existing borrowers, only to the extent that you don't want to move, which is actually a big deal.
Itamar Drexler, thank you so much for coming back on Odd Lot. It's always a treat. And next time you have a new report out, let's talk arms next time.
Okay, great. Thank you very much for having me.
Tracy, I found that conversation to be fascinating. I have to admit, credit cards are the sort of black box to me in many respects. I don't really understand the business because I don't actually use them for revolving purposes or borrowing against them. I don't think I quite realized how crazy the numbers are. And I certainly knew that there's tons of advertising, including direct mail on credit cards. But the idea that this is so substantial that a big part of what people are paying for here is the advertising, that was all very novel to me.
It's very surprising. My main takeaway is that people, I guess, are not rational, at least when it comes to credit cards, right? The marketing seems to work.
Yeah. No, totally. I'm not rational because I don't take advantage of all the points that I could, and I don't optimize the way I could. And when I buy a plane ticket, only part of the time do I think about, is this the airline?
Well, you could also argue that it's rational to factor in the time you spend on doing
this.
That's
how
right?
I justify all of this money left on the table.
That's right.
By saying I make a rational decision.
My time
not to
is
allocate.
valuable.
Yeah, my time is valuable. But if there are all these other borrowing products out there that are cheaper, et cetera, it does feel like someone must be able to come along and make a product that is let's going to compete on rate, or you're going to be able to borrow cheaper. I don't know. Maybe BNPL will achieve that. I don't know.
I'm going to go take out a personal finance loan right now.
Go for it.
Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Itamar Drexler. He's at iDrex. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Kel Brooks at Kel Brooks. For more Odd Lots content, go to Bloomberg.com/oddlots. We have a daily newsletter and all of our episodes. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we talk about the very profitable business of credit cards, then please leave us a review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber and you enjoy getting benefits and rewards, then please check out the Bloomberg channel on Apple Podcasts. You can listen to all of our episodes absolutely ad-free. Just find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
This is Tom Keene, inviting you to join me for the Bloomberg Surveillance Podcast. It's about making you smarter each and every business day. We bring you a recap of what happened overnight in Europe and Asia, the day's economic data, and complete coverage of the U.S. market open. We cover stocks, bonds, commodities, currencies, even crypto, all the information you need to excel. Bloomberg Surveillance also brings you the analysis behind the headlines. We do that with lengthy conversations with our expert guests, the smartest names in economics, finance, investment, and international relations. We do all this live each and every weekday, then bring you the best analysis in our daily podcast. Search for Bloomberg Surveillance on YouTube, Apple, Spotify, or anywhere else you listen. On the East Coast, listen at lunch, and on the West Coast when you wake up. That's the Bloomberg Surveillance Podcast with me, Tom Keene, along with Paul Sweeney and Lisa Mateo. Subscribe today wherever you get your podcasts.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Lisa Mateo.
Lisa, we begin with exclusive Bloomberg News reporting on what could be one of the biggest media deals in history. Sources tell us Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. The streaming giant is offering a $5 billion breakup fee if regulators don't approve the deal. Manuel Baigorri is a deals reporter for Bloomberg.
It would be definitely the biggest ever deal by Netflix. They've never done a deal of this magnitude. And it will also be very, very consequential for competitors, take Paramount, Walt Disney, and others that are also growing in this field. So surprising also to see a potential $5 billion breakup fee. That is quite remarkable, and perhaps one of the reasons why Netflix seems to be, according to our sources, pulling ahead of the game here.
And Bloomberg's Manuel Baigorri adds the two companies could announce a deal in as soon as the coming days.
Breaking news in geopolitics this morning, Nathan. The U.S. lobbied several countries in the European Union in an effort to block EU plans to use frozen Russian central bank assets to back a massive loan to Ukraine. That's according to European diplomats that are familiar with the matter. We get more from Bloomberg's Stephen Carroll in Brussels.
Yeah, well, this is our reporting telling us that the US officials have been arguing to individual countries in the European Union that the frozen Russian assets shouldn't be used to support Ukraine. This is a key plan that's been under negotiation in the EU for some time now. Earlier this week, we had the proposal from the EU, which was meant to be either using these frozen Russian assets, I mean, they haven't been able to get agreement with among member states, or to use a loan backed by the EU's own resources to try and support Ukraine instead, knowing full well that would be politically very difficult to get agreement on as well. It was meant to exert pressure on Belgium, one of the key holdout countries, for the use of those frozen Russian assets.
Bloomberg's Stephen Carroll notes that the discussions come at a critical time for Ukraine, with the U.S. pressuring Kyiv to agree to a potentially lopsided peace deal with Russia.
Lisa, this comes as India's Prime Minister Narendra Modi and Russian President Vladimir Putin hold a bilateral meeting in New Delhi. The two leaders are looking to deepen their economic cooperation in the face of pressure from President Trump. Putin's making his first trip to India since Russia's full-scale invasion of Ukraine to showcase the long-standing partnership dating back to the Cold War. Ties with India have centered on defense, but Modi and Putin want to broaden cooperation to include deeper trade, migration, and economic links.
Turning to Washington now, Nathan. President Trump standing by Defense Secretary Pete Hegseth after a string of recent controversies. Among them, a second strike on a suspected drug-running boat in the Caribbean that killed survivors of the initial attack. The admiral who gave the order, Frank Bradley, was on Capitol Hill yesterday telling lawmakers he was not ordered to kill everyone on board. Republican Senate Intelligence Chairman Tom Cotton spoke after the classified briefing.
I saw two survivors trying to flip a boat loaded with drugs bound for the United States back over so they could stay in the fight.
But Adam Smith, the top Democrat on the House Armed Services Committee, says he's not convinced those survivors still pose a threat.
Two people without their shirts on top of the bow of a capsized boat. There's a tiny little portion of the boat that was above the water. And they were there, just there.
Along with the strike order, a Pentagon Inspector General's report found Defense Secretary Hegseth could have compromised sensitive information by using his personal cell phone in a signal chat about Yemen attack plans.
Well, elsewhere in the nation's capital, Lisa, a divided Supreme Court has cleared Texas to use a new Republican-drawn congressional map in next year's election. Over 3 dissents, the justices lifted a lower court ruling that blocked the map. It was drawn at President Trump's behest to help Republicans try to keep their House majority in the next year. Although the order formally applies only until the justices resolve Texas's appeal, the court suggests it will ultimately rule in the state's favor.
A Virginia man has been charged with placing pipe bombs outside Republican and Democratic National Committee headquarters in Washington on the eve of January 6, 2021 riot. That's capping a 5-year federal investigation. Attorney General Pam Bondi announced the charges in a news conference.
He has been charged with violating 18 U.S.C. 844, which is use of an explosive device. This investigation is ongoing. As we speak, search warrants are being executed, and there could be more charges to come.
Attorney General Pam Bondi identified the suspect as Brian Cole Jr. of Woodbridge, Virginia. Cole was arrested earlier yesterday by the FBI.
Turning to the economy and the Fed now, Lisa, National Economic Council Director Kevin Hassett says the Federal Reserve should cut interest rates at its meeting next week. Hassett was asked on Fox News if he thinks the Federal Open Market Committee will cut rates.
If you look at the communications from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right
And how
move.
much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
Yeah, that was White House economic advisor Kevin Hassett speaking on Fox News.
Well, someone else who would also like to see a rate cut by the Fed, Nathan, that's Bank of America CEO Brian Moynihan. He spoke last hour with Bloomberg's Francine Lacroix.
Would a Fed cut help?
A Fed cut helps, and our team believes the Fed will cut next week.
Yeah.
They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
And sticky.
It's sticky, although right when they started raising rates, people told me it takes 5 years to actually squeeze out inflation, and people just aren't patient.
Well, Bank of America CEO Brian Moynihan added that his team thinks long-term the Fed will get down to a 3% Fed funds rate.
Time now for our Bloomberg Sports Update, and for that, we bring in John Stashower.
A big game in the NFC. The Cowboys and Lions hoping to make the playoffs. Detroit never trailed. In a game that had 7 touchdowns and 8 field goals, the Lions won 44-30. They were up by 18 in the second half. Dallas cut that lead to 3, but Jahmyr Gibbs with 2 fourth-quarter touchdowns. He had 3 in the game. The Lakers with a 3-point win in Toronto. LeBron James scored only 8 points. It was the first time since 2007 that he was held to single figures as a streak lasting almost 1,300 games. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager.
I'm Lisa Mateo, and this is Bloomberg.
कहीं सीलन की बूंदें आपके घर में भी संगीत बनके ना गूंजे, इसीलिए घर बनाएं ACC Gold Water Shield सीमेंट के साथ।
In our new podcast, Everybody's Business, we talk about the business news that concerns everybody.
From Bloomberg Business Week, I'm Stacey Vanek Smith.
And I'm Max Chafkin.
Each week, we unpack what is happening on Main Street and Wall Street.
Hi, I'm Kim Vanell in New York. It's Friday, everything you need to know from the front lines in 10 minutes, 7 days a week. The US military says it's killed 4 men in a fresh strike on a suspected drug boat. A statement on X saying, intelligence confirmed that the vessel was carrying illicit narcotics and transiting along a known narco-trafficking route in the Eastern Pacific. This latest attack comes as lawmakers are split after a classified briefing from Admiral Frank Bradley about another US strike on a suspected drug boat in the Caribbean that killed 11 people in September. Democrats on the Intelligence and Armed Services Committee say they're horrified by footage showing 2 survivors of an initial strike then being killed in a second strike by the US, a violation of war rules, while Republicans are defending the strike, saying the video shows the survivors could have potentially handed drugs over to other boats in the area. Pentagon reporter Idris Ali says the scrutiny over the strike's legality comes at a delicate time for Defense Secretary Pete Hegseth.
This comes at a time when the Pentagon's Inspector General just released a report on the use of the Signal messaging app by him a few months ago. And so it's a key moment for Pete Hegseth, and people are watching closely whether President Trump, who is his boss, still has confidence in him. For his part, Trump has said he backs Hegseth, but it's really an interesting time because during the initial phases of the controversy around the Caribbean strike, even Republican lawmakers questioning what happened and what legal authorities went into the strike. And so I think the context these military officials provided with the strike that took place on September 2nd have really helped allay some of the concerns for Republican lawmakers. We're not seeing some of those heavy hitters questioning Hegseth in the same way, of course. The broader context is still important, right? The United States has carried out about 20 strikes, killed more than 80 people. And President Trump himself has said, land strikes in Venezuela are next. So we've zeroed in on the September 2nd strike, but there have been questions about the legality of all the strikes that have taken place.
The U.S. Supreme Court has revived a redrawn congressional map in Texas, giving Republicans a major boost ahead of the 2026 midterms. The justices have lifted a lower court's block on the Trump-backed map, which could flip up to 5 Democratic seats. That lower court had ruled the map likely violated constitutional protections against racial discrimination. Republicans hold narrow majorities in Congress, so this decision matters. It strengthens Trump's push to keep control and underscores a nationwide fight over gerrymandering and voting rights. The FBI has arrested a suspect in one of the most notorious unsolved cases from January 6th, the person accused of planting pipe bombs outside the Democratic and Republican Party headquarters the night before the Capitol attack. The arrest of 30-year-old Brian Cole Jr. comes nearly 4 years after a massive manhunt that included a $500,000 reward and hundreds of tips. It also comes just months after the president pardoned nearly everyone charged in the Capitol riot itself. And to find out what's happening in the markets today, we've got Morning Bid's Peter Devlin. Peter, what do we need to know?
Morning, Kim. Today on Morning Bid, we talked about Netflix and Warner Brothers. The bidding war could be coming to close, and Netflix is eking ahead, according to sources. As well, we look to the PCE numbers for the Fed could be critical in terms of a Christmas cuts. And finally, Zuckerberg could be scrapping the metaverse in terms of funding. Not great news for those looking for AI wearables. Please listen to more on Morning Bids.
Thanks, Peter. You can ask your smart speaker for Reuters Morning Bid, listen to it on your favourite podcast player, or watch it on Spotify. Anna Frioli reacting to the news that the Vatican has overwhelmingly voted against women serving as deacons, saying even our Lord had women who followed him, so we are not inferior to men, adding she wishes the Catholic Church would do more for inclusion in the 21st century. Discussions about women deacons in the 1.4 billion member church have been ongoing for the last decade. Deacons are ordained and can help with church services but cannot celebrate Mass, and the Commission has recommended further study of the issue. A warning that ICE vans have been spotted near Carmel Mall, also known as Somali Mall, in Minneapolis. Minnesota is home to more than 70,000 Somali Americans, and now many of them are staying inside, fearing they could be detained by ICE agents after President Trump called Somali immigrants garbage at a White House cabinet meeting on Tuesday.
The Somalians should be out of here. They've destroyed our country.
City Councilman Jamal Osman says that ICE are going door to door and stopping people in the streets.
They're not just targeting undocumented, they're targeting every Somali person. It feels like we are in, I don't know how to explain it, a war zone.
Inside the Carmel Mall, the emptiness is haunting. Shop owner Mohammed Amin Sharif says the Somali community is fearful.
You could see around the mall a lot of vacant stores, a lot of closed stores, and no foot traffic. People are hiding in their homes.
Baja Ali owns a cafe in the mall that just last week was buzzing.
They don't want to come out, and a lot of businesses are closed.
Now, Donald Trump is no stranger to putting his name on buildings. The latest to get a Trump rebrand is the United States Institute of Peace in Washington. USIP is a government-founded nonprofit that the Trump administration tried to seize control of earlier this year. On Thursday, the State Department said on X it had renamed it to the Donald J. Trump Institute of Peace to, quote, reflect the greatest deal-maker in our nation's history.
And thank you for putting a certain name on that building. I said, boy, that is beautiful. That blew up last night.
The rebranding came ahead of the signing of the Congo-Rwanda peace deal, which Trump held at the Institute. Here's White House reporter Trevor Honeycutt.
So we're seeing ongoing clashes right now between M23, that's a rebel group that's operating in eastern Congo, and the Congolese army. And that fighting continued the same day that we saw this peace deal signed in Washington. So there's clearly a disconnect between what's happening diplomatically and what's happening on the ground.
The Eurovision Song Contest has cleared Israel to enter the 2026 competition, prompting Ireland, Spain, the Netherlands and Slovenia to withdraw, citing the death count in Gaza and accusing Israel of flouting rules meant to guard the contest's neutrality. Israel accuses its critics of mounting a global smear campaign against it. Olivia Lepoidevin in Geneva says it's unprecedented for the European Broadcasting Union.
It has not faced an issue of this scale before in terms of the number of countries asking for another country, in this case Israel, to be excluded from the competition, of which is said to be non-political. It should be a competition which unites the world through cheesy pop music. And this would run quite contrary to that.
And for today's recommended read, Assad's exiled spy chief and his billionaire cousin are spending millions plotting Syrian revolts from their exile in Russia. And Syria's government has deployed another ex-Assad insider, a childhood friend of the new president, to neutralize them. There's a link to that story in the podcast notes. Plus, a recommended listen. This weekend, Christopher Walljasper takes us on assignment to Kenya, where the real-world impact of the Trump administration's cuts to US aid are hitting hard. That pod drops on.
Right, so let's kick off taking a look at the dollar that was really doing reasonably well for the past few weeks, but has hit a stumbling block.
Yeah,
what's going on there?
We've had several days of downshift. Most obviously, we're awaiting a Fed cut later this month, actually next week, virtually fully priced in. But we're getting two things happening at the same time. Some of the high-frequency US data, we are getting some US data at long last, is showing that the weakness in the labor market is persistent. Yesterday, we had a drop in private sector payrolls for November, which was quite alarming because it was unexpected. And it showed also that there was quite considerable job shedding going on among small businesses in the US, which spoke to a greater problem in the broader labor market. We get an update on weekly jobless later today, but it's all building that picture because the Fed has been obsessing about the labor market and how weak it is. So that's the first thing hitting the dollar. The second thing, of course, is that the new Fed chair is almost been announced, and we've talked about this for many days now. There is a fear in the backdrop that a more political appointee, likely to be Kevin Hassett, at least if you believe the bookmakers, then that will lead to even further rate cuts next year. So dollars feeding off of all this, notably against Chinese yuan, as well as the euro, sterling, and the Swiss franc.
Absolutely, yeah. And I think there's some truth in the US sneezes and the rest of the world catches a cold. And it feels like the market's at that tipping point, doesn't it? Where bad news is good news in that it means Fed rate cuts, it means more stimulus and so on. But at some point, that tipping point passes and bad news becomes bad news. I'm wondering if perhaps we are at that point, people thinking perhaps more about not just next week's rate cut or even next year's rate cuts, but what this is all going to mean for things like, for example, government finances, for economic growth and so on. A lot of focus on long-dated treasuries and, by extension, long-dated bonds, which is one of the things that we're looking at today, right?
Yeah, well, that's kind of an interesting segue. I think Japan, this would normally be a fairly routine event in most years that a government sells an auction of long-dated debt, but it's been the focus all year, particularly in Japan. There's a fiscal stimulus going on there. There's a concern that the new prime minister may lean on the Bank of Japan to not raise interest rates, but we have to wait for December 18 for that final decision. So the idea that Japan suddenly has drawn such a comfortable amount of investors for its new sale of 30-year debt may seem slightly in the plumbing, but it does matter because there has been a huge concern about demand for long-dated government debt due to the rising debt piles everywhere. And Japan is further down that pike than most governments. So what happens there does have an implication, I think, for government bonds everywhere. And there is also the very big issue about Japanese money that's invested overseas. If there's some indication that that money is coming home, then it does matter more broadly for world markets.
So on to Microsoft, another thing that we're looking at today, and that sort of flip-flopping in the stock yesterday. There's this report out that there's the company cutting its software sales targets. Microsoft, of course, came out and denied it, but the stock ended the day down 2.5%. Is no doubt in focus in this morning's pre-market. This kind of speaks a lot to the, for all the attraction of the Magnificent Seven, for all that they're carrying a lot of the S&P 500 right now. There's fragility there, right?
Yeah, there's a lot of fragility, I think, because those huge mega cap stocks are so richly valued. And we are coming to also a year-end period where I think maybe many people looking to rotate and think of what their plans for 2026 might be. And it was notable yesterday that even though Microsoft stumbled on what seemed like, again, a relatively small detail, that the small caps in Wall Street, the Russell 2000 index, had one of their best days in months.
I think this is what you get in a market that's priced for perfection. For today's recommended read, check out Mike's column on whether the AI boom can knock the US economy from a 150-year trend. The link is in the show notes. For more on any of today's stories, head to Reuters.com or the Reuters app. Follow us on your favorite podcast player, and if you're on
There are not too many people who love Microsoft Excel. If you try to imagine like the most depressing version of a modern workplace, so kind of gray carpets, high-walled cubicles.
It's taking an act of Congress to make them do it, but it always felt... I want to say on the record here that the subject line of the calendar invite for this recording session is FOIA: Epstein/Santa. It makes me wonder, like, wouldn't that just be the ultimate kick in the face of 2025 that Santa Claus is on the Epstein list?
Well, for the record, we're not talking about Santa right this second. That's a different episode. I want to talk about how the FBI turned over dozens of emails to me that revealed details about how hundreds of the Bureau's special agents and personnel from the Freedom of Information Act office reviewed and processed the Epstein files earlier this year. Plus, the best chance for getting the Epstein files released. Let's go! I'm investigative journalist Jason Leopold. I spend most of my days getting documents from the government.
I'm attorney Matt Topic, and I fight them in court to open their files when they don't want to.
From Bloomberg and No Smiling, this is Disclosure, a podcast about prying loose government secrets, the Freedom of Information Act, and the unexpected places that takes us. Now, before we get into the documents I recently pried loose and the rest of it, let's just recap what happened in Epstein land these last few weeks. So, Matt, Congress has now passed a bill which is called the Epstein Files Transparency Act that compels the Department of Justice to release their files on Jeffrey Epstein within 30 days. And President Trump has already signed that into law.
Yeah, I thought that the speculation about would Trump sign it or not, what's kind of funny is like he has the power himself to order the DOJ to release this. He doesn't need Congress in order to do that. It seems like it's taking an act of Congress to make them do it, but it always felt a little weird to me, like he's signing a bill that's saying do what you ought to be doing.
Yeah, he could have released this at any time by just calling for the Justice Department to release it, which is exactly what he's done on other high-profile political matters earlier this year.
Donald Trump has just said that he is going to release the files around the death of President JFK tomorrow.
The Trump administration has gone public with more than 230,000 pages of records related to Dr. Martin Luther King Jr.'s assassination.
But what's interesting about this Epstein Transparency Act is what it allows the Justice Department to do. And it allows them to withhold certain information, particularly information within these files that could interfere with an ongoing law enforcement investigation, which in FOIA land, Matt, we like to refer to as the B7A.
Well, B7A. But the investigations that would be the predicate for that are what? Like the president had requested that Attorney General Pam Bondi open some investigations into Bill Clinton and some other Democrats or democratically inclined people that I believe the Truth Social post or whatever it was he posted it in, like specifically referred to Democrats. So just openly saying, I want you to investigate some Democrats about this. And not surprisingly, they're going to do that, it seems.
But that directive by Trump came 1 week prior to the passage of this bill. And what we don't know is, what does an investigation like that look like? What are they going to investigate? So Trump delivering this directive via Truth Social to Pam Bondi. So that means that, whatever Epstein files they may have that relate to these folks could arguably be withheld.
Yeah, I mean, I think that if they pull that, there's a lot of angry people already about all this. If they now pull the rug out again and say, hardly release anything because of these ongoing investigations, I don't know what's going to happen. I think there's going to be a lot of people that are going to be very upset about that.
So, Matt, this kind of gets at a fundamental question when we talk about the release of the Epstein files. When we say Epstein files, what are we actually talking about? This is a guy who was investigated by federal authorities starting around the mid-2000s. He signed a controversial plea deal and did some light prison time. And then he was arrested again in 2019 and accused of sex trafficking minors. And the idea is that those investigations threw up a lot of paperwork, presumably about interviews with victims, evidence, names of associates, and co-conspirators. So now, with the Epstein Files Transparency Act, there's going to be a lot of discussion of what gets released and what may get withheld. So the point of this, Matt, is that over the past year, I've been doing some document requests and following some other FOIA actions related to Epstein. And it all helps us get a handle on what's in the Epstein files and how the government has been handling them. And as you know, Matt, this has been building since Trump took office again in January. A lot of Trump's supporters want this information out in the public, and Trump seemed to say during the campaign that he'd do that. But by the summer, that was looking less likely. So in July, the Justice Department and FBI released a joint statement that said, "It is the determination of the Department of Justice and the Federal Bureau of Investigation that no further disclosure would be appropriate or warranted."
Cue the outrage.
Yeah.
Right? I mean, there are a lot of people for whom this is the most important issue in American politics right now.
Well,
and you're just telling them, we changed our mind. There's nothing to see here. Move on.
Yeah. And this is the biggest political story of the year. So earlier this year, I filed a wide-ranging FOIA request for everything related to the processing of the Epstein files. I was really interested in how the records were processed, and I was even more interested within the context of how everything went down with the rollout of the Epstein files earlier this year. What I was hoping was to get a look at what was going on behind closed doors with the Epstein records, going back to the beginning of the new administration. And remember, Matt, just a few weeks after Trump was inaugurated, back in February, his brand new Attorney General, Pam Bondi, calls a group of right-wing influencers to the White House for an event because she has something to give them.
They walked out of the White House holding binders
and hands them binders.
Look at what we got today.
That say Epstein Files, Phase 1.
See that right there? That's the Epstein Files.
Bondi has this kind of grand rollout. And so shortly thereafter, I mean, I want to say more, like almost immediately thereafter, the MAGA crowd goes nuts.
We frankly assumed this had at least some smoking guns. And now
it's a backlash.
That's not what's in this binder at all.
It's a backlash against Bondi. It's a backlash against the FBI.
It is the biggest disappointment I think that you'll find.
Because it turns out that these documents that were in the binder had been previously released in court cases and previously released by the FBI. So it ignited a firestorm.
This is kind of their own folks, right? They invite all these people that are kind of from the MAGA world, and do they think they're so stupid that they're not going to realize that these documents have already been out there? I mean, of course, folks are going to pick over every document, and like, was this just incompetence, or were they trying to pull a fast one? Or
well, I don't think they actually pulled a fast one. I just don't think they actually even looked at any of the files they were going to release. And so what happened after that is Bondi, who had been really embarrassed by this, fires off a letter.
In a letter to FBI Director Kash Patel, the AG demanding the release of the Bureau's full and complete Epstein files.
So she's throwing Kash Patel kind of under the bus here. Like, hey, what are you guys doing? This stuff has already been released.
Exactly. And she kind of blamed him for this. She says, I repeatedly questioned whether this was the full set of documents responsive to my request. And as she later explains on Fox News,
you're looking at these documents going, these aren't all the Epstein files.
Bondi's letter to Patel goes on to say that she knows there are more Epstein documents. She writes she has a source in the FBI field office in New York who told her so.
And so a source said, whoa, all this evidence is sitting in the Southern District of New York. Shock.
So she then tells Kash Patel that he has until February 28th to have the FBI deliver the full and complete Epstein files to her office.
And we got hopefully all of them Friday at 8 a.m., thousands of pages of documents.
And she goes on to say that she wants a full investigation as to why her order to the FBI originally wasn't followed.
Kash is going to get me and himself really a detailed report as to why all these documents and evidence had been withheld. And, we're going to go through it as fast as we can.
So, Matt, as you know, I actually asked for that detailed report, but they withheld it under a FOIA exemption. But as I reported earlier this year for Bloomberg, after all this happens, Kash Patel directs FBI agents from the New York field office, the Washington, D.C. field office, and personnel from the Records Information Dissemination Section, or RIDS. Those are the folks that process FOIA requests, and they were all holed up in a facility in Virginia, which is called the Central Records Complex. So what do I mean by processing? Well, when reviewing documents for eventual release, FOIA officers have to determine what can be released and what needs to be withheld using 9 exemptions under the FOIA. For example, they would withhold information based on someone's personal privacy or an ongoing investigation. And they begin processing these Epstein files, right? They're pulling all-nighters. They're, working 20-hour shifts just to process the Epstein files. So I was really interested in what was taking place behind the scenes. How these requests were processed, how much money they spent on FBI personnel.
So this is like a meta request, right? Like you're trying to get, it's a FOIA about a FOIA.
Yes.
So most agencies, as they're processing requests, they have some kind of a database that they keep track of all the steps. Received request, forwarded to analyst, analyst ran search, 42,000 search results, narrowed with search terms, sent extension letter to requester. Like all those little details from a lot of agencies get tracked in some kind of a centralized database, and we usually refer to those as processing notes.
And that's informative because you sort of learn how these requests are processed and maybe even, learn about a record-keeping system. So I find that to be good information to get insight into how the agency is handling a FOIA request.
It kind of reminds me of like the updates or texts I get from United Airlines about what's going on with my checked bag. Like it'll say like, it's
Right.
like,
Exactly.
gone through screening. He's been loaded onto the plane. It's like, it's on the cart, you know?
Yeah.
But way more detailed than that.
So I filed multiple FOIA requests over the summer, and then Bloomberg sued to compel the release of these records. And recently, the FBI released about 60 pages of emails and other documents I asked for related to the processing of the Epstein files.
So what do you got?
We have a bunch of emails, and they're kind of heavily redacted, but there is still a lot of info in here. And there's some real interesting takeaways here.
So let's go through the timeline here. So where does the story of the emails begin?
It begins in March, early March 2025, this year. There's an email here from the assistant director of the Information Management Division. It's dated March 10th. And it says that we are prepared to receive boxes tomorrow as New York agents are traveling to the Washington field office in the morning and will arrive to Winchester, that's the location of the Central Records Complex, where they will start photographing and we will start scanning and processing the physical files. Why do you think that they were photographing the files?
Well, that's interesting because like regular paper documents, you would think they would just scan them. You wouldn't need to photograph them. It suggests that potentially there's some things that aren't like documents. Like there could be physical evidence, right? There could be it could be anything. It could be a beer bottle. It could be a hairbrush, whatever.
Yeah.
They might be taking photos of those physical items that you can't scan, but we're just kind of guessing at that, at least for now.
Yeah, the email goes on to say, once I see the volume, I'll have a better estimate of processing times, although I suggest we do a rolling delivery to further demonstrate the FBI's commitment to delivery and transparency.
Yeah, interesting.
I mean, I think that's just funny because the FBI wants to demonstrate to the DOJ its commitment to transparency. It also says, by the way, in this email, and again, this is very early, is March 10th. So it says that, in a meeting with the criminal division in New York and Washington field offices, there were questions on the types of redactions the FBI should apply to these files. And then there's like just a really long redaction box.
So do we know anything from these emails about like what kinds of records the FBI was reviewing?
Oh, yeah. Yeah. I mean, we do. And it's kind of fascinating. So on one page, they're discussing FBI search warrant execution photos, FBI interview videos, Ghislaine Maxwell's prison security footage, time-lapsed video footage from an office. And in parentheses, it says no persons identified and no crimes observed. Street surveillance footage, aerial footage from FBI search warrant execution, police interview videos.
And you're just salivating, seeing, you're like, oh man, I got to get this stuff.
And marketing videos.
Marketing videos?
Marketing videos. I mean, this is what's
who
identified
what?
here.
Do we know?
I don't know.
Marketing videos.
It's
is
odd.
Is that Mr. Epstein's like, come visit my island kind of marketing videos?
I don't know. I mean, I'm trying to figure out what marketing videos.
Yeah.
Oh, actually, the other thing that's here is they're discussing the prison video of Epstein before he was found dead and after he was found dead. And they discuss this video and 8 terabytes of data related to Epstein. So that is something that they were looking at as well.
So do these documents tell us anything about sort of the interactions between FBI and DOJ? Because this is a little bit of a tense, this is after the binders that really weren't anything new, right? So you got a little bit of an awkward relationship between the FBI and the DOJ. Are they communicating with each other at all here?
Great question. I mean, in these records, it does not appear that they're communicating. And in fact, there's one email that asked the question of, did you happen to send the results of the below review to DOJ at any point? And the response is, we definitely did not provide anything to DOJ, just to HQ headquarters. So it doesn't appear, and this just may be the fact that it's early, at least in these documents that the FBI released, that there's no communication with DOJ. But I also want to note that the FBI did withhold 160 pages in its entirety.
Okay, so not a ton about the DOJ-FBI relationship. So did we learn anything about, like, did they do this in phases? Like, how did they structure the processing? Yeah, I see reference to like phase 1 and phase 2.
Yeah, and so another document here, again, this is all in March. And I think what's noteworthy is the bulk of the work was taking place in March. Almost 1,000 FBI agents and personnel working during the month of March, just plowing through these records. There's an email on Sunday, March 23rd, 2025, 6:43 p.m. So you can already see that they're working on the weekends, right? Stand by. We have identified more files requiring phase 1 review. Please continue to refresh as files will be populated momentarily.
So do we know anything about what those phases mean?
No, unfortunately, the documents don't describe what those phases refer to, what it actually means.
And it looks like, so then upon completion of phase 2, the FBI is going to provide what they call see-through redaction files for DOJ review, which to me reads like FBI is doing the work of identifying what to redact, but they're giving it to DOJ so DOJ can see what the plan is. Is that how you read that?
That's exactly how I read that.
So, Jason, in March, they're doing all this processing. So what's the next kind of big thing that happens?
Well, the next big thing, at least according to these emails, is April 15th, tax day. An email goes out to FBI personnel that says, Kash Patel, quote, asked for status of all remaining Epstein-related reviews.
Makes sense.
Yeah, it makes sense, but there's no response to that email. But Patel is weighing in, right? The director of the FBI wants an update. Where are we at, with the Epstein files?
So when do they finish the review?
So it appears around May 2nd is when they kind of wrap things up. An FBI employee from the New York field office sends an email and attached a document titled Epstein Overview Final that summarized their work.
Well, what does it say?
Unfortunately, the FBI withheld the attachment.
No.
So they withheld those attachments, citing a number of different FOIA exemptions, such as attorney-client privilege, the deliberative process, and others.
So they're taunting you. They're taunting you by telling you what's there, but that you can't have it.
Can I tell you that as I'm reading these files and the subject lines refer to a PowerPoint or a document, I'm like clicking. I'm clicking to see if there's any chance that it will magically open up.
Any luck?
It did not.
Bummer.
But importantly to me, this is the biggest standout on these records. So I asked how much money they spent on overtime, for example, for agents who are tasked with processing these records. So go to page 14 of the release.
Okay, so I'm looking at it's a chart, and then the division name column says Business Strategy and Analytics section, Counterintelligence Division, Counterterrorism Division, Criminal Investigative Division, Cyber Division, Directorate of Intelligence, EAD Information and Technology Branch, Finance and Facilities Division, Human Resources Division, and then everything else is withheld for secret investigative techniques that, if released, would harm some future investigations.
So these are all the divisions that were involved in the review of the Epstein files. And how do we know that? Because the government released an index of what I requested, and the FBI document types is how they refer to it. And this is a resource planning office, that's an office within the FBI, report that documents the premium pay hours. And premium pay is overtime, nighttime differential hours, but more or less you could think of it as overtime. And it's the number of hours they recorded on this project, right? That's how they refer to it, the Epstein files. They refer to it as a special redaction project. And it's during the period of March 17th through March 22nd. So five or 6 days, right?
So they're withholding from you the total amount of pay across each of those.
Right.
But they are giving you the grand total of employees worked, premium pay hours total, and premium expenses. So they don't want to give you the breakdown, I guess, on the theory that somehow you could interfere with an investigation if they knew the specifics of how they staffed this up. But you at least know the totals.
Yeah, and those totals are kind of stunning. There were 934 employees that were involved in the processing and review of the Epstein files. 14,278 premium pay hours worked for a total of $851,344 that the FBI spent on premium pay during the March 17th and March 22nd review of these files. I mean, that's a lot of money. That seems like a ton of money to me for the FBI to spend on this. I mean, it wasn't a national emergency.
Well, it depends who you ask.
Yeah, true.
I mean, I think there's a sizable number of people, and I think they probably are skewing towards Trump supporters for whom, like, this is like
right.
So I'm looking at these numbers. I'm seeing 850,000, and that's just the overtime. So, it's possible that the overtime might only be like maybe half of the total cost. So you could easily be looking at like a couple $1 million total that people are just working, which means they're not in the field investigating crimes. They're not in the office processing Jason's other FOIA requests. Like, it's sort of, they drop everything. This is what they're doing. And all this work gets done. And then Pam Bondi says there's nothing to see here. So nothing more is going to get released.
Right.
So it sounds like by May 2nd, they've pretty much wrapped up. And then in May, DOJ tells Trump that his name appears in the documents.
Yeah, that's the timing of it. And shortly thereafter, we have this unsigned memo saying that they collected 300 gigabytes of data, which is video, photographs, actual documents, and none of that, not a single document from that trove, can be released.
All right, well, the clock is ticking on the 30-day Epstein Transparency Act deadline. So I guess that work wasn't a waste, because it's going to probably come in pretty handy pretty quickly. It's a good thing that they already did all this back in the summer. Hopefully we're going to start seeing some more stuff.
I want to segue into waiver before we turn anything over. Right?
And he's still alive then in 2017.
He's still alive. So they're going down the road of privacy waiver and a privacy exemption. They sue, right? And so you know how it is. I mean, we both know how it is. If this is dragging out for a while.
But this is really long.
It's really long. The next thing you know, what happens is, I'm fast forwarding here, but Epstein gets arrested. And so now everything is being withheld under B7A, an ongoing law enforcement proceeding. So they're not getting anything. They're still arguing, going back and forth. So these folks just continuously hit roadblocks and roadblocks and roadblocks, and they're just unable to pry anything loose, but they're fighting. They're continuing to fight, right? I respect that.
It's nice to hear you not be mad at other people making FOIA requests and filing lawsuits.
Yeah. I mean, I like when other people file FOIA requests and lawsuits, as long as it's not for the same records I want.
Fair.
So I go into the docket of this FOIA lawsuit that Radar filed, trying to make these Epstein documents public. And on the docket is what's called a Vaughn index. This specific document is very important as far as the Epstein files are concerned. But before we get into that, Matt, can you explain what a Vaughn index is and the old FOIA lawsuit that gave rise to it?
Yes, Jason. It comes from a case called Vaughn versus Rosen in, I think, kind of like the 1970s. And what used to happen is agencies would withhold a bunch of stuff, and then they would just dump all the documents on the court in the lawsuit and be like, here you go, court, you tell us. Like, it's called in-camera review, like where the court in chambers, not in public, reviews these documents. So agencies were just kind of like dumping all this stuff. And eventually the courts are like, yeah, we're not cool with that. You've got to make an index of what all these documents are, describe them, at least in some level of generality, and identify the specific exemptions that you're claiming for each one of those. So that has become known as a Vaughan index. So it's what it sounds like. It's a listing of all the documents. And sometimes the Vaughan index can have a whole lot of interesting information, even if you can't get the documents.
Right. And we've received many Vaughan indices in our FOIA lawsuits.
Yeah, routinely.
Yeah, and they're extremely valuable just to even have a general overview of what the documents are that they're withholding. So
who's talking to who and when they're talking. Like, even if you don't know what they're saying, it can be really interesting. Like, oh, this person was involved. Or, that timing is really interesting as to when things were happening. And you can usually get those kinds of details.
Yeah, and I feel like they're newsworthy and you can write a story out of it.
You have written stories out of it.
Oh, yeah. I thought this one was really important, and it doesn't seem like anyone, even knew it was out there. It had some pretty damn good detail of what the documents are that the FBI had as it relates to Jeffrey Epstein. And obviously it's a sliver, but what would be in the Epstein files that are now supposed to be released. And the index says that the FBI processed but withheld information it obtained from confidential sources, letters addressed to then U.S. Attorney for the Southern District of Florida, Alex Acosta. He was the one that ultimately authorized that non-prosecution agreement with Jeffrey Epstein. Subpoenas to MySpace. Remember MySpace?
Oh, yeah.
That's specifically in this Vaughan index. The handwritten notes of FBI agents, photographs, grand jury subpoenas.
This is all listed out in the Vaughan index.
Yeah, and bank records, communications with foreign government agencies. I thought that was really, really interesting. Of course, there are 302s. Tell everyone what FBI 302 is.
FBI 302 is a summary of a FBI interview with someone.
So in this Vaughan index, so I counted, right? Because it describes the 302s here. And mind you, this index relates to the investigation that the Justice Department and FBI.
नीलंजन रॉय जी, अगर नेचुरल गैस 4 आवर का रेजिस्टेंस तगड़ा है तो कहाँ तक टारगेट मिल सकता है? देखो, तगड़ा तो है, बट ये रेजिस्टेंस ऐसा नहीं है अभी पहली बार आ रहा है यहाँ पर प्राइस। कई दिनों से रुका हुआ है प्राइस इस लेवल पे। एक बार पहले टेस्ट कर चुका है, उसके बाद से देखोगे तो कंटिन्यूअसली इस एरिया पे रुके जा रहा है। नॉर्मली तो इसको यहीं से गिर जाना चाहिए था, चलो फिर भी थोड़ा बहुत 50% तक जाना था। ये नीचे जा रहा है, बट नीचे से भी सपोर्ट बने हुए हैं प्राइस में, इसलिए थोड़ा गिर नहीं रहा। गिर रहा है तो फिर नीचे आ नहीं रहा है, तो थोड़ा संभल के करना इस लेवल को, क्योंकि ये मल्टीपल टाइम हो गया टेस्ट अब। इवन दो 4 आवर का रेजिस्टेंस है जरूर, बट इसका ये नहीं कि ब्रेक नहीं हो सकता अब, क्योंकि बहुत बार टेस्ट हो गया। तो थोड़ा सा कॉशियसली, क्योंकि इसमें अब एसएल भी छोटा नहीं रख सकते। ओवरऑल है तो बुलिश ही नेचुरल गैस। थोड़ी बहुत प्रॉफिट बुकिंग एक्सपेक्ट थी। 2-3 दिनों से कंटिन्यूअसली सेल कर रहे हैं रेजिस्टेंस पे। थोड़ा बहुत नीचे आता है फिर रिटर्न कर जाता है, थोड़ा बहुत नीचे आता है फिर रिटर्न कर जा रहा है। कि अगर ये सक्सेसफुली ब्रेकआउट रीटेस्ट करता है तो फिर तो ये सीधा 500 के आसपास दिख रहा है। 550 560 तक भी जा सकता है, 550 560। मंथ की कैंडल बड़ी इंपॉर्टेंट है, अगर एक क्लोजिंग दे देती है इस मंथ, अभी टाइम काफ़ी है वैसे तो 26 डेज हैं, बट अगर ये कहीं 425 और 30 के ऊपर क्लोजिंग देती है तो फिर ये 4 आवर टाइम फ्रेम का रेजिस्टेंस का ब्रेकआउट ही माना जाएगा। इस मंथ क्लोजिंग नहीं आनी चाहिए 425 के ऊपर। देखो 15 मिनट में भी रेजिस्टेंस होंगे यहाँ पर, बट वही इशू है, उतना पीछे चार्ट ही शो नहीं कर रहा है 15 मिनट का, नहीं तो 15 मिनट के लेवल ही क्रिएट करके लगा देते, वो और थोड़ा बेटर रहता।
Actually gets challenged. I mean, there's so many twists and turns.
ब्रेक करता है तो ऊपर भी फिर वही लेवल है जो मैंने बताया 4 आवर टाइम फ्रेम के अकॉर्डिंग, बट वही है फिर वो 4 आवर टाइम फ्रेम में ब्रेकआउट रीटेस्ट करना चाहिए। उसके लिए मंथली टाइम फ्रेम की कैंडल देख लेना, मंथली टाइम फ्रेम की कैंडल कहाँ क्लोज होती है। अभी 6:30 न्यूयॉर्क सेशन ओपन होगा, लेट्स सी। नेचुरल गैस में 465 पर नेचुरल गैस सेल कर सकते हैं, हाँ लगाया तो है सेलिंग का, बट इसमें एसएल थोड़ा बड़ा है या क्योंकि ये रेजिस्टेंस 4 आवर टाइम फ्रेम के अकॉर्डिंग है और अभी का नहीं है, बहुत बार टेस्ट हो गया, तो उतना ही रिस्क लेना जितना ले सकते हो 4 आवर टाइम फ्रेम पे। ऑब्वियसली ये 10 पॉइंट का एसएल है तो बड़ी क्वांटिटी तो मत ही करना, एसएल जाएगा तो बहुत बड़ा लॉस हो जाएगा। बाकी उसके कंपैरिजन में टारगेट भी बड़ा रख सकते हो। प्रॉफिट बुकिंग का देखो, प्रॉफिट बुकिंग काफ़ी टाइम से हो रही है, प्राइस रेजिस्टेंस को हिट करता है बट उतना सेल ऑफ पे नहीं आ रहा है। प्रॉफिट बुकिंग तो रोज ही देखने के लिए मिल रही है, यहाँ से कंटिन्यूसली प्रॉफिट बुकिंग ही चल रही है, बट ये प्राइस नीचे जा ही नहीं रहा है, उस हिसाब से जाना चाहिए हायर टाइम फ्रेम पे, तो इट मीन्स कहीं ना कहीं चांसेस हैं ऊपर ब्रेकआउट होने के भी। 4 आवर टाइम फ्रेम के रेजिस्टेंस पे मल्टीपल टाइम टेस्ट हो गया। सेल ऑफ थोड़ा जल्दी आता है, सेलिंग इतना रुक के नहीं आती है कभी भी। सेलिंग या तो हमेशा फास्ट आती है रेजिस्टेंस जोन से, या फिर सेकेंड ऑप्शन ये रहता है कि पहले एसएल हिट करे सेलर्स के और फिर नीचे आए। दोनों ही कंडीशन में सेलिंग फास्ट ही आती है, रुक रुक के नहीं आती जिस तरह से 2-3 दिनों से देख रहे हैं। तो गैस में ध्यान रखना, इसमें ये ट्रेड जो लगाया हुआ है एसएल इज अराउंड 10 पॉइंट, चाहो तो उसको छोटा भी रख सकते हो 2-3 पॉइंट का, बड़ा एसएल रखोगे तो फिर क्वांटिटी कम रखना, टारगेट बड़ा रख सकते हो, टारगेट बड़ा ही रखना पड़ेगा। वैसे इंट्राडे में देखोगे तो डेलो नाउ इज अ सपोर्ट 15 मिनट टाइम फ्रेम।
by Sean Cannon. For more transparency news and important document dumps, you
ब्रेकआउट से काम नहीं चलेगा, ब्रेकआउट रीटेस्ट चाहिए। मंथली टाइम फ्रेम की कैंडल देख लेना, मैंने बताया नेचुरल गैस में ब्रेकआउट होगा नहीं होगा, मंथली टाइम फ्रेम की कैंडल विल डिसाइड। लास्ट मंथ की कैंडल क्लोज नहीं हुई है, इस मंथ की कैंडल अगर क्लोजिंग देती है नेचुरल गैस में अबव 430 मान लो, 425 430 के ऊपर, तो ब्रेकआउट हो गया समझो। फिर रिटेस्ट बचता है बस, अगर रिटेस्ट कर दिया तो फिर नेक्स्ट टारगेट वही है 550 560 के अराउंड। रिटेस्ट नहीं हुआ, फेक ब्रेकआउट हुआ, ये वापस कैंडल, ये सेम कैंडल ही नीचे आ जाती है 425 430 के नीचे क्लोजिंग बेसिस पे, या फिर नेक्स्ट मंथ की कैंडल नीचे आ जाती है, तो फिर फेक ब्रेकआउट माना जाएगा। वैसे अभी 26 डेज है, काफ़ी टाइम है।
कहीं सीलन की बूंदें आपके घर में भी संगीत बनके ना गूंजे, इसीलिए घर बनाएं ACC गोल्ड वाटर शील्ड सीमेंट के साथ।
News when you want it with Bloomberg News Now. I'm Nathan Hager. It is a deal that will reshape the face of Hollywood. Netflix has agreed to buy Warner Brothers in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. Under the deal, Warner Brothers shareholders will receive $27.75 a share in cash and stock, putting the total equity value of the deal at $72 billion. Bloomberg's Paul Sweeney has more.
This is going to be big. Again, Netflix has just kind of built its business organically, investing in programming, licensing program from other folks in Hollywood. Now, if they move ahead with this Warner Brothers Discovery deal, they're going to own one of the iconic studios in all of Hollywood, and that would be and tremendous library of content which they can put on the Netflix platform globally.
That's Bloomberg's Paul Sweeney. Now, under the deal, Warner Brothers will complete its planned spinoff of cable channels, including CNN, TBS, and TNT, under a new publicly traded company called Discovery Global. Again, Netflix is buying the Warner Brothers studio in a deal worth $72 billion in stock. And that's news when you want it. With Bloomberg News Now, I'm Nathan Hager, and this is Bloomberg.
What happened overnight in Europe and Asia, the day's economic data, and complete coverage of the U.S. market open. We cover stocks, bonds, commodities, currencies, even crypto, all the information you need to excel. Bloomberg Surveillance also brings you the analysis behind the headlines. We do that with lengthy conversations with our expert guests, the smartest names in economics, finance, investment, and international relations. We do all this live each and every weekday, then bring you the best analysis in our daily podcast. Search for Bloomberg Surveillance on YouTube, Apple, Spotify, or anywhere else you listen. On the East Coast, listen at lunch, and on the West Coast when you wake up. That's the Bloomberg Surveillance Podcast with me, Tom Keene, along with Paul Sweeney and Lisa Mateo. Subscribe today wherever you get your podcasts.
Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy.
कॉल लिया था तो हाफ प्रॉफिट बुक करके ट्रेल कर लो.
I've been avoiding it on purpose, Joe. In all honesty, I really find this particular market/issue a difficult one to talk about because it's impossible to talk about it in broad terms. And
ये नेचुरल गैस के सेलिंग के रेट में ध्यान रखना गाइस, ये 4 आवर टाइम फ्रेम का रेजिस्टेंस है, मल्टीपल टाइम टेस्ट हो गया. री एंट्री करोगे तो क्वांटिटी का ध्यान रखियो. एसएल बड़ा है 10 पॉइंट का, उतना ही रिस्क लेना जितना ले सकते हो इस 10 पॉइंट के एसएल में. अगर 10 पॉइंट का एसएल नहीं लेना है तो फिर 2-3 पॉइंट का एसएल रखना, या फिर कोशिश करना जितना इसका एसएल जोन है वहाँ कहीं एंट्री करो, सो दैट एसएल और छोटा हो जाएगा. फिर वहाँ पर भी ऐसा नहीं कि बड़ा एसएल लो, वहाँ पर भी 2-3 पॉइंट का एसएल लेना. ओवरऑल बुलिश ही लग रहा है.
And their first thing, and they're like, wait, are you talking about a competitive market or a regulated market here? That always
is
seems
a metered
to be,
basis or unmetered or I don't know.
Behind the meter, etc. Yeah, but anyway, obviously with the sort of Ian Dunning, who we recently had, Hudson River Trading, he was talking about how, their main constraint is power. And that's just a very small, in the grand scheme of things, user of AI services. We were talking about using AI and high frequency trading. And he said, even more than chips, that the power constraints are their biggest constraints right now. And so I do think that one thing we have to think about is, especially how long can this AI boom go on, is what's it going to take to get all of this AI activity on the grid? Like, how constrained is it?
That's right. And we also recorded that episode with Sagar and Jetty, and we were talking about the political controversies surrounding AI, and obviously power consumption is a big one of those at a time when electricity prices have already been rising. Is AI only going to drive them up further? Although that said, You can't even say that electricity prices have been rising because in certain states they've actually been going down on an inflation-adjusted basis. So even that is a nuanced picture.
But by and large, especially since the pandemic, really, by and large, we have seen faster than normal increase in electricity price inflation. And we have the big AI question. So we really have to figure out, A, how is all of this new data center capacity going to come onto the market? Who's going to supply the generation? And then who is going to bear that cost? Is it going to be the consumers who are already, generally speaking, across several markets, seeing their bills go up?
If we have to talk about this rubber band ball market, then I'm glad we at least have the perfect guest to do it. That's all I'm going to say.
We do, in fact, have the perfect guest. Very excited to say we're going to be speaking with someone who's been trying to get on the podcast for a little while, Travis Kavula. He is a VP of regulation at NRG Energy. He's also been on a public commission in Montana, so he knows that side of the business in terms of how prices are set in those regulated monopoly markets. He's also an academic. Travis, thank you so much for coming on Outlaws.
It's great to be here. Thank you.
We're really excited about this one because there's so many questions. Why are we talking to you? Why don't you give us the sort of brief intro of what you do and what your background is so that our audience has some idea of why you're the perfect guest?
Sure. So I spend my time on regulatory affairs at a company, NRG. We're a big producer of power. We sell power to end-use customers where that's permitted by law, where competition exists in the power and gas markets. So we've got about 8 million end-use customers. And previously, I was the head of the Montana Public Service Commission, the rate-setting body for regulated utilities in the state. I headed up an organization that represents state utility commissions at the national level called NARUC. And I teach a little bit on the side at University of Chicago's Harris School of Public Policy, a course on utility regulation and electricity markets. So I spend my time thinking a lot about what goes into customer bills, both the stuff that we can control, being a company that is a provider, and also stuff that are sort of upstream costs of goods sold that appear on my company's bills, the sort of poles and wires charges that go into people's bills. So basically, there's two parts of people's bills: the commodity and the regulated grid charges that get the commodity to you. And both of those are subject to some form of regulation in this industry.
Yeah, Tracy, when we were in Chicago recently for our live episode, I met one of Travis's students there, and he's like, you got to talk to Travis. Travis is the man that will explain all these things. So glad we're finally making this happen.
I'm glad I have a high rating from the students. That's important.
From Rate My Professor.
Market.
That's right. Okay, so no pressure, Travis. All right, so you were talking about the wholesale cost of the thing that goes across the wires and the poles and all of that. So that's electricity versus the actual transmission system. One thing that we hear whenever this topic comes up is it's not necessarily about the wholesale cost of electricity, it's the cost of actually maintaining and expanding the grid. How much truth is there to that? If you're going to pinpoint the dominant factor behind higher electricity prices right now, is it the wholesale price or the actual cost of transmission?
Yeah, it's kind of the scope of time that you choose to evaluate. But, just to give you kind of a benchmarking, if you looked at, say, the New England power market over the last 20 years, which sort of is the beginning point of the restructuring of the industry and the introduction of competition in a place like New England, the actual commodity cost would have fallen by about 50% on an inflation-adjusted basis, whereas on the same basis, transmission costs would have increased something like 900%. Now, from a very low level to a much more substantial level. But then if you drew that comparison in another market, say the Mid-Atlantic, over a shorter period of time, like year over year, the grid costs would not have risen substantially in a year, but power prices would have. And that's really just because the commodity works on more fundamental kind of supply and demand balance. Scarcity will drive up prices relatively rapidly, and then an oversupply that occurs when the market is moving back toward equilibrium will drive prices down rapidly. Whereas those regulated set of costs that attach to the transmission and distribution systems, those are still cost plus regulated industries, and they have a funny way of working monodirectionally up over the course of time. But these two things trade off against one another. You need to invest in transmission in order to facilitate the efficient delivery of electricity. You need to invest in it in order to open up regions for low-cost renewable energy production. So they do have an interactive effect, but they're regulated in a very different way. And both of those land on consumers' bills. I think the easiest way to understand this is that, consumers, in a sense, had maybe been, as a result of the regulated charges, the proverbial frog in gradually warming water. And then when you finally enter a commodity super cycle, people can have the sense that, oh, wow, someone just ratcheted up the heat on this pot. But both of those are contributing factors, and they require sort of different structural approaches in order to reckon with them.
Joe, this is my perennial frustration talking about electricity prices and the electricity system in the US, which is you cannot talk in generalities, right? There are different types of regulations for different entities. There are different regulations for each state, basically. There's, the New England system, then there's the West Coast, and then there's Texas, which is its own special entity. You kind of have to talk about every single market in isolation, which is difficult even on an hour-long podcast. So that's going to be the caveat throughout this conversation, I think.
It's idiosyncratic, and it's funny because at the same time restructuring and competition was introduced into this industry, it was also occurring in things like telecom. Telecom, was substantially deregulated and federalized at the same time. States, however, were left to make their own decisions about the power sector, and as a result, you really have a huge patchwork quilt of state and federal regulation and different industry models. It's true.
I have another really rudimentary question, I guess. What are we even talking about when we talk about competition in electricity? I don't get to choose which wire I get into. There's one utility I have the option from. Sometimes there are these people on the street and they're like, will you sign up for clean power or something like that? And they try to get me to do stuff, but I don't really understand how that works because I don't understand how electrons can be directed to anyone's home. So I'm always very skeptical of that. What are we talking about when people talk about a competitive market?
Yeah, so think of the electricity system as sort of a chain of links. Upstream, you've got the power generators, and then after that, you've got the high voltage transmission system. It patches into a substation that steps down the voltage to a lower level. That's what we would call the distribution system. And then there's a meter hanging on the side of your home. And beyond that meter, you are the consumer of electricity. The most upstream, the generation, and the most downstream, retailing, have been opened in some states to competition. And I think it's fairly intuitive what that means for generation. Power plants are owned by private investors who make investments in them. Those power plants compete against one another in auctions for electricity and to sell their power to wholesale off-takers. Some of those off-takers then are the retailers of electricity who sort of buy an upstream supply of goods and then use the regulated poles and wires and pay regulated rates to deliver that commodity to you at your home. So some of the value proposition of what you're experiencing as a potential retail customer in a competitive market is your product selection. I mean, to give an example, a retailer came to me and marketed me a 5-year fixed price for electricity last year. I bought it. I locked in a rate. I'm insulated from upstream, changes in wholesale market volatility as a result. That's generally the value proposition of competitive retail, though in places like Texas, you're also seeing product differentiation that has a ring of telecommunications and data competition, sort of like more apps as part of your retail electric supply service, people selling you smart thermostats or residential batteries that can be packaged onto your retail electricity supply plan to sell back to the grid, help manage your costs upstream to stabilize pricing. But that's the paradigm of competition in this space. It's a regulated system in the middle with competition on the edges.
Can we back up for a second and go back to that big restructuring of the market? Because I have a feeling this will help us understand our current situation. But what was the problem that we were trying to solve back then? People have short memories. A lot of people would say that our electricity system right now has its own special problems, and they would forget that there were previous problems that this system was meant to address.
Yeah, I mean, it's kind of haunting. It's funny you should ask that question because the problem it was meant to address is that regulated utilities, which used to own this whole chain of links on a consolidated, vertically integrated basis, bet wrong very badly on the amount of demand growth in the sector. And they put themselves out there building power plants that were intended to be included in what's called their rate base, on which they earn a return and are able to charge off those costs to a captive set of customers. When they bet wrong on the demand that would ultimately materialize on the system, they found themselves well over their skis in the amount of power generation that they either had built or were in the process of building. At the heart of regulated utility economics is this division problem where kind of a total system of fixed costs is the numerator divided by the denominator of throughput. So these regulated utilities were adding handsomely to the numerator. The denominator wasn't propping up that. And the result was that division problem spitting out a price that was escalating higher and higher. Some utilities at that point, their state regulators said, you've been imprudent. We're going to not allow you cost recovery because you've been imprudent. They went bankrupt. But that was the exception to the rule. Most of them allowed those costs to be recovered from a captive customer base. But some of those states also passed laws that said, let's never do this again. There's no reason why we shouldn't have power generation invested in to meet the levels of demand needed on the system be a function of investors' competitive bets in the market. And so in about, call it a third of the states, but accounting for more than half of the power sold, that's now the business model where companies like mine are, have to make guesses about what the demand is going to be and try to sign up customers to voluntarily contract with us to produce revenue for the power generation we might invest in. And for the rest of the country, it still works by, people like me wearing my former hat, as the chairman of a utility commission, like.
Valley is selling you a future where you're obsolete, or worse, identical. At Palantir, they're witnessing something different and revolutionary. From reindustrializing the nation's defense base to shipyard workers building faster and frontline workers boosting productivity, AI is transforming work across the nation. AI is not replacing American workers or flattening them into conformity. It's unleashing what makes each one irreplaceable: their judgment, their craft, their Palantir, making Americans irreplaceable.
In our new podcast, Everybody's Business, we talk about the business news that concerns everybody.
From Bloomberg Business Week, I'm Stacey Vanek Smith.
And I'm Max Chafkin.
Each week, we unpack what is happening on Main Street and Wall Street, all the streets. WrestleMania has taken over the U.S. economy.
Poetry that executives write on LinkedIn.
A little actual magic in our underrated story of the
single
week.
greatest marketing campaign the music business has ever seen.
I decided to ask people how they felt about the penny going away. Listen to Everybody's Business wherever you get your podcasts.
Let's talk about your former hat, because one of the things you hear about is that the utilities have this incentive to overinvest because that might help determine what they're allowed to charge on a going forward basis. But why don't you sort of talk about your former hat and the basic role you played, how you thought about decision making, and how we are to understand what the world looks like from the standpoint of someone sitting on that regulatory commission?
Yeah, well, you're absolutely correct about the incentives at play. Under the style of economic regulation that is widely used, really without exception in the United States, to regulate the monopoly industries in the utility sector, the companies earn a return that is sort of announced in advance by their state or federal economic regulators based on the amount of capital they've invested in the system. So spend more, make more has some paradoxical effects where the most amount of profit a utility will ever make is in the first year that it owns a particular asset. And then when they own it free and clear, they actually earn zero profit. So sort of an inversion of the cash flow paradigm that you would expect out of competitive businesses. Regulators also established the depreciation lifespan for rate-making purposes of regulated assets, which has some interactive effects with that model. So that's basically the grist in the mill of what state regulatory utility commissions do. They determine the amount that is, quote unquote, used and useful in service to customers of the capital investments that utilities have made. They also establish an allowance for so-called prudently incurred expenses, the O&M on the system, around which the utility earns no margin, just gets a recovery of those costs. And that also has the knock-on incentive of, if I'm a utility and I look at a problem that I have to solve, I will always want to solve it with capital investment. I will never want to solve it with OpEx, and because that one earns a return, one does not. So ordinary trade-offs that would occur in competitive businesses between CapEx and OpEx tend not to occur. Last set, a record demand, before the period of offshoring and deindustrialization of industries that use a lot of electricity. And that actually facilitated the kind of turnover of capital from coal to gas and to renewables a little bit as well in a lot of these places. But net of net, that was kind of neutral or even a little bit negative in terms of the total installed generation capacity. It was kind of managing to even in terms of generation capacity additions. And then in terms of shouldn't they be celebrating? Yes, definitely. Everyone in this sector, my business and the regulated utilities, are excited about the prospect of growth. They're also nervous about whether or not this growth is real and to what magnitude. Part of what makes it a little worrying is that ordinarily electricity demand growth would be a composite of growing demand from many different end-use applications that would kind of diversify the risk of betting on growth. Here it's like a 1 or a 0. If you take out the data centers, the sector is actually pretty stable in terms of electricity demand. If you add the data centers, the sector is really poised to grow a heck of a lot. And when you look at the projections of the grid operators, just to put some numbers on this, the market PJM in the Mid-Atlantic that I was referring to, it's currently about 160,000 megawatt market. It's projecting to add 40,000 megawatts by 2030. The ERCOT Texas market, about 85,000 megawatts right now. Its latest projection is up to nearly 140,000 megawatts by 2030. Now, that's like adding a California to Texas in terms of electricity demand in 5 years. And that's not going to happen because it can't. It just, literally could not occur. But therein lies the problem is what are we actually investing toward, and what are the regulatory policies that can essentially help call the question on the amount of offtake that will actually materialize from AI, so that then capital investments can propagate throughout the supply chain to end up serving them. That's really the fundamental question that policymakers, utilities, and competitive providers like us are trying to deal with.
Those numbers are absolutely staggering. The idea of adding California-size demand to Texas in just a standpoint of a few years. When you say you don't think those numbers can happen, what is the constraint? Is it on the generation side in a market like Texas, or if we're talking about any other region? Or because I think it's pretty easy to set up, solar farms or whatever. Texas seems pretty liberal with how easy it is to plug into the grid. Or is it in a state like that, there isn't the transmission capacity, even if you can stand up the production?
Yeah, it's a little bit of everything. Everything from stuff that isn't, on the power sector side of the fence line in terms of actually being able to construct data centers and, their chips and the fiber optics that would back them up. And then on our side of the fence, you're right, getting access to the grid through interconnection, getting all the equipment that you would need to tap into the grid. We're talking about, kind of grid step-up, generator step-up transformers and stuff like that. Joe, I know that's a topic near and dear to you from listening to the pod over the years. And then it is the power equipment in terms of gas turbine availability. Solar panels probably aren't going to do it for you given the demand for, kind of consistent power production off of these data centers, but they are helpful. So it's just the magnitude there is a dilemma. And, right now, if I were to place an order for something like, a generator step-up transformer, pre-COVID, it would have been maybe 12 to 18 months. Now we're talking about 3 to 4 years for a bespoke piece of equipment whose specifications are only available to me after the local utility, the poles and wires company, tells me what my interconnection study looks like in terms of grid availability and our connection to the system. So that's one. NRG is lucky enough to have some gas turbines lined up for delivery, later in this decade. So we would be able to facilitate some of this investment. But if you were going to get in line right now, that too would be a process that would take several years. Some of it's the availability of equipment, and some of it is a natural pacing of steps in the kind of quasi-regulatory process to get projects online. It would be better, I think one of the interesting policy innovations that's out there is if you had kind of more of a market to make use of the scarce remaining headroom in our system from sort of a grid interconnection point of view without tripping into having to build a bunch of capital investments in poles and wires. But, that's not the way the regulatory model is set up. Right now we have a paradigm where if I'm a power generator, I kind of knock on the door of the local utility and say, hey, I want to build a power project at this place. Can you study it for the sake of its interconnection to the grid? They come back with a study and I don't like the number, I don't like the specs, and then I submit another study and we iterate. So it's a time-consuming process sometimes to develop these projects. And there probably needs to be avenues that are more coordinated between the demand and supply side. And even if you don't, even if you certainly shouldn't functionally reintegrate the utility business model, but there does need to be more coordination between the people who own the poles and wires and the people who are doing the generation. And that's kind of a missing link right now in this policy landscape.
Other than sheer volume of power needs, I guess sheer megawatts, do data centers have specific energy needs in terms of, the type of electricity? I would assume a megawatt is a megawatt, but what do I know? But maybe in terms of timing and things like that, are there sort of operational considerations that are unique to data centers' electricity consumption versus, say, an industrial factory or us turning the lights on when we get home?
Yeah. So, the first experience, at any scale that anyone seemed to have with computing technologies, were kind of, cloud-based servers. And then really on the other side, like crypto mining facilities. And both of them data centers, but the two could not be more different, right? Crypto it becomes uneconomic at a certain strike price for cryptocurrency to continue mining. And so it's a highly flexible load that drops off the system when conditions become tight in an electricity market. And we see that all the time in Texas. On the other hand, for, cloud services that are providing kind of real-time instantaneous hosting capabilities, they kind of they have a very high what's called a load factor of their power consumption. They're drawing from the system on a relatively consistent basis. And of course, they need to be highly reliable. They can't really be interrupted without having Cloudflare or AWS interruption style problems. So very different. And you can look back to analogs of, other industrial customers, aluminum smelters, high load factor when they were doing the batching of smelting, couldn't be interrupted. Paper mills, maybe you could interrupt them. So the industry has some kind of learnings from this, and there have been markets designed around the flexibility of demand to try to do for the power sector what previously happened to, say, the airline sector, which used to have, very low load factor. And then after restructuring and deregulation in the 70s, suddenly everyone's airplanes ended up full, and too full in some cases where, people get bumped and compensated for it. So we've yet to achieve that, though, in the power sector where load factors continue to be, 50, 60, 70%. So there's a lot of headroom during certain hours and very little headroom during other hours. So the primary question in terms of the network economics is if you end up with a bunch of high load factor data center customers, the type that can't be interrupted, how do you get them online without tripping into a bunch of necessary capital investments to serve that last few percent of hours where their demand needs to be served and firm? Or can you source flexibility out of the system somewhere else, like from residential air conditioning or something like that? That's a question, again, that's very important to figure out. People have kind of issue spotted it, but we've really yet to solve in any meaningful way. Though markets like Texas are kind of geared towards solving it in more of a free enterprise
thanks to data centers. Intuitively, it seems like, well, it shouldn't be. They can pay for their own electricity. They can pay for their own upgrades. But how does this massive increase in demand play out from the sort of the ratepayer perspective?
Yeah, so we go back to the kind of segmentation between the regulated grid costs and the commodity costs on in answer to that question. On the commodity side, this tends to be a marginal cost pricing environment where if you have demand growth outstripping supply additions, the system becomes tighter. The supply curve moves up for the kind of last unit that's necessary to serve demand, and its marginal costs in a very real way establish the clearing price that all demand has to pay, unless and to the extent to they are bilaterally contracted with some kind of hedging instruments, which everyone should be. No one should be in an ideal market exposed to that spot price, but we find that many people are for a variety of reasons. So some policy interventions that people have contemplated is, usually we would let these markets kind of equilibrate on their own. We would expect sort of organic growth to be met with organic supply additions. Here, people have observed wow, this demand growth seems really out of scale with what the markets have organically been able to achieve. Maybe we should have a requirement to just bring your own generation. We're not going to let the power markets on a forward traded basis send the right signal and hope that enough generation shows up to serve this demand as sort of part of the social license or even a formalized regulatory requirement for them to get online. You got to show us the megawatts that you're bringing onto the system. So that's one of the debates. On the other side of the ledger, the regulated costs, that too can be a problem. Usually, and again, this division problem of network economics for the regulated costs, if you're adding to that denominator of throughput at a rate that is higher than you're adding to additions to the fixed costs of the system, everyone's rates go down. Produces a lower quotient, which is the price of grid consumed electricity. The problem here is that in a kind of an inflationary environment for all the materials, the transformers, the cabling, everything that goes into the poles and wires, if you're adding demand and you're not just using headroom that already exists on the system, if you're not increasing that capacity factor on the system, if you're tripping into a lot of new capital expenditures, then even if you're adding demand that's paying regulated rates, it may not be enough to offset the total amount of expenditures incrementally you're making on the system. So there's policy interventions there too, where you can try to directly assign the costs that are caused on the grid back to the data centers. But those are pretty nascent approaches, and some of the ones that have been tried are kind of aiming at the wrong thing. So a lot of policy work remains to be done here. And all of this is kind of a political debate where, a lot of state governors, the people who are really the ones kind of in charge of with their state utility commissions setting these policies, they simultaneously want the economic development of data centers, but they don't want any negative externalities around reliability, affordability, clean energy. And all those things trade off against one another. But, political actors will want to maximize all of those variables, which is not possible in the current environment.
Can I ask a very basic question? And I'm struggling to think of a way to frame it that doesn't sound like I've just taken an elderly family member to a medical office or something. But what is a node?
A node usually would be a place like a substation. It is the place on the physical grid at which electricity is bought and sold. It's a physical destination on the grid. When we say nodal markets, which is a way to describe electricity markets, we're referring to markets where electricity is priced on a so-called locational marginal price basis. And the LMPs, as they're called, are based on physical destinations on the grid called nodes. I'm just estimated guess here, but a market like Texas will have a few thousand nodes at which electricity is traded on an individuated price basis.
That seems like such a weird way of doing it to me. And I'm sure there are very valid reasons for doing it in this way. But nowadays, given all the data at our disposal, given the rise of AI, can't we work out some sort of average cost across the system? It seems really weird that we're taking it at physical points. Although I guess There are plenty of commodities that do trade based on particular locations, but it just seems strange to me.
Well, it is important that you have nodal pricing in the system only because it sends a powerful price signal for the accurate location of necessary power generation. There are certain markets, I'm thinking of Alberta, some of the European markets, that actually do establish a zonal price across their entire market. But there you end up with power plant developers, who develop wind in a particular area far away from demand to capture the average price, but then that energy ends up being undeliverable because there are transmission system constraints and congestion. So the nodal pricing formulation is intended to reflect a market that, unlike the stock exchange, isn't just trading bits of data to represent kind of paper securities. It, in a very real way, is meant to simulate a kind of flow of electrons on a system-constrained basis. And then it provides valuable information, too, because if you continue to see locational marginal prices, in one place that are very high, and 20 miles away, they're very low. That's a signal to the people who plan the transmission grid that, hey, we should probably build a transmission line here, because the addition of the transmission line will be the thing that flattens out that price differential and creates a market that looks more like a copper plate rather than two separate swimming pools.
Interesting. Just to be clear, though, if I wanted to be public enemy number one, could I build a gigantic data center next to a locational marginal price point node and affect the cost of electricity for, a greater area?
Yes, you absolutely could. And in fact, I know of at least one example. North Dakota is actually a good example of this, a place that doesn't have a lot of robust transmission infrastructure, does have a lot of renewable resources that cause, and those renewables are almost kind of dumping on the market in a way that causes the energy price to go down and even negative at times in North Dakota. And, some of the first data centers that we've seen in this wave of expansion chose to locate in North Dakota because they had access to wholesale prices that were low or negative. They were just following the price signal. And so there's certain data centers out there that are literally being paid to consume electricity because there's such an oversupply and so little transmission into the area.
I got to ask this question on a podcast recently, and I didn't have a good answer. So now I want to ask. So you mentioned, all of these different pieces of electrical gear, they're in short supply. You might not be able to get some key equipment until 2030. Is that strain going to ease at all? Is there any additional capacity coming on the market? When I was asked this, I hesitated. I was like, well, maybe they're not sure about the future, so they're reluctant to do the capital expending involved. But do you think there's any, is capacity growing for some of this core infrastructure as far as you can tell?
My impression is yes. You've seen public announcements from the largest gas turbine manufacturer, GE Vernova, about new manufacturing base additions, some of the transformer equipment as well. I think you're seeing some incremental investment in. You're certainly seeing power generators like NRG, take positions in lining up their optionality to have power projects that can be deployable to either the Texas market or the Mid-Atlantic market, depending on where consumer demand actually arises. So I think there is some development in that market. I will say, I think what people are waiting for, everyone looks around the supply chain and, is reasonably asking, well, who's got the deep pockets here? And then everyone turns to big tech. Big tech, obviously, if they signed a power purchase agreement for 15 years or even less to take power at a certain price, some of this supply chain would fall into place pretty readily, I would say. And so people are kind of waiting, in a sense, for big tech to make those big bilateral contracting moves that would serve to propagate sort of rationality around response to the perceived demand up and down the supply chain. And I think that's kind of the leading indicator to watch for in the sector, how many of those contracts are actually being signed.
big tech is just going to do everything. They're going to build nuclear plants, and they're going to build their own chips, and they're going to build their own fabs and everything. It'll be this entire ecosystem that is just alphabets from down the line. I want to go back, though, to something you said, which is that part of what's tricky about the data center thing is that, okay, here's this big boom in demand, but it's not because of like general like trend economic growth. And it could be perhaps that in a year from now or 6 months from now or tomorrow, people say, oh, I want to slam the brakes on AI spending. We're not getting this return, fears of a bubble, forth. Talk to us a little bit more how the commissions are dealing with this risk and this very binary state of planning.
Yeah, so commissions at the state level have dealt with this in a very different way. Some of them have candidly, and regulated utilities themselves have said, we want no part of this risk. Like, we're a small mid-cap utility and someone is knocking at our door asking us to invest in power generation that would be like a third of our total existing balance sheet that's remained stable for decades. We're just not doing it. You can get on our grid and you can pay the cost to get on our grid, but in terms of power generation, you've got to bring your own project. We're not involved in that. Other utilities that have larger balance sheets, the southeastern utilities, are using their regulated balance sheets to build out generation and supply data center customers. Devil's in the details on those heavily redacted commercial agreements that I would desperately love to see about the degree to which they protect consumers. And then, of course, the other side of the industry, the competitive industry, it's companies like mine and data centers that enter into commercial agreements for the purchase and sale of power, and neither of those parties have recourse to a captive base of customers. So they could go bust, we could go bust. It's not going to, be skin off the teeth of a set of quote-unquote ratepayers. Again, on the grid costs, it's about whether or not state commissions, and in this case, a federal regulator, the Federal Energy Regulatory Commission, are going to style take-or-pay contractual agreements to require large data centers that come onto the grid to essentially collateralize a revenue stream associated with the incremental costs of developing the grid to serve them. And so far, there seems to be relative unanimity that that is the right way to go in order to protect legacy customers. But again, the devil's in the details, and I have a problem with some of the math that's being done in those regulatory approaches. So it's not as if this problem is invisible to the people who are economically regulating this industry, but they are trying to, in a very real way, they are trying to figure it out in real time. And I'll be the first to say their solution set is far from perfect.
So just on this note, it strikes me that the difficulty in the system, setting aside the patchwork of 50 different states all having their own different regulations, like the heart of the difficulty in the current system is we're trying to preserve the market signal for further investment, but also smooth out some of the volatility so that Joe and I don't have to spend an inordinate amount of time thinking about what is like the most cost-effective time to blow dry our hair or do our laundry or something like that. So we're kind of trying to have our capitalism cake and eat it too. Cakeitalism. That kind of works. What is your platonic ideal of a electricity market? Do you have one either in the US or elsewhere in the world that you would say, look, here is a system that actually manages to do both these things?
Yeah, man, I love that question. I will say that one of the real flaws in the US electricity system is that it is not as robustly a two-sided market as you would hope for. It's still demand just exists on the system. It's coming onto the system based on people's, on the supply side, guesses about what will happen. And then the supply side is expected to solve all of it. There's very little in the way of demand elasticity. And that's been for a variety of historical reasons. The first and most obvious one is that you didn't even have the technology in the form of advanced metering infrastructure to understand when people were actually using the power in relation to a highly time variable set of upstream costs. Now you do have that. You are also increasingly having the software that allows financial settlements on the part of the people retailing electricity to end use consumers to be settled on the basis of that advanced metering infrastructure's actual meter reads, so on a time interval basis. And finally, because you shouldn't have to think about when you're going to blow dry your hair, you have a significant amount of device automation in the form of smart thermostats, battery storage, electric vehicles, manufacturing and industrial processes, which can be sort of a set it and forget it to automatically respond to high prices to try to increase the system's load factor and avoid using electricity at very high cost times. So that is just starting to happen in the American electricity sector. I would tend to look to the UK and Australia as places that have gone a bit ways further in trying to solve that problem and embrace the inherent flexibility of the system as versus the United States, which is kind of stuck in this sort of supply does something to demand framework of industry. So that's definitely on my, it's always on the top of my homework list, if only because I think a lot of people are thinking about solving this problem highly conventionally with supply additions, which is going to be really important, but that demand flexibility component is actually essential to get to a market that looks like every other efficient and competitive market in the world, which has two sides to it.
We've been talking a lot about sort of the future, looking forward and figuring out, how that we're going to get all of this new capacity onto the market, et cetera. Let's look at the last several years. What happened? Part of the reason we're even having this conversation is because electricity bills are on people's minds, right? And they've been high. And it's a little unclear, how much of this is just keeping up with inflation. I presume that grid maintenance is actually straightforwardly an effective labor cost, inflation, et cetera. One thing we do know, however, is that the pace of electricity price increases really since the pandemic seems to have been a level step up. What's driven that? How would you characterize the last several years of electricity prices and perhaps the role of load growth in driving those increases?
Yeah, so far, load growth is really not the contributor to what has happened here. It is almost an awakening to the fact that we had already, without any more load growth, a less reliable system than we thought we did. And that's due to a variety of reasons. We retired a lot of coal, which, had a lot of emissions, but we replaced it with a bunch of natural gas. That created a sort of more of a dependency on an interrelated network system, the gas supply and pipeline system, which, while usually very robust and very economically efficient in winter conditions where there's a lot of residential heating draw on that system, can show frailties. And so market operators in these electricity markets sort of derated the value of that capacity in how they set up these markets, which meant effectively a sort of administrative withdrawal of supply from some of these markets. Similar to that, renewables were seen not as a one-to-one replacement for reliable generation in the parts of the country, the middle of the country especially, where they were heavily invested in, but they were really being leaned on as an effective substitute for more dispatchable power. And I think everyone in the back of their head knew that wasn't the case, but only recently, as things have gotten tight, have people begun to do a lot of hard math around it. And then finally, we've just seen a few really traumatic winter storms in particular, one in the East and one in Texas, that have sort of reshaped the way in which the people who have responsibility to operate the grid think about the operational posture and need for reliable resources on the grid. And so there were a variety of regulatory changes that were made that had net of net the effect to tighten up the understanding of what generating capacity was available on the system relative to a base of demand that really didn't change. But suddenly, because of all of the retirements that had happened of coal and older gas due to economics as well as environmental regulation, we suddenly found ourselves pretty tight. And then this demand growth started to happen. So we were not particularly well positioned for the present moment of demand growth. We'd already driven the system to, some might call it a tight and efficient system if you had demand growth that was level, but it was not well situated to pick up tens and tens of new gigawatts of demand.
I have a hypothetical question, but just as a theoretical exercise. If we are all in the pursuit of cheap and plentiful energy. And if, as part of that pursuit, you could choose between two options, you could either wave a magic wand and get a bunch of nuclear reactors scattered around America, or you could wave a magic wand and get huge advances in battery technology across America. Which of those would be most conducive to having that cheap and plentiful energy supply?
Yeah, I mean, I'm going to make a lot of my friends unhappy with this one, but I'd probably go batteries and storage. I think there are some natural economic advantages in wide swaths of the country for relatively affordable, even without subsidies, solar production in particular, and batteries seem like a pretty good natural match to that. It really has been, in the kind of Texas story to date, the pairing of batteries and solar together with natural gas additions that have supported really the only electricity market that has been growing without data centers. So I would take that as the leading indicator. That's not to speak ill of my friends in the nuclear bro community. I hope that
Many of whom
the
listen to this
technology
podcast.
advances that seem to be occurring in the small modular space come to fruition. So far, I don't see a lot of people laying down serious capital on that from a commercial perspective, but I do see people laying down money on storage.
I just have one last question, and it's kind of cheating. This question I'm kind of going to have you do our work for us, etc. Because, I'm trying to think of a really good title for this episode. But if you look out over the next 5 years, you mentioned adding a whole California to Texas. How are you thinking about the scale of the challenge overall that the U.S. electricity system, that the grid overall really faces in this moment? Like, how big is it that everyone from companies like yours to the various utility commissions, like, how big is this challenge going to be?
It could be a substantial one. I mean, I think that AI demand growth for electricity consumption is real. I also think that growth needs to pony up financial commitments to engender capital investments in the power sector that it intends to rely upon. I think those will be the table stakes of their social license to operate in a grid that, even where competition has been introduced, remains pretty heavily regulated. So I think we're going to get there. I do think that in terms of the regulatory policy that I deal with, there's too much small ball thinking on this, and there's too much trust in the way we've always done things. It's probably a time to really have kind of regulatory policy innovations like we've seen with the FCC regulating spectrum and the deregulation of the airline industry that tries to allocate the capacity on the grid to the highest value, the people who are actually willing to pay the most for it. And those payments, which would likely exceed the incremental cost of serving them, could then actually be a revenue source back to consumers that helps on the affordability side. So it's almost a call to your listeners that, if you're doing a mundane corporate job and want to do something completely different, consider becoming a utility regulator and applying some market-based principles to help solve some of these problems. Because really, when you think about it, utility regulation, they need to be an agent of capital formation here in the sector and to clarify this moment in terms of demand uncertainty. And that is the kind of challenge on a conceptual basis that we're grappling with.
Travis Kavula, we could talk to you for hours, actually, just on, I have a million more questions just about specifics from your time in Montana and how all those things work. But we'll let you go. Really appreciate your time. Let's do it again sometime. And I did learn a few things on this episode, so appreciate you coming on Odd Lots.
Thank you so much.
Thank you so much, Travis. That was great. You actually really respect Travis's call just then. If you're interested in markets and want to have an impact on people's everyday lives, consider trying to clean up the mess that is energy regulation.
But, even in the non-convoluted version of it, if we just imagine the platonic ideal of a normal market and there's this commodity, electrons, and it's, well, what if AI is this really valuable thing, and it's more valuable than blow drying your hair? I mean, for real, this could be a thing. Like, we were talking about making cars or making steel, etc., would be like, oh yeah, well, this is this value productive thing.
I wasn't going to do it. I wasn't going to, but now I'm going to bring up that time you wrote that mining crypto could theoretically be a more valuable activity than running a fridge.
Well, right. This is the question. In a normal market, the reason why that example seems absurd, I'm glad you actually brought it up. Because the reason why that example seems absurd is because very few people could ever wrap their heads around, well, could crypto mining be more valuable or value add than running a fridge? That being said, when it comes to something like AI, there really is a debate. And some people would say that's a total waste because AI is just a costly way to make fast poems. And other people would say, no, this is the fourth industrial revolution or whatever. And so I think part of the reason we're sort of uncomfortable with let's just move the electrons to where who's going to pay for them most is because I don't think there are a lot of people who intuitively are skeptical that this is a good allocation of real resources.
Right. I mean, I think politically, the message that the cost of your electricity has to go up so that AI can do its thing and you can lose your job is an extremely unpalatable one.
No, it's totally, I think this is why it's going to break a lot of people's brains. But on the other hand, if we accept that, the belief that markets are generally good allocators of resources, et cetera, they're like, well, it's not really our job to have an opinion on this is a good use, this is not a good use. But anyway, I did find that to be a very interesting conversation. It does seem like those commissions that have to decide what is an appropriate amount to spend on upgrades and capacity, they really have their work cut out for them right now.
Yeah. The way I would put it is they are not always the most popular people among their respective jurisdictions. That's for sure.
Well, someone has to have the job of doing the unpopular stuff, right?
Someone has to have the job of adequately compensating investors in utilities for the risks that they take on in providing a necessary commodity for life and the fourth industrial revolution.
That's right.
All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Travis Kavula. He's at T. Kavula. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. For more Odd Lots content, go to Bloomberg.com/oddlots. We have a daily newsletter and all of our episodes. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
कहीं सीलन की बूंदें आपके घर में भी संगीत बनके ना गूंजे, इसीलिए
streaming giant the winner in a bidding war with Paramount, Skydance, and Comcast. Bloomberg Intelligence media analyst Geetha Ranganathan says the deal could be better for Warner Brothers employees.
There's no global networks involved here. There's no studio that Netflix has. So I think in terms of the damage itself to talent, to Hollywood, this might be one of the more benign ones, I would say.
Geetha Ranganathan of Bloomberg Intelligence says the deal gives Netflix the HBO network and its slate of shows, along with Warner's vast archive of movies and TV programs like Harry Potter and Friends. Bloomberg News has learned banks are providing Netflix with up to $59 billion in bridge loans to finance the transaction. Warner Brothers shares in the pre-market are up about 1/3%. Netflix is moving lower. It's down 2.5%. Elon Musk's X has been hit with a $140 million fine under the European Union's controversial Digital Services Act. The European Commission says the social network formerly known as Twitter misled users with its paid blue checkmarks and stonewalled researchers' access to data. This is the first penalty under the EU's content moderation law. It's lower than expected, but it could still raise tensions with the White House. President Trump has repeatedly attacked the EU's tech regulations. Bloomberg News has learned that the U.S. lobbied several several European nations against an EU plan to back a massive loan for Ukraine with frozen Russian assets. We get more from Bloomberg's Stephen Carroll in Brussels.
Now, according to our reporting, US officials have argued these assets are needed to help secure the peace deal between Russia and Ukraine and shouldn't be used, as they put it, to prolong the war. This, as the debate has been raging among EU leaders about how exactly they're going to support Ukraine into the coming years as well. We're talking here about 210 billion euros worth of these frozen assets that are held on EU soil.
Bloomberg's Stephen Carroll. The State Department has yet to comment on our reporting. Meantime, the Trump administration says European civilization is at risk of erasure as a result of decades of economic decline, political censorship, and immigration. In a 29-page national security strategy published this morning and signed by the president, the administration says Europe's cultural and political failures pose a bigger threat to the continent's way of life than its poor economic performance. Back in this country, the Supreme Court is clearing the way for Texas to use a Republican-drawn congressional map in next year's midterm elections. The court's conservative justices lifted a lower court ruling that blocked the new map. Bloomberg Supreme Court reporter Greg Storr has more on the decision.
The first half of it is we think the lower court got it wrong, and the second half of it is this decision came too close to the election to take effect. With the first half of it, the court said that the district court did not honor what it called the presumption of legislative good faith. In other words, the lower court was too quick to assume that or to decide that the state was doing something it shouldn't do by using race too much.
Bloomberg's Greg Storr reports the court's 3 liberal justices said Texas's map could be an unconstitutional racial gerrymander. President Trump is standing by Defense Secretary Pete Hegseth after a string of recent controversies, including a second strike on a suspected Caribbean drug boat that left no survivors. Admiral Frank Bradley told lawmakers in a classified briefing on Capitol Hill that he was not given a kill-all order. Tom Cotton chairs the Senate Intelligence Committee.
I saw 2 survivors trying to flip a boat loaded with drugs down for the United States, back over, so they could stay in the fight.
Many Democrats say video of the attack may show a war crime. Hegseth is also under pressure over a Pentagon watchdog report about his use of his personal cell phone to share attack plans on Signal. On Wall Street, stocks are on track to set more records. Investors are all but convinced that the Fed will cut rates next week. That includes Bank of America CEO Brian Moynihan.
Our team believes the Fed will cut next week. They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
Bank of America's Brian Moynihan was on Bloomberg Television this morning, but a note today from B of A strategist Michael Hartnett says a year-end rally in stocks could be at risk if the Fed signals more rate cuts are coming next year. Hartnett says that could suggest a bigger than expected economic slowdown. But ahead of that decision next week, futures are rising. S&P futures are up 0.2%, Dow futures higher by 0.1%, NASDAQ futures are up 0.3%. Southwest Airlines shares are down 1.5%. The carrier cut its full-year profit target thanks to higher fuel prices and flight cuts from the government shutdown. Victoria's Secret is soaring, up 13.5%. The lingerie maker boosted its outlook and reported better sales than Wall Street expected, even with consumers showing stress in this economy. And that's news when you want it. With Bloomberg News Now, I'm Nathan Hager. This is Bloomberg.
Hello and welcome. This confirmed that the vessel was carrying illicit narcotics and transiting along a known narco-trafficking route in the Eastern Pacific. This latest attack comes as lawmakers are split after a classified briefing from Admiral Frank Bradley about another U.S. strike on a suspected drug boat in the Caribbean that killed 11 people in September. Democrats on the Intelligence and Armed Services Committee say they're horrified by footage showing 2 survivors of an initial strike then being killed in a second strike by the US, a violation of war rules, while Republicans are defending the strike, saying the video shows the survivors could have potentially handed drugs over to other boats in the area. Pentagon reporter Idris Ali says the scrutiny over the strike's legality comes at a delicate time for Defense Secretary Pete Hegseth.
This comes at a time when the Pentagon's Inspector General just released a report on the use of the Signal messaging app by him a few months ago. And so it's a key moment for Pete Hegseth, and people are watching closely whether President Trump, who is his boss, still has confidence in him. For his part, Trump has said he backs Hegseth, but it's really an interesting time because during the initial phases of the controversy around the Caribbean strike, even Republican lawmakers questioning what happened and what legal authorities went into the strike. And so I think the context these military officials provided with the strike that took place on September 2nd have really helped allay some of the concerns for Republican lawmakers. We're not seeing some of those heavy hitters questioning Hegseth in the same way, of course. The broader context is still important, right? The United States has carried out about 20 strikes, killed more than 80 people, and President Trump himself has said land strikes in Venezuela are next. So we've zeroed in on the September 2nd strike, but there have been questions about the legality of all the strikes that have taken place.
The U.S. Supreme Court has revived a redrawn congressional map in Texas, giving Republicans a major boost ahead of the 2026 midterms. The justices have lifted a lower court's block on the Trump-backed map, which could flip up to 5 Democratic seats. That lower court had ruled the map likely violated constitutional protections against racial discrimination. Republicans hold narrow majorities in Congress, so this decision matters. It strengthens Trump's push to keep control and underscores a nationwide fight over gerrymandering and voting rights. The FBI has arrested a suspect in one of the most notorious unsolved cases from January 6th, the person accused of planting pipe bombs outside the Democratic and Republican Party headquarters the night before the Capitol attack. The arrest of 30-year-old Brian Cole Jr. comes nearly 4 years after a massive manhunt that included a $500,000 reward and hundreds of tips. It also comes just months after the president pardoned nearly everyone charged in the Capitol riot itself. And to find out what's happening in the markets today, we've got Morning Bid's Peter Devlin. Peter, what do we need to know?
Morning, Kim. Today on Morning Bid, we talked about Netflix and Warner Brothers. The bidding war could be coming to close and Netflix is eking ahead, according to sources. As well, we look to the PCE numbers for the Fed could be critical in terms of a Christmas cuts. And finally, Zuckerberg could be scrapping the metaverse in terms of funding. Not great news for those looking for AI wearables. Please listen to more on Morning Bids.
Thanks, Peter. You can ask your smart speaker for Reuters Morning Bid, listen to it on your favourite podcast player, or watch it on Spotify. Anna Frioli reacting to the news that the Vatican has overwhelmingly voted against women serving as deacons, saying even our Lord had women who followed him, so we are not inferior to men, adding she wishes the Catholic Church would do more for inclusion in the 21st century. Discussions about women deacons in the 1.4 billion member church have been ongoing for the last decade. Deacons are ordained and can help with church services but cannot celebrate Mass, and the Commission has recommended further study of the issue. A warning that ICE vans have been spotted near Carmel Mall, also known as Somali Mall, in Minneapolis. Minnesota is home to more than 70,000 Somali Americans, and now many of them are staying inside, fearing they could be detained by ICE agents after President Trump called Somali immigrants garbage at a White House cabinet meeting on Tuesday.
The Somalians should be out of here. They've destroyed our country.
City Councilman Jamal Osman says that ICE are going door to door and stopping people in the streets.
They're not just targeting undocumented, they're targeting every Somali person. It feels like we are in, I don't know how to explain it, a war zone.
Inside the Carmel Mall, the emptiness is haunting. Shop owner Mohammed Amin Sharif says the Somali community is fearful.
You could see around the mall a lot of vacant stores, a lot of closed stores, and no foot traffic. People are hiding in their homes.
Baja Ali owns a cafe in the mall that just last week was buzzing.
They don't want to come out, and a lot of businesses are closed.
Now, Donald Trump is no stranger to putting his name on buildings. The latest to get a Trump rebrand is the United
गाइस ये क्रूड ऑयल में अपना एसएल कॉस्ट में रख लो, काफ़ी देर हो गई है, काफ़ी देर क्या मॉर्निंग से यहीं पर रुका हुआ है, ये ऊपर रेजिस्टेंस भी है इसलिए जा नहीं रहा लग रहा है, ऊपर से सेलिंग का प्रेशर कंटिन्यूसली आ रहा है, थोड़ा ऊपर जाके यहाँ से फिर गिरता तो बेटर रहता, अगर अब नहीं जाता है ऊपर तो देयर इज अ वेरी हाई चांसेस, क्योंकि हायर टाइम फ्रेम पे देखोगे कैंडल 4 आवर की लास्ट वाली क्लोज हो गई है, 5364 के नीचे अगर अब आता है क्लोजिंग बेसिस पे तो फिर नीचे ही जाएगा, मल्टीपल टाइम टेस्टेड हो चुका है, तो क्रूड ऑयल के इस बाइंग ट्रेड में कोई अगर रुका हुआ है तो पुट योर एसएल एट कॉस्ट टू कॉस्ट का एसएल जाता है तो एग्जिट कर लेना, डोंट होल्ड नाउ इट इज, ठीक है, इवन तो एसएल छोटा ही है 20 पॉइंट का, बट फिर भी मत करो होल्ड, मॉर्निंग से कुछ मोमेंटम ही नहीं हुआ, यहाँ देखोगे पूरा साइडवेज ही चला गया इसी सपोर्ट पे, इवन तो सपोर्ट तो नहीं है, काइंड ऑफ अ पॉइंट ऑफ इंटरेस्ट कह सकते हैं, बट अब नहीं जा रहा है ऊपर तो अननेसेसरी रिस्क नहीं लेना है, ठीक है, पुट योर एसएल ऑन कॉस्ट, हो सकता है बेस्ट तो ये है कि थोड़ा ऊपर जाए और यहाँ से गिरना ही है, तो वैसे तो ऊपर का लेवल ही मल्टीपल टाइम टेस्ट हो गया, बट एक आखिरी बार ऊपर से भी, अदरवाइज अपना एसएल कॉस्ट पर रखो, क्योंकि अगर अब नीचे आया तो फिर नीचे कोई नियर बाय सपोर्ट नहीं है, काफ़ी दूर ही बने हैं सपोर्ट। ठीक है, क्रूड ऑयल में यूएस मार्केट भी ओपन होने वाला है 8 बजे, पुट योर एसएल ऑन कॉस्ट।
Caribbean that killed 11 people in September. Democrats on the Intelligence and Armed Services Committee say they're horrified by footage showing 2 survivors of an initial strike then being killed in a second strike by the US, a violation of war rules, while Republicans are defending the strike, saying the video shows the survivors could have potentially handed drugs over to other boats in the area. Pentagon reporter Idris Ali says the scrutiny over the strike's legality comes at a delicate time for Defense Secretary Pete Hegseth.
This comes at a time when the Pentagon's Inspector General just released a report on the use of the Signal messaging app by him a few months ago. And so it's a key moment for Pete Hegseth, and people are watching closely whether President Trump, who is his boss, still has confidence in him. For his part, Trump has said he backs Hegseth, but it's really an interesting time because during the initial phases of the controversy around the Caribbean strike, even Republican lawmakers questioning what happened and what legal authorities went into the strike. And so I think the context these military officials provided with the strike that took place on September 2nd have really helped allay some of the concerns for Republican lawmakers. We're not seeing some of those heavy hitters questioning Hegseth in the same way. Of course, the broader context is still important, right? The United States has carried out about 20 strikes, killed more than 80 people. And President Trump himself has said land strikes in Venezuela are next. So we've zeroed in on the September 2nd strike, but there have been questions about the legality of all the strikes that have taken place.
The US Supreme Court has revived a redrawn congressional map in Texas, giving Republicans a major boost ahead of the 2026 midterms. The justices have lifted a lower court's block on the Trump-backed map, which could flip up to 5 Democratic seats. That lower court had ruled the map likely violated constitutional protections against racial discrimination. Republicans hold narrow majorities in Congress, so this decision matters. It strengthens Trump's push to keep control and underscores a nationwide fight over gerrymandering and voting rights. The FBI has arrested a suspect in one of the most notorious unsolved cases from January 6th, the person accused of planting pipe bombs outside the Democratic and Republican Party headquarters the night before the Capitol attack. The arrest of 30-year-old Brian Cole Jr. comes nearly 4 years after a massive manhunt that included a $500,000 reward and hundreds of tips. It also comes just months after the president pardoned nearly everyone charged in the Capitol riot itself. And to find out what's happening in the markets today, we've got Morning Bid's Peter Devlin. Peter, what do we need to know?
Morning, Kim. Today on Morning Bid, we talked about Netflix and Warner Brothers. The bidding war could be coming to close, and Netflix is eking ahead, according to sources. As well, we look to the PCE numbers for the Fed could be critical in terms of a Christmas cuts. And finally, Zuckerberg could be scrapping the metaverse in terms of funding. Not great news for those looking for AI wearables. Please listen to more on Morning Bids.
Thanks, Peter. You can ask your smart speaker for Reuters Morning Bid, listen to it on your favourite podcast player, or watch it on Spotify. Anna Frioli reacting to the news that the Vatican has overwhelmingly voted against women serving as deacons, saying even our Lord had women who followed him, so we are not inferior to men, adding she wishes the Catholic Church would do more for inclusion in the 21st century. Discussions about women deacons in the 1.4 billion member church have been ongoing for the last decade. Deacons are ordained and can help with church services but cannot celebrate Mass, and the Commission has recommended further study of the issue. A warning that ICE vans have been spotted near Carmel Mall, also known as Somali Mall, in Minneapolis. Minnesota is home to more than 70,000 Somali Americans, and now many of them are staying inside, fearing they could be detained by ICE agents after President Trump called Somali immigrants garbage at a White House cabinet meeting on Tuesday.
The Somalians should be out of here. They've destroyed our country.
City Councilman Jamal Osman says that ICE are going door to door and stopping people in the streets.
They're not just targeting undocumented, they're targeting every Somali person. It feels like we are in I don't know how to explain it. A war zone.
Inside the Carmel Mall, the emptiness is haunting. Shop owner Mohammed Amin Sharif says the Somali community is fearful.
You could see around the mall a lot of vacant stores, a lot of closed stores, and no foot traffic. People are hiding in their homes.
Baja Ali owns a cafe in the mall that just last week was buzzing.
They don't want to come out, and a lot of businesses are closed.
Now, Donald Trump is no stranger to putting his name on buildings. The latest to get a Trump rebrand is the United States Institute of Peace in Washington. USIP is a government-founded nonprofit that the Trump administration tried to seize control of earlier this year. On Thursday, the State Department said on X it had renamed it to the Donald J. Trump Institute of Peace to, quote, reflect the greatest deal-maker in our nation's history.
And thank you for putting a certain name on that building. I said, boy, that is beautiful. That blew up last night.
The rebranding came ahead of the signing of the Congo-Rwanda peace deal, which Trump held at the Institute. Here's White House reporter Trevor Honeycutt.
So we're seeing ongoing clashes right now between M23, that's a rebel group that's operating in eastern Congo, and the Congolese army. And that fighting continued the same day that we saw this peace deal signed in Washington. So there's clearly a disconnect between what's happening diplomatically and what's happening on the ground.
The Eurovision Song Contest has cleared Israel to enter the 2026 competition, prompting Ireland, Spain, the Netherlands and Slovenia to withdraw, citing the death count in Gaza and accusing Israel of flouting rules meant to guard the contest's neutrality. Israel accuses its critics of mounting a global smear campaign against it. Olivia Lepoidevin in Geneva says it's unprecedented for the European Broadcasting Union.
It has not faced an issue of this scale before in terms of the number of countries asking for another country, in this case Israel, to be excluded from the competition, of which is said to be non-political. It should be a competition which unites the world through cheesy pop music. And this would run quite contrary to that.
And for today's recommended read, Assad's exiled spy chief and his billionaire cousin are spending millions plotting Syrian revolts from their exile in Russia. And Syria's government has deployed another ex-Assad insider, a childhood friend of the new president, to neutralize them. There's a link to that story in the podcast notes. Plus, a recommended listen. This weekend, Christopher Walljasper takes us on assignment to Kenya, where the real-world impact of the Trump administration's cuts to US aid are hitting hard. That pod drops on Saturday. For more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favourite podcast player. If you're listening on a smart speaker, just ask for the latest news from Reuters 7 days a week. We'll be back tomorrow with our daily headline show.
November 5th. Well, let's talk about Warner Brothers, Peter. There were 3 suitors to buy the company: Netflix, Paramount and Comcast. Now it looks like Netflix has pulled ahead and is reportedly in exclusive talks that could be announced as soon as today.
Well, it seems that Netflix were always the front runner in this. It was going to take extraordinary amounts of cash, and Netflix has the money. If we look at the numbers, Warner Brothers was valued about $60 billion before the deal, before they were on offer. And now it's looking at with the $30 a share, it could be at $75 billion worth valuation, and Netflix can't afford that.
There are major antitrust concerns here, though, aren't they? This deal would have to be signed off by the Trump administration. And if Netflix has a tie-up with Warner Brothers, which of course also owns HBO, that's a lot of viewers concentrated in one place. Could politicians object to this?
Well, such a dominant streamer such as Netflix, I think this deal would make 450 million subscribers globally. That's a lot of people. And really their only defense is that they would lower prices. I think this could come to antitrust concerns. I mean, we know that President Trump is very close to Paramount. I mean, the reason that Rush Hour 4 is being made reportedly is because he's pushing on them and he wants it. Could he step in and really sputter on the deal? I mean, I've seen stranger things.
Well, we did think that Paramount was the lead bidder in this. Of course, CEO David Ellison's dad, Larry Ellison of Oracle, is a major donor to the Trump administration. So this is a surprise in some ways. And Netflix, of course, only want to buy the streaming business and the film and TV studios. Paramount wanted the whole company. So it might not be the end of that story. But we have to talk, of course, about the Fed. And we've got those PCE inflation numbers out later today, the Fed's favourite measure of inflation. What are we expecting there?
Well, these are delayed numbers as well from the ongoing government shutdown that has finally ended a few weeks ago. Looking at the numbers, we're expecting core to come in at 0.2%. That would be third straight month of that reading. That would put annual at around 3%, showing inflation is stable, but still sticky, still stubbornly high.
Markets don't think the Fed cares about that right now, though, do they? I mean, they see the chance of a rate cut next week at, I think, 87%. That's despite the fact that labour market data has been fairly inconsistent, hasn't it? Jobless claims came in low yesterday after the day before ADP payrolls were the worst in, I think, more than 2.5 years. Why is this happening?
Well, we look at Challenger job cuts as well yesterday, and they showed that, again, job cuts were far less than expected as well compared to the previous month. And in terms of inflation, yes, December cut looks pretty baked in now. I don't think anything's going to stop them. But the calls that it's anchored surely can't be true. We look at next year, and I think that's going to be a big conversation for the Fed.
Well, of course, markets are much more interested in what's going to happen going forward and are now pricing in a fairly aggressive series of cuts. This week, we discover that White House economic advisor Kevin Hassett is apparently the name in the frame to be the next Fed chair. And so increasingly, markets are pricing in that he's going to follow what we know that President Trump wants and deliver that series of quite aggressive cuts.
Well, this is where I disagree with the markets because, I mean, it's not surprising that the market is overly aggressive on this easing bets. But overall, the Fed is an open committee, and one more dovish, let's say, central bank chair may push the debate, but it is a debate at the end of the day. And at the end of the day, it will be the economic narrative that will decide how the Fed eases. And as the inflation maybe rises with tariffs, we'll see how that goes next year.
That's a good point, isn't it? He's only one voice among many. And as the current Fed chair, Jerome Powell, has emphasised over and over again, they are focused on the economic data. So it will all depend really on just how weak the US job market really is. Of course, we won't get hard payrolls figures from the Labour Department until after they've voted on rates next week. So everything's still quite up in the air. But let's talk also about Meta, where apparently the metaverse is going out of the window.
Well, this sector was always bleeding money. I think it's lost about $70 billion since it started in 2021. Investors wanted it to go. They wanted to push some of the resources in the other AI developments of the company. It might hurt for Zuckerberg, though. I mean, he changed the whole name of the company from Facebook to Meta because of the metaverse.
Well, that never went down very well with investors in the first place when it was announced in 2022. They were never convinced that we were all going to be putting on our virtual reality headsets and living in the metaverse. Zuckerberg still believes wearables are the future. He now thinks that it's those AI-enhanced smart glasses that will replace our phones everywhere, doesn't he?
Well, yeah, it's all going to wearables. We'll see if that actually pays off. To me, I really see that it could be some frugality coming into these big mega capped tech stocks, and maybe that's the narrative next year. Meta is one of the biggest spenders in terms of data centers and AI chips. Could we start seeing tightening of the purse strings across all the Magnificent Seven?
Well, investors seem to like that idea, don't they? Meta's stock was up as much as, I think, 7% yesterday on that news. And for today's recommended read, check out Jamie McGeever's column for a deeper dive into how much Americans are really struggling with the cost of living.
For more of any of today's stories, head to Reuters.com or the Reuters app. Follow us on your favorite podcast player, and if you're on a smart speaker, just ask for the latest market news from Reuters 7 days a week.
And we'll be back tomorrow.
गाइस यूएस मार्केट ओपन होने वाला है, अपना एसएल रख लेना कॉस्ट पे क्रूड ऑयल में, ठीक है। पुट योर एसएल एट कॉस्ट, लेट्स सी व्हाट हैपन एट यूएस मार्केट ओपनिंग। अगर ये नीचे आता है कॉस्ट टू कॉस्ट तो निकल जाना है, फिर होल्ड मत करना। ऊपर जाता है तो वेल एंड गुड है, ऊपर से फिर से सेल प्लान करना। अगर ऊपर नहीं जाता है, नीचे आता है, तो फिर लेट इट गो, कॉस्ट कॉस्ट पे निकल सकते हैं। बाकी नेचुरल गैस रुक ही नहीं रहा है, कम्प्लीटली अपर सर्किट लगने के बाद भी कंटिन्यूएशन में ही है अभी भी, कम्प्लीटली बुलिश।
I want to say on the record here that the subject line of the calendar invite for this recording session is FOIA : Epstein/Santa. It makes me wonder, like, wouldn't that just be the ultimate kick in the face of 2025 that Santa Claus is on the Epstein list?
Well, for the record, we're not talking about Santa right this second. That's a different episode. I want to talk about how the FBI turned over dozens of emails to me that revealed details about how hundreds of the Bureau's special agents and personnel from the Freedom of Information Act office reviewed and processed the Epstein files earlier this year. Plus, the best chance for getting the Epstein files released. Let's go! I'm investigative journalist Jason Leopold. I spend most of my days getting documents from the government.
I'm attorney Matt Topic, and I fight them in court to open their files when they don't want to.
From Bloomberg and No Smiling, this is Disclosure, a podcast about prying loose government secrets, the Freedom of Information Act, and the unexpected places that takes us. Now, before we get into the documents I recently pried loose and the rest of it, let's just recap what happened in Epstein land these last few weeks. So, Matt, Congress has now passed a bill which is called the Epstein Files Transparency Act that compels the Department of Justice to release their files on Jeffrey Epstein within 30 days. And President Trump has already signed that into law.
Yeah, I thought that the speculation about would Trump sign it or not, what's kind of funny is like he has the power himself to order the DOJ to release this. He doesn't need Congress in order to do that. It seems like it's taking an act of Congress to make them do it, but it always felt a little weird to me, like he's signing a bill that's saying do what you ought to be doing.
Yeah, he could have released this at any time by just calling for the Justice Department to release it, which is exactly what he has done on other high-profile political matters earlier this year.
Donald Trump has just said that he is going to release the files around the death of President JFK tomorrow.
The Trump administration has gone public with more than 230,000 pages of records related to Dr. Martin Luther King Jr.'s assassination.
But what's interesting about this Epstein Transparency Act is what it allows the Justice Department to do. And it allows them to withhold certain information, particularly information within these files that could interfere with an ongoing law enforcement investigation, which in FOIA land, Matt, we like to refer to as the B7A.
Well, B7A. But the investigations that would be the predicate for that are what? Like the president had requested that Attorney General Pam Bondi open some investigations into Bill Clinton and some other Democrats or democratically inclined people that I believe the Truth Social post or whatever it was he posted it in, like specifically referred to Democrats. So just openly saying, I want you to investigate some Democrats about this. And not surprisingly, they're going to do that, it seems.
But that directive by Trump came 1 week prior to the passage of this bill. And what we don't know is, what does an investigation like that look like? What are they going to investigate? So Trump delivering this directive via Truth Social to Pam Bondi. So that means that, whatever Epstein files they may have that relate to these folks could arguably be withheld.
Yeah, I mean, I think that if they pull that, there's a lot of angry people already about all this. If they now pull the rug out again and say, hardly release anything because of these ongoing investigations, I don't know what's going to happen. I think there's going to be a lot of people that are going to be very upset about that.
So, Matt, this kind of gets at a fundamental question when we talk about the release of the Epstein files. When we say Epstein files, what are we actually talking about? This is a guy who was investigated by federal authorities starting around the mid-2000s. He signed a controversial plea deal and did some light prison time. And then he was arrested again in 2019 and accused of sex trafficking minors. And the idea is that those investigations threw up a lot of paperwork, presumably about interviews with victims, evidence, names of associates, and co-conspirators. So now, with the Epstein Files Transparency Act, there's going to be a lot of discussion of what gets released and what may get withheld. So the point of this, Matt, is that over the past year, I've been doing some document requests and following some other FOIA actions related to Epstein. And it all helps us get a handle on what's in the Epstein files and how the government has been handling them. And as you know, Matt, this has been building since Trump took office again in January. A lot of Trump's supporters want this information out in the public, and Trump seemed to say during the campaign that he'd do that. But by the summer, that was looking less likely. So in July, the Justice Department and FBI released a joint statement that said, "It is the determination of the Department of Justice and the Federal Bureau of Investigation that no further disclosure would be appropriate or warranted."
Cue the outrage.
Yeah.
Right? I mean, there are a lot of people for whom this is the most important issue in American politics right now.
Well,
and you're just telling them, we changed our mind. There's nothing to see here. Move on.
Yeah, and this is the biggest political story of the year. So earlier this year, I filed a wide-ranging FOIA request for everything related to the processing of the Epstein files. I was really interested in how the records were processed, and I was even more interested within the context of how everything went down with the rollout of the Epstein files earlier this year. What I was hoping was to get a look at what was going on behind closed doors with the Epstein records, going back to the beginning of the new administration. And remember, Matt, just a few weeks after Trump was inaugurated, back in February, his brand new Attorney General, Pam Bondi, calls a group of right-wing influencers to the White House for an event because she has something to give them.
They walked out of the White House holding binders
and hands them binders.
Look at what we got today.
That say Epstein Files, Phase 1.
See that right there? That's the Epstein Files.
Bondi has this kind of grand rollout. And so shortly thereafter, I mean, I want to say more, like almost immediately thereafter, the MAGA crowd goes nuts.
We frankly assumed this had at least some smoking guns. And now
it's a backlash.
That's not what's in this binder at all.
It's a backlash against Bondi. It's a backlash against the FBI.
It is the biggest disappointment, I think, that you'll find.
Because it turns out that these documents that were in the binder had been previously released in court cases and previously released by the FBI. So it ignited a firestorm.
This is kind of their own folks, right? They invite all these people that are kind of from the MAGA world. And do they think they're so stupid that they're not going to realize that these documents have already been out there? I mean, of course, folks are going to pick over every document. And like, was this just incompetence, or were they trying to pull a fast one? Or
well, I don't think they actually pulled a fast one. I just don't think they actually even looked at any of the files they were going to release. And so what happened after that is Bondi, who had been really embarrassed by this, fires off a letter.
In a letter to FBI Director Kash Patel, the AG demanding the release of the Bureau's full and complete Epstein files.
So she's throwing Kash Patel kind of under the bus here. Like, hey, what are you guys doing? This stuff has already been released.
Exactly. And she kind of blamed him for this. She says, I repeatedly questioned whether this was the full set.
गाइस ये क्रूड ऑयल में चाहो तो थोड़ा प्रॉफिट बुक भी कर सकते हो, एसएल कॉस्ट पे रख के अब छोड़ दो, ऊपर जाएगा तो जाएगा, ठीक है, एसएल कॉस्ट पे रख के छोड़ देना, अब डोंट टेक द रिस्क। अगर थोड़ा ऊपर आता है अपसाइड की ओर तो इसमें भी एक सेलिंग का प्लान रखना। बाकी इसमें भी सेलिंग आप ये मान के चलो ये लास्ट टाइम ही है, क्योंकि ये लेवल मल्टीपल टाइम टेस्ट हो चुका है, क्रूड ऑयल का भी ब्रेकआउट आया तो फिर ठीक ठाक ही चला जाएगा ऊपर। ठीक है, बाइंग वाले ट्रेड में एसएल कॉस्ट पे रख देना, रिस्क नहीं लेना आप। बाकी काफ़ी देर हो गई है, पैटर्न तो ब्रेकआउट का ही है, ऊपर जाना चाहिए। लेट्स सी कितना देर और लगाता है ये। काफ़ी देर के बाद आया है मोमेंटम। मार्केट ओपन हुआ है इसलिए वॉल्यूम आ रहा है, एक्सपेक्ट करते हैं कंटिन्यूएशन होना चाहिए वॉल्यूम का। नेचुरल गैस भी सुपर बुलिश है। 4 आवर की कैंडल देखते हैं क्लोजिंग आती है या फिर नहीं। क्या मोमेंटम आया है, सिंगल कैंडल ऑलमोस्ट 5%। लास्ट टाइम सिंगल कैंडल पे 4 आवर की इतना बड़ा मोमेंटम रिसेंटली कहीं देखने के लिए नहीं मिला है, जहाँ 5% से ज़्यादा एक कैंडल पे मूव हो गया हो प्राइस। यहाँ पर डाउन साइड पे एक सेलिंग आई थी, बाइंग 5% के अराउंड सिंगल कैंडल पे। यहाँ भी नहीं है, ठीक है। यहाँ आया है लास्ट 5th ऑफ सितंबर 2024। उसके बाद आ जा रहा है इंट्राडे में इतना बड़ा मूव। ऊपर तो रेजिस्टेंस भी नहीं है कुछ, अपना ही बना दे 15 मिनट में एक फेक ब्रेकआउट करके तो ही हो सकता है मोमेंटम। सेवन 7.20% डबल अपर सर्किट, सेकेंड अपर सर्किट के अराउंड जाता हुआ। परसेंट पे सेकेंड अपर सर्किट लग जाएगा। सिक्स 600 ही जाने वाला है क्या, बिल्कुल 520। सुपर बुलिस, सुपर डुपर बुलिस। नेचुरल गैस विंटर आते आते फिर से अपना मोमेंटम दिखाता हुआ। मंथली टाइम फ्रेम पे देखोगे या इवन डेली टाइम फ्रेम पे देखोगे एंड वीकली टाइम फ्रेम पे देखोगे, जहाँ पर भी देखोगे कंप्लीटली बुलिस है, कोई पुल बैक ही नहीं है। अक्टूबर से कंटिन्यूसली, अक्टूबर भी नहीं कहेंगे, हाँ अक्टूबर से कंटिन्यूसली मंथली टाइम फ्रेम एज वेल, सितंबर से कंटिन्यूसली बुलिस।
Here's the review.
So it appears around May 2nd is when they kind of wrap things up. An FBI employee from the New York field office sends an email and attached a document titled Epstein Overview Final that summarized their work.
Well, what does it say?
Unfortunately, the FBI withheld the attachment.
No.
So they withheld those attachments, citing a number of different FOIA exemptions, such as attorney-client privilege, the deliberative process, and others.
So they're taunting you. They're taunting you by telling you what's there, but that you can't have it.
Can I tell you that as I'm reading these files and the subject lines refer to a PowerPoint or a document, I'm like clicking. I'm clicking to see if there's any chance that like it will magically open up.
Any luck?
It did not.
Bummer.
But importantly to me, like this is the biggest standout on these records. So I asked how much money they spent on overtime, for example, for agents who are tasked with processing these records. So go to page 14 of the release.
Okay, so I'm looking at it's a chart, and then the division name column says Business Strategy and Analytics section, Counterintelligence Division, Counterterrorism Division, Criminal Investigative Division, Cyber Division, Directorate of Intelligence, EAD Information and Technology Branch, Finance and Facilities Division, Human Resources Division, and then everything else is withheld for secret investigative techniques that, if released, would harm some future investigations.
So these are all the divisions that were involved in the review of the Epstein files. And how do we know that? Because the government released an index of what I requested, and the FBI document types is how they refer to it. And this is a resource planning office, that's an office within the FBI, report that documents the premium pay hours. And premium pay is overtime, nighttime differential hours, but more or less you could think of it as overtime. And it's the number of hours they recorded on this project, right? That's how they refer to it, the Epstein files. They refer to it as a special redaction project. And it's during the period of March 17th through March 22nd. So five or 6 days, right?
So they're withholding from you the total amount of pay across each of those.
Right.
But they are giving you the grand total of employees worked, premium pay hours total, and premium expenses. So they don't want to give you the breakdown, I guess, on the theory that somehow you could interfere with an investigation if they knew the specifics of how they staffed this up. But you at least know the totals.
Yeah, and those totals are kind of stunning. There were 934 employees that were involved in the processing and review of the Epstein files. 14,278 premium pay hours worked for a total of $851,344 that the FBI spent on premium pay during the March 17th and March 22nd review of these files. I mean, that's a lot of money. That seems like a ton of money to me for the FBI to spend on this. I mean, it wasn't a national emergency.
Well, it depends who you ask.
Yeah, true.
I mean, I think there's a sizable number of people, and I think they probably are skewing towards Trump supporters for whom, like, this is like
right.
So I'm looking at these numbers. I'm seeing 850,000, and that's just the overtime. So, it's possible that the overtime might only be like maybe half of the total cost. So you could easily be looking at like a couple $1 million total that people are just working, which means they're not in the field investigating crimes. They're not in the office processing Jason's other FOIA requests. Like, it's sort of, they drop everything. This is what they're doing. And all this work gets done. And then Pam Bondi says there's nothing to see here. So nothing more is going to get released.
Right.
So it sounds like by May 2nd, they've pretty much wrapped up. And then in May, DOJ tells Trump that his name appears in the documents.
Yeah, that's the timing of it. And shortly thereafter, we have this unsigned memo saying that they collected 300 gigabytes of data, which is video, photographs, actual documents, and none of that, not a single document from that trove, can be released.
All right, well, the clock is ticking on the 30-day Epstein Transparency Act deadline. So I guess that work wasn't a waste, because it's going to probably come in pretty handy pretty quickly. It's a good thing that they already did all this back in the summer. Hopefully we're going to start seeing some more stuff.
I want to segue into what may be in the Epstein files. So earlier this year, I wrote about the under the radar Freedom of Information Act lawsuit that was filed back in, I think it was 2017. It's a nearly 9-year-old lawsuit that an attorney named Dan Novak filed on behalf of a reporter for what was Radar Magazine at the time. This FOIA lawsuit that he filed, they were trying to get, at that time, all of the FBI's Epstein files. And in this lawsuit that had been going on now for nearly 9 years, the FBI released about 1,200 pages of documents. And these are the 1,200 pages, more or less, that have been screenshotted and shared on social media. And
is this the same stuff that was in the famous binders, the Pambandi binders?
Exactly.
Where people who've been following this are like, what is this trash? We've already seen this.
Right. That's exactly right. So here's what happened. I dig into this case, and the FBI and the Justice Department essentially withheld the vast majority of records, at least 10,000 plus pages, because of an ongoing investigation. First, I should go back and say they denied the request before they moved to a lawsuit. They said to the reporter that you need to have a privacy waiver. You need to get Epstein to sign a privacy waiver before we turn anything over. Right?
And he's still alive then in 2017.
He's still alive. So they're going down the road of privacy waiver and a privacy exemption. They sue, right? And so you know how it is. I mean, we both know how it is. If this is dragging out for a while.
But this is really long. It's
really long. The next thing you know, what happens is, I'm fast forwarding here, but Epstein gets arrested. And so now everything is being withheld under B7A, an ongoing law enforcement proceeding. So they're not getting anything. They're still arguing, going back and forth. So these folks just continuously hit roadblocks and roadblocks and roadblocks, and they're just unable to pry anything loose, but they're fighting. They're continuing to fight, right? I respect that.
It's nice to hear you not be mad at other people making FOIA requests and filing lawsuits.
Yeah. I mean, I like when other people file FOIA requests and lawsuits, as long as it's not for the same records I want.
Fair.
So I go into the docket of this FOIA lawsuit that Radar filed, trying to make these Epstein documents public. And on the docket is what's called a Vaughn Index. This specific document is very important as far as the Epstein files are concerned. But before we get into that, Matt, can you explain what a Vaughn Index is and the old FOIA lawsuit that gave rise to it?
Yes, Jason. It comes from a case called Vaughn versus Rosen in, I think, kind of like the 1970s. And what used to happen is agencies would withhold a bunch of stuff, and then they would just dump all the documents on the court in the lawsuit and be like, here you go, court, you tell us. Like, it's called in-camera review, like where the court in chambers, not in public, reviews these documents. So agencies were just kind of like dumping all this stuff. And eventually the courts are like, yeah, we're not cool with that. You've got to make an index of what all these documents are, describe them, at least in some level of generality, and identify the specific exemptions that you're claiming for each one of those. So that has become known as a Vaughn Index. So it's what it sounds like. It's a listing of all the documents. And sometimes the Vaughn Index can have a whole lot of interesting information, even if you can't get the documents.
Right. And we've received many Vaughn indices in our FOIA lawsuits.
Yeah, routinely.
Yeah, and they're extremely valuable just to even have a general overview of what the documents are that they're withholding. So
who's talking to who and when they're talking. Like, even if you don't know what they're saying, it can be really interesting. Like, oh, this person was involved. Or, that timing is really interesting as to when things were happening. And you can usually get those kinds of details.
Yeah, and I feel like they're newsworthy and you could write a story out of it.
You have written stories out of it.
Oh, yeah. I thought this one was really important, and it doesn't seem like anyone, even knew it was out there. It had some pretty damn good detail of what the documents are that the FBI had as it relates to Jeffrey Epstein. And obviously it's a sliver, but what would be in the Epstein files that are now supposed to be released. And the index says that the FBI processed but withheld information it obtained from confidential sources, letters addressed to then U.S. Attorney for the Southern District of Florida, Alex Acosta. He was the one that ultimately authorized that non-prosecution agreement with Jeffrey Epstein. Subpoenas to MySpace. Remember MySpace?
Oh, yeah.
That's specifically in this Vaughn Index. the handwritten notes of FBI agents, photographs, grand jury subpoenas.
This is all listed out
records.
in the Vaughn Index.
Yeah, and bank records, communications with foreign government agencies. I thought that was really, really interesting. Of course, there are 302s. Tell everyone what FBI 302 is.
FBI 302 is a summary of a FBI interview with someone.
So in this Vaughn Index, so I counted, right? Because it describes the 302s here. And mind you, this index relates to the investigation that the Justice Department and FBI took on between 2006 and, when Epstein pleaded guilty in 2008. So I counted, and it reveals that the FBI conducted, at least according to this Vaughn Index, 55 interviews with witnesses, victims, potential investigative targets, and importantly, bank records. So, I'm hoping we get a chance to see those. But here's what I really zeroed in on, is that it shows that some of the documents that were processed and withheld from Radar magazine are from 2011 and include dozens of photographs and agents' interview summaries of third parties and documents provided to the FBI by confidential sources.
That's 2011.
2011.
And
So
he
it
gets
looked like-
charged in 2019.
No, so we're only talking about the first investigation, right? 2006 through 2008. But it looks like the FBI never really closed it, that it remained active because there's documents from 2011. So I just wanted to get your take on this because we've dealt with the FBI a lot. Do you think that people may have just been coming in and just collecting evidence and submitting it to the investigative file? Or could this be kind of evidence that the FBI still had an active investigation in 2011, 3 years after Epstein had pled guilty and at that point was already out of jail?
I mean, that's pretty hard to tell. I mean, wouldn't surprise me if victims and others continued to come to the FBI for good reason, dissatisfied with the minimal punishment that he had gotten to that point. And whether the FBI did anything with that, we really don't know, unless the Vaughn Index shows more activity at the time. But if all you have is a listing of a bunch of 302s of witness interviews, that it's hard to really say if they were actively investigating or just sort of passively receiving information.
Right. Yeah. And based on my reporting, the FBI doesn't typically close investigations. They're sort of keeping it open. That's just
that would
my
make
experience,
sense.
Right?
In these circumstances, that would make perfect sense.
Yeah, and I didn't see anything in the Vaughn Index that indicated there was a case closing memorandum, an actual document there. So I dug into this over the summer. This was during that time where everyone was just kind of clamoring these Epstein files because this was immediately after the Justice Department FBI said we're not going to release anything. So now Radar Magazine is 8 years into its lawsuit to get the Epstein records. At this point, they know the FBI has reviewed the records, and the FBI and the DOJ say they're not going to release more records. So the Radar lawsuit has some new urgency. It looks like they have a pretty clear path to say, you have to release the records. But then Ghislaine Maxwell appeals her case.
Ghislaine Maxwell, we now see that her attorney renewing his request for the Supreme Court to overturn her conviction.
So there's Radar Magazine again with oh man, this is still an ongoing law enforcement proceeding. So they still can't get anything. And now that the Supreme Court has rejected Maxwell's petition, Dan Novak and Radar Magazine has now appealed to the Second Circuit. And so there's an oral argument set for January 28th. So I still think, Matt, I just want to see what you think. This FOIA case is the best chance of getting anything from the Epstein files versus Congress's Epstein Files Transparency Act.
Yeah, I think for a couple reasons. I mean, first, I think that the Vaughn Index is going to be a check on whatever gets released. If you see that there's things on the Vaughn Index that don't get released, then there's some splaining to do, right? But the lawsuit also has teeth. The Epstein Act has no teeth. If DOJ decides to violate it, there's no private cause of action. You and I can't file a lawsuit over that. You need to have a FOIA case. And so that case could end up being the legal vehicle by which the Epstein Act release actually gets challenged. I mean, there's so many twists and turns to this, and like people get charged and people die, and it impacts what can be withheld or not, and it's up and down on appeal and all this stuff going on. And so that's got to be frustrating to go on for that long. But now it almost turns out, it does turn out that like it's great.
Right, exactly.
That there is a live active FOIA case right now that can be the vehicle by which, if the DOJ is trying to get away with withholding things, that's how they can be held accountable for that, and how courts can guarantee and the public can guarantee that they're actually releasing everything that they're supposed to release. Because the track record ain't that great so far.
That's kind of how I felt as well. It's like, this is really the best course of action for the public to kind of see what's going on. It will be interesting if the government argues that, well, Donald Trump has now called for an investigation into Democrats, so we're going to keep withholding it because of an ongoing investigation.
Yeah, and that's, I mean, it depends on how bold they are on trying to make those withholdings. And I think they're, given the memo from July, if I was representing you right now in a case on this and they said, oh, well, there's these investigations, I think you can make the argument that's a sham. They already said that there isn't any predicate to investigate anybody else.
That's right. And DOJ and FBI said in their joint statement from July, quote, there was also no credible evidence found that Epstein blackmailed prominent individuals as part of his actions. We did not uncover evidence that could predicate an investigation against uncharged third parties.
So the fact that they're now claiming they're going to do investigation, it's not a real investigation, so it doesn't count for FOIA purposes. That's how I would argue it. I don't know. I think there's a fair chance of succeeding on that, but no guarantees.
I mean, the timing couldn't be better for Radar Magazine, right? They filed this back in 2017, so they're coming up on 9 years. That's a really long time. But man, the fact that they're still fighting at this very moment where the Epstein files have become the biggest political story of the year, that's wild. So as I mentioned, there's a hearing in the Second Circuit, an oral argument that's scheduled for January 28th.
And let me just explain. So that's the Court of Appeals that covers the trial courts that are in New York and some other adjacent states. The country is divided into a series of different regional courts of appeal. So it's above the trial court and it's before the Supreme Court.
An oral argument? Explain it, Matt.
Oral argument is the parties have filed their briefs and then they come in and they answer the judge's questions and they make their arguments. And those are open to the public. I got a feeling that's going to be a packed courtroom with overflow rooms.
Yeah. And it's interesting because it's coming, it's happening right after kind of the deadline for when the Justice Department is supposed to turn over everything in the Epstein files. So I just want to ask you this question, Matt. So let's say the Justice Department does turn over everything in the Epstein files to Congress as they're required to do under the law. Would those same records be responsive to this FOIA lawsuit?
Well, the scope of that request was like all records from the FBI's investigation, right? All documents relating to the FBI's investigation and prosecution of Jeffrey Epstein. Now, they made the request in 2017.
Yeah.
There could be a dispute about whether documents after that date get included or not. I mean, it certainly would be cut off at whatever point the FBI searched, then that would typically be the cutoff. Sometimes it's the date of the request, sometimes it's whenever they do the search. So there could be some later stuff like, because when did he die? 2019?
2019.
Yeah, so there's a couple years there.
2019.
There may be a little bit of a delta.
Well, I guess we'll see what happens, whether or not the Justice Department releases the Epstein files to Congress. And I guess we'll see what happens in late January in the Radar FOIA lawsuit for the FBI's files on Epstein. From Bloomberg and No Smiling, this is Disclosure. The show is hosted by Matt Topic and me, Jason Leopold. It's produced by Heather Schroering and Sean Cannon for No Smiling. Our editor for Bloomberg is Jeff Grocott. Our executive producers for Bloomberg are Sage Bauman and me, Jason Leopold. And our executive producers for No Smiling are Sean Cannon, Heather Schroering, and Matt Topic. The Disclosure theme song is by Nick with additional music by Nick and Epidemic Sound. Sound design and mixing is by Sean Cannon. For more transparency news and important document dumps, you can subscribe to my weekly FOIA Files newsletter at bloomberg.com/FOIA Files. That's FOIA Files. To get every episode early on Apple Podcasts, become a Bloomberg.com subscriber today. Check out our special intro offer right now at Bloomberg.com/podcast offer, or click the link in the show notes. You'll also unlock deep reporting, data, and analysis from reporters around the world. We'll see you again next Tuesday.
Okay. Opening the link.
गाइस क्रूड ऑयल में यहाँ पे प्रॉफिट बुक कर लेना, ठीक है। एंड सेलिंग में जा रहे हैं तो ओवरनाइट होल्ड मत करना, ऑब्वियसली इतना बड़ा फॉल तो नहीं करेगा प्राइस, थोड़ा बहुत सेलिंग जरूर आएगी बट ज़्यादा एक्सपेक्टेड नहीं है। डोंट होल्ड ओवरनाइट पोजीशन, बाकी बाइंग वाले निकल जाना।
कहीं सीलन की बूंदें आपके घर में भी संगीत बनके ना गूंजे, इसीलिए घर बनाएं ACC गोल्ड वाटर शील्ड सीमेंट के साथ।
News when you want it with Bloomberg News now. I'm Nathan Hager. It is a deal that's set to shake up Hollywood again. Netflix is buying Warner Brothers in a tie-up that values the iconic movie and TV studio at almost $83 billion and gives the streaming giant HBO and Warner's vast content library. Bloomberg's Felix Gillette reports it is yet another seismic shift in entertainment.
We're just talking 3 years ago, we heard the argument that combining the Warner Brother assets with the Discovery assets was going to unleash all of this synergy that was going to better position this company to take on Netflix. And here we are 3 years later after Zaslav made that argument to all of us, and he's saying, you know what, like, you know what would be really great is combining these assets with Netflix.
Bloomberg's Felix Gillette reports Netflix has lined up $59 billion in bridge loans to seal the deal, but it could face regulatory scrutiny. CNBC is reporting that the White House sees heavy skepticism on the tie-up. Right now, Warner Brothers shares are up more than 3%. Netflix is little change to the downside, and Paramount Skydance, which had set off the bidding war, is down more than 6%. The broader market is moving higher on the first boost in consumer sentiment in 5 months. Bloomberg's Matt Miller has the numbers from the University of Michigan's preliminary December sentiment index.
53.3, and that is better than expected and better than the previous reading. 52 was the survey, and 51 was the previous reading. This is a good number, especially when coupled with the fact that inflation expectations, according to the University of Michigan, have fallen. 4.1% is the one-year inflation expectation. We were looking for 4.5%. 3.2% is the 5 to 10-year inflation expectation. We were looking for 3.4%.
Bloomberg's Matt Miller. And we also got government shutdown delayed economic data for September. Consumer spending stalled that month, while the Fed's preferred read on inflation, the PCE index, rose 2 0.2% from August. Right now, though, the S&P 500 is higher by 0.6%. The Dow Jones Industrial Average up 0.5%, and the Nasdaq Composite is higher by 0.75%. The S&P 500 is close to the 6,900 level right now. The White House says Europe is facing civilizational erasure from decades of economic decline, political censorship, and immigration. This latest broadside against the continent comes in a 29-page national security strategy signed by President Trump, and it comes as the president gets ready to welcome the world to next year's FIFA World Cup. He's hosting the draw for that event today with the leaders of Canada and Mexico. Bloomberg Government's Maeve Sheehy has more from Washington.
It might be a bit awkward. You've got all of these tensions between the U.S. and Canada and Mexico, and then everyone's coming together for this FIFA draw, which Trump has really trumpeted.
Bloomberg Government's Maeve Sheehy reports the draw is colliding with President Trump's migrant crackdown. Mexico says President Claudia Sheinbaum will meet with Mexican immigrants after today's draw at the Kennedy Center. Bloomberg News has learned the U.S. lobbied several European nations against an EU plan to back a Ukraine loan with frozen Russian assets, arguing those funds should be used to back the U.S. peace plan, not to prolong the war. We get more from Bloomberg's Stephen Carroll in Brussels.
Now, the State Department hasn't commented on our reporting, but this morning here in our Brussels bureau at Bloomberg, we spoke to the US ambassador to the EU, Andrew Puzder, who said he wasn't aware of any of these efforts until he read our reporting. He was even reluctant to talk about the US position on these assets in general, deferring instead to Steve Witkoff and Jared Kushner.
Bloomberg's Stephen Carroll in Brussels. Now, Ambassador Puzder is speaking out about a $140 million fine from the European Union against Elon Musk's X.
The vice president is very concerned about limits that are unfair against American companies, enforcement of legislation that's really contrary to the spirit of the free trade agreement.
EU Ambassador Andy Puzder on Bloomberg Television. The EU says the platform formerly known as Twitter misled users with its paid blue checkmarks and stonewalled researchers' access to data. This is the first fine issued under the EU's controversial Digital Services Act. Back in Washington, House Speaker Mike Johnson says Republicans will unveil their plan to deal with a pending spike in health insurance premiums next week. Johnson made that prediction on Fox Business. House Minority Leader Hakeem Jeffries says he'll believe it when he sees it.
Part of the challenge with Republicans is that they've broken all of their promises. They indicated that they were going to lower costs. In fact, lower costs on day one. Costs haven't gone down in America. Costs have gone up. Housing costs are through the roof. Grocery prices through the roof. Electricity bills through the roof.
House Minority Leader Hakeem Jeffries tells Bloomberg tens of millions of Americans could see health costs spike by the end of the year unless Congress extends expiring Affordable Care Act subsidies. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager. This is Bloomberg.
No feeling I get that's the same as when I
Now, how does this work? Obviously, you're going to edit this, right? My name's Roman Martinez. I'm a Supreme Court litigator at Latham & Watkins, a law firm here in Washington.
Roman Martinez is really a very seasoned Supreme Court advocate. He's in his mid-40s, and he's already got 14 cases that he's argued before the justices. And he has the pedigree that you'd expect from an elite lawyer, so he went to Yale Law School. He then clerked for Chief Justice John Roberts. And then after that, he went to work for the U.S. Solicitor General's office, and that's the office that handles all the litigation before the Supreme Court on behalf of the federal government.
Our firm is representing Ava Tharp on a pro bono basis. She has a form of epilepsy that makes it extremely hard for her to communicate. She's essentially nonverbal.
When she was about 4.5 months old, she started having spasms. She always needed 24/7 care, and she has seizures every day.
When she was 10 years old, she moved from Kentucky to Minnesota, and she changed school districts. When she went to her new school in Minnesota, they refused to give her the same kind of accommodations that she had been receiving in Kentucky.
And it wasn't until the day before we started school that they told us that they would not adopt the Kentucky IEP, that they were going to remove services from Ava.
And so as a result, the hours of instruction that she was able to get were really cut down. And so they were much reduced from what she had received in Kentucky.
As time went on, Ava began to lose skills, and she lost her ability to communicate. Thank you, Ava.
The case began 10 years ago when Ava's family argued that some courts have made it too hard to sue public schools when they don't accommodate students with disabilities.
Those types of plaintiffs, those kids, have to satisfy a higher standard than every other plaintiff with disabilities.
This case is about Ava, of course, but it's also about a whole host of other students who are similarly situated.
I was engaged in this case when Ava was still in the Court of Appeals.
As they teach you in grammar school, there are three branches of government: the legislative, the executive, and the judicial. At the top of the judiciary food chain is the Supreme Court of the United States. The big cases that the court hears every year go through a series of appeals through the federal courts.
The Supreme Court will decide cases where the lower courts have really disagreed, trying to provide some sort of national unity across the law.
Is there a circuit split?
In Ava's case, all courts agree that plaintiffs can get damages when there's been intentional discrimination. But where the courts disagree is what plaintiffs, here, Ava and her family, what they must do to prove that the discrimination has actually been intentional.
What we then did was bring the case to the Supreme Court, and we filed what's called a petition for certiorari.
There are several stages in the life of a typical Supreme Court case. The first one's going to be the petition for cert, asking the justices to take up the case.
Usually, when you're filing briefs in court as a lawyer, the goal is to just argue the merits of whatever issue you're arguing. A cert petition is different because the issue that the justices are considering is not whether you should win the case or lose the case, but rather whether they should hear it at all in the first place. And so you need to write a brief that appeals to their discretion. And so we're saying, hey, Supreme Court, you are here in part to make sure that federal law is interpreted and applied fairly and uniformly across the country. Because the lower courts are disagreeing about whether this is the right test, you need to step in and sort out this disagreement.
The justices will meet in a private conference. They'll talk about whether or not they want to take a case.
The Supreme Court is picky, the justices are picky.
There are thousands of cases that are appealed to the Supreme Court every year.
And they only hear a small fraction of those.
Basically, you have a 1 to 2% chance of getting your case granted.
So you need to convince them that your case is special and warrants their attention.
So we're racing right now in the week or so before Christmas, and our expectation is that the justices will consider whether to grant review in our case, whether to grant certiorari at their conference when they get together to discuss cases on January 10th. I'm very hopeful that the justices will see it our way and let us in the door. It's about 3:50 in the afternoon on January 17th on Friday. I just got the news that the Supreme Court granted review in Ava's case, which is absolutely wonderful news.
Ava, yay!
Hey guys. How's it going? Hey, congratulations.
Oh, thank you for everything.
Oh, this is so exciting.
There is no feeling I get that's the same as when I walk into the U.S. Supreme Court's courtroom.
It's an amazing experience to get to argue in the Supreme Court.
Being in the Supreme Court, the significance and importance of the case is always on your mind.
You can hardly think of a subject that matters to you as an individual that will never come before the Supreme Court.
The landmark Supreme Court decision in Brown versus Board of Education.
The landmark decision that overturned Roe versus Wade.
Legalizing same-sex marriage across the land.
The Supreme Court takes a case because they want to figure out what the rule of law should be. Both sides will get the chance to stand up and argue. It's kind of like a sporting event. There'll be some adrenaline rushing. You know, it's game time. Now, how does this work? Obviously, you're going to edit this, right? My name's Roman Martinez. I'm a Supreme Court litigator at Latham & Watkins, a law firm here in Washington.
Roman Martinez is really a very seasoned Supreme Court advocate. He's in his mid-40s, and he's already got 14 cases that he's argued before the justices. And he has the pedigree that you'd expect from an elite lawyer, so he went to Yale Law School. He then clerked for Chief Justice John Roberts. And then after that, he went to work for the U.S. Solicitor General's office, and that's the office that handles all the litigation before the Supreme Court on behalf of the federal government.
Our firm is representing Ava Tharp on a pro bono basis. She has a form of epilepsy that makes it extremely hard for her to communicate. She's essentially nonverbal.
When she was about 4.5 months old, she started having spasms. She always needed 24/7 care, and she has seizures every day.
When she was 10 years old, she moved from Kentucky to Minnesota, and she changed school districts. When she went to her new school in Minnesota, they refused to give her the same kind of accommodations that she had been receiving in Kentucky.
And it wasn't until the day before we started school that they told us that they would not adopt the Kentucky IEP, that they were going to remove services from Ava.
And so as a result, the hours of instruction that she was able to get were really cut down. And so they were much reduced from what she had received in Kentucky.
As time went on, Ava began to lose skills, and she lost her ability to communicate.
Thank you, Ava.
The case began 10 years ago when Ava's family argued that some courts have made it too hard to sue public schools when they don't accommodate students with disabilities.
Those types of plaintiffs, those kids, have to satisfy a higher standard than every other plaintiff with disabilities.
This case is about Ava, of course, but it's also about a whole host of other students who are similarly situated.
I was engaged in this case when Ava was still in the Court of Appeals.
As they teach you in grammar school, there are three branches of government: the legislative, the executive, and the judicial. At the top of the judiciary food chain is the Supreme Court of the United States. The big cases that the court hears every year go through a series of appeals through the federal courts.
The Supreme Court will decide cases where the lower courts have really disagreed, trying to provide some sort of national unity across the law.
Is there a circuit split?
In Ava's case, all courts agree that plaintiffs can get damages when there's been intentional discrimination. But where the courts disagree is what plaintiffs, here, Ava and her family, what they must do to prove that the discrimination has actually been intentional.
What we then did was bring the case to the Supreme Court, and we filed what's called a petition for certiorari.
There are several stages in the life of a typical Supreme Court case. The first one's going to be the petition for cert, asking the justices to take up the case.
Usually, when you're filing briefs in court as a lawyer, the goal is to just argue the merits of whatever issue you're arguing. A cert petition is different because the issue that the justices are considering is not whether you should win the case or lose the case, but rather whether they should hear it at all in the first place. And so you need to write a brief that appeals to their discretion. And so we're saying, hey, Supreme Court, you are here in part to make sure that federal law is interpreted and applied fairly and uniformly across the country. Because the lower courts are disagreeing about whether this is the right test, you need to step in and sort out this disagreement.
The justices will meet in a private conference. They'll talk about whether or not they want to take a case.
The Supreme Court is picky, the justices are picky.
There are thousands of cases that are appealed to the Supreme Court every year.
And they only hear a small fraction of those.
Basically, you have a 1% to 2% chance of getting your case granted.
So you need to convince them that your case is special and warrants their attention.
So we're racing right now in the week or so before Christmas, and our expectation is that the justices will consider whether to grant review in our case, whether to grant certiorari at their conference when they get together to discuss cases on January 10th. I'm very hopeful that the justices will see it our way and let us in the door. It's about 3:50 in the afternoon on January 17th on Friday. I just got the news that the Supreme Court granted review in Ava's case, which is absolutely wonderful news.
Ava, yay!
Hey guys, how's it going? Hey, congratulations.
Okay.
for everything.
Oh, this is so exciting. It's always exciting to get a CERT grant, but especially in a case like this. Ava, it's good to see you.
I can't thank all of you guys enough.
After the orders list comes out and a case has been granted, then the attorneys are really off to the races. They have to write an opening brief. That's when they really do get to sort of how the court should decide a case and looking at all the precedents that weigh on the issue that they're being asked to decide.
We're going to be on a tight deadline, tighter than usual. Under the normal briefing schedule, we would get 45 days to file our opening brief. The other side would get 30 days after that to file their response brief, and then we would have an opportunity to file a reply brief. But because of the fact that this is mid-January and the court is going to have argument in the case in April, we're going to have less time than we would normally have to file our briefs. And so it'll feel a little bit more like a sprint. In addition, in parallel, we're going to be reaching out to amici very soon to give them a heads up about the grant or request for them to participate. Amicus briefs are filed by parties that are not in the case yet, but who have a view on the question at issue. And they can be very helpful in sort of bringing additional arguments and perspectives to bear. Now we're in the door. We just gotta get it over the finish line here and get the justices to see it our way. So I got these quills from my first argument at the Supreme Court in 2014. A fun tradition at the Supreme Court. Every time you argue a case, the clerk's office or the marshal's office gives you a quill. I grew up in New York City. My dad came to the United States when he was about 12 or 13 years old from Cuba. He was born in Cuba and came over right after Castro took over the country. My mom had grown up in New York, and that's where they met. When I was young, I always liked arguing. I would pretty much argue about anything. I had an uncle who was a prosecutor in Miami, and so I kind of learned about what being a lawyer might be like through him. There's some cases that are out there that are really not going to interest your normal layperson, but once you start looking at the law and looking at the precedent and looking at the history and some of the policy considerations, almost any case becomes interesting, or at least interesting to me.
Probably the case that he's most known for is this case called Loper-Bright. He was part of the team that overturned this long-standing administrative law principle.
This is a doctrine that was established all the way back in 1984, which essentially gave the power of agencies like this the ability to interpret laws that were vague.
Felt like a Super Bowl type of argument as far as Supreme Court arguments go.
He was the advocate who was arguing during the infamous toilet flush.
It is the toilet flush that was heard around the world.
Like a lot of us right now, the justices are working from home.
At one point during the hearing, something unexpected was heard as a lawyer was speaking. Listen closely.
And change these laws that apply to banks. And what the FCC has said is that when the subject matter of the call ranges to the topics, then the call is transformed.
I was not the one who flushed. I was busy arguing a Supreme Court case. It's certainly something I'll remember. I didn't wake up that morning having that on my bingo card. Hey guys. So listen, thanks for all the work on the brief. I think it's shaping up really nicely. So why don't we start on the accommodation issue? It's January 30th. The Supreme Court granted cert, I think, about 13 days ago. And so we have been hard at work, our team. We've internally come up with a plan for how we're going to pull our opening brief together.
There can be a few things that the lawyers are trying to accomplish. They're trying to ultimately get the justices on their side, either by convincing them that, this is the right way to interpret a statute, or this is, what the founders meant for the Constitution to mean.
We're trying to persuade them this is a case where you should rule for our client. It starts with kind of ideas, us brainstorming and thinking about how the brief, which is going to be, about 50 pages, about 13,000 words, how it should be structured. So we kind of work from a rough, kind of outline of the key points we want to make. And then the task is really to go and just sit down and write it. And that requires researching the case law, looking closely at the statutes that are in play, and then coming up with ways to explain how the statutes and the case law support us.
Because the Supreme Court has never weighed in on what standard applies to these kinds of claims brought by students with disabilities. You're focused a lot on the statutes themselves, but also canons of interpretation, accepted norms in the legal field about how these kinds of texts are interpreted.
I spend most of my day, I am, I'm writing, I'm thinking about arguments for that narrow question. Like, that's what the Supreme Court's going to be addressing.
The research part it's frankly a lot of reading, analysis, connecting dots. The writing is similarly somewhat of a monastic affair in the beginning.
They'll kind of divide up different pieces of it, and the associates will usually prepare jointly a first draft, and then I will look at it and we'll go back and forth. We'll just iterate on it. They'll send it to me in Microsoft Word. I'll turn on the comment tracking feature, and then I'll type in my changes. I'll rewrite things. I'll ask questions in comment bubbles, and then we'll just go back and forth. And sometimes that'll take 3 or 4 turns. Sometimes it can take 20 or 30 turns. I'm going to cut the Doe citation. I think I like the regulatory site for the ADA, which is basically what Fry cites, and then otherwise generally keep it as is.
Along with a merits briefing, there's people who file amicus briefs, friends of the court.
What lawyers on both sides want is someone who's going to be a friend and amicus to them. So you want your amicus briefs to explain why your side of the case should prevail.
Some of these liberal and conservative groups will make it a point to file briefs supporting the point of view that they like.
I mean, I do think sometimes the group filing the brief's primary interest is to protect its interests, and those are not necessarily all that helpful to the court.
You'll see 20 or 30 of these in some cases. I think they have less of an impact now because there's so many of them.
The most important amicus is the U.S. government.
Anytime you can have the United States government on your side, that's a plus.
The Solicitor General's office manages and supervises all Supreme Court litigation on behalf of the federal government.
They used to refer to the Solicitor General as the 10th Justice.
They participate in so many cases, they have a unique credibility coming to the justices, and the justices trust what they're saying.
Anytime the Supreme Court grants review in a case and the SG's office has not previously participated or the federal government has not been a party, we start a very extensive process to solicit views across the federal government to try to understand how the legal issues in the case affect the interests of the United States.
And so their usual process after a case is granted in the Supreme Court is to invite both sides to the case and basically give them an opportunity to make a pitch for why the government should come in support of their side.
And I've been told that these SG meetings, from the party perspective, function as something like a moot court because the people in the room often ask really difficult questions that are probing the limits of the party's positions.
We went for about 45 minutes or so, then a separate Zoom the government had with the other side, and then they probably had an internal discussion.
The whole point of this process is to really try to get everything on the table so that we can make an informed decision about what will best advance the interests of the United States.
If you get them a lot of the way on your side, it's going to go a long way for your argument.
It's March 13th, 2025. I'm here in Arlington, Texas, where my law firm has our annual meeting of our partners. The big development has been we got an amicus brief from the U.S. government. They filed a brief last week, wholeheartedly supporting Ava's position in the case and essentially agreeing with our arguments. So that's a big deal to have the government on our side. The Supreme Court has announced that the oral argument in our case is going to be held on Monday, April 28th. That's the last week of the 2024-2025 Supreme Court term. It's April 2nd, 2025. We are here in my home. The ball's back in our court in the case. The other side filed its response brief on Monday. I always am reluctant to pick it up and start reading because you never know exactly what they're going to say, whether they're going to point out that you were wrong about a certain case or precedent or statute. The other side is not really disagreeing with us on our basic interpretation of the statute, but they've come up with some new arguments that they are going to hope the justices will consider and that are going to give us a lot to think about over the next couple of weeks.
One of the things that was really unusual about this case was that the defendants really changed their position pretty late in the game. And so in their reply brief, they said not only would students with disabilities be affected by this case, but really everybody with disabilities. And that really raised the stakes for the justices.
The other side basically says, no, there's no uniquely stringent standard because the standard is stringent for everyone. And so we're going to join battle with them on that point. We have until April 18th to put together our reply brief. We get 6,000 words, which is going to be about 25 pages or so, to put our arguments together, and then that'll be the last word in writing before the court. My first case arguing in the Supreme Court was about a decade ago in 2014.
Mr. Chief Justice, and may it please the court.
I'd been in the Solicitor General's office for a number of months, so I'd been to a lot of arguments with my colleagues. But it was very exciting. This was going to be the first time when I was going to get a chance to stand up and argue.
Well, if that's what you mean, why don't you say exceptional injustice instead of gross injustice?
We're trying to tie the interpretation of the statute to the language
to the Senate report.
Not just to the Senate report, Justice Scalia, but to the judicial decisions.
It was a very hot bench, which is sort of the way that lawyers talk about cases when the justices are just firing questions at you one after the other. I thought, I want to get back in there. When can I do this again?
I think the best advocates are able to have a conversation with the court. And that means that there's a back and forth, and it's not a high wire act.
There's a lot of room in Supreme Court advocacy to think hard about how to make the case and what kinds of creative legal arguments might persuade this decisional body.
Appellate specialists know how to take a narrow legal question and build out an argument that doesn't span just a couple paragraphs, but builds out 50 pages.
My mentor, Rex Lee, who was the Solicitor General for Ronald Reagan, he would say, we bring the expertise in how to effectively communicate with the court, how to posture your arguments to be as persuasive as possible for the justices.
This is very high stakes stuff. And if you don't have real experience before the Supreme Court, you're taking your life in your hands.
Supreme Court cases differ quite a bit from cases in the lower courts. If we think about a trial court, really the issue there is you're arguing in front of a jury, you're trying to convince them of different facts. Once you get to the Supreme Court, usually the questions are all legal. Very little bit of the facts are going to come in, and they're usually not disputed at all.
So much of our work is developing the case for why our position is correct as a matter of law, focusing on the statutes, focusing on canons of statutory interpretation that support our position.
What if there was no precedent? What would we say about this as a matter of the Constitution itself? Not being a prisoner of the way in which other people have argued the case before or the way other judges have thought about the issues before can be really valuable. Jacket on. All right, let's get started. Thank you all for coming. Thank you guys for coming.
The moot court is really a trial run through the arguments.
The moots are, they're a lot of fun, and they're in some ways the most valuable way to prepare for these arguments. I've recruited really smart colleagues of mine in our appellate practice who have not up until now been involved in the case at all.
That's another wild part of this.
When I started arguing in 1982, and nobody in the SG's office did moot courts. And then Justice Scalia went on the court, and you went from getting about 10 questions in 30 minutes to getting about 10 questions in 30 seconds, which just created a much more active oral argument, which made mooting seem more important.
So you get people who are very knowledgeable in the area, and you have them sort of play the role of the justices.
This isn't like a dress-up exercise. There are no costumes. There are no funny accents or anything like that.
Am I right that Title I and Title III both specifically call for reasonable accommodations? I'm not at all trying to embody a particular justice, but I do think it's helpful to try to anticipate the questions that the various justices do.
The goal is to figure out what it is that the justices are going to ask you so that you can have the answers for them.
I will do the 2-minute opening if that works. Mr. Chief Justice, and may it please the court, the district has conceded Ava's question presented.
Counsel, you put a lot of weight on the idea that they have conceded the question presented. I guess I don't see that.
When we came and we briefed the merits of this case, as we said on page 30 in footnote 7, we weren't even going to address the issue of what standards should apply because our question presented was limited to that. So I think in context, it was absolutely clear to everyone.
If it was so clear, why did you preemptively include this footnote?
We were just indicating to the court that we didn't think it was making especially clear that it was not within the question.
But why would, I mean, if it was as clear as you're saying, why would you put that footnote in? So they're literally saying
two comments on that.
Anticipating this argument that you say is unimaginable that it could be made.
Okay. Thank you guys. You guys are tough. It was hot. It was hot. Yeah, that's great. I mean, that's exactly the kind of moot you want to have, where you have people who are really smart and are going to be very skeptical.
I tend to be a fairly nice guy, but I try to channel a little more aggression in my questions sometimes. And I don't understand how you can say that you lost on a theory that's completely wrong.
You know, if you go through something like that for an hour and 5 minutes of questioning, it makes it a lot easier to get in front of the justices.
So what's next? You know, what's your weekend like?
Tomorrow I'll work mainly from home for much of the day. And then Sunday I think I'll probably come to the office and work most of the day from here. And then get a good night's sleep both nights, both Saturday and Sunday.
Mr. Chief Justice, and may it please the court.
The district has conceded Ava's question presented. I had a great day yesterday. I came into the office early with my daughter, Kobe, and she was helping me pull together and finalize my thoughts for the opening comments. We did a little rehearsal together a couple times, which was fun. What's going on over there? My family's great. I met my wife when I was a summer associate at another law firm, and we started dating the following year. All right, so what was up with you today? For a while there, I would get my wife to do a moot court for me here at home before every case that I argued.
Yeah, we used to do them for every single argument. Now you have too many arguments that can't keep up.
And so we'd get together in the evening, and the Chief Justice would have a glass of wine, and I'd be standing up arguing the case, and she'd be firing questions at me.
I'm presuming, is that the brief?
This is our brief here. Our argument is that the school violated Ava's rights under the American with Disabilities Act and the Rehabilitation Act because they didn't give her equal treatment. The kids are wonderful in general. I think it's kind of fun trying to think about how to explain some of these more complex cases and complex legal issues to them.
He's the best dad ever, and he always spends time with us, and even though he works really hard. And I know sometimes he stays up till like 4 a.m. in the morning, but just to make sure he has time to spend time with us.
Thanks, Kobe. You're not going to trade me in, is that what you're saying?
No.
Okay, well, it's 8:20 p.m. on Sunday night, April 27th. I'm just going to do a little bit more reviewing of my papers and then hopefully try to get a good night's sleep. So that's about it. See you tomorrow. Good morning.
How are you doing?
All right, guys.
Good morning. Where's my mom?
How you doing? Good.
More?
Oh, you look nice.
Thanks.
Hi. How's it going?
Good. Sleep.
I slept okay until about 5.
I tend to get up really early on argument days, usually about 5 a.m.
I am a big believer in having rituals leading up to a Supreme Court argument. I always have the same thing for breakfast, which is bananas.
It's better to not treat this the way I used to sometimes treat law school exams or college exams, where I'm up till 3 a.m. the night before, kind of cramming and trying to stuff everything in my brain. I'll try to wake up, either have quick breakfast with the kids or grab something on the way.
And then head down to the office because I've got adrenaline just flowing through my system.
The U.S. Supreme Court hears arguments today in a case about the federal laws that promise help for children with disabilities in public schools.
Argument day starts at 10 o'clock. You come up to this building that's got marble steps, a big marble plaza. Often the sun is shining right off of it. Flags are flying in the wind. It's a really majestic kind of scene. And then once you get into the building, you walk through these big doors into a courtroom that's ornately decorated. There's a lot of gravitas to it.
It's a really special experience to be in the courtroom.
I like to look around at the friezes and the architecture of the place. It's just, it's magical from my perspective.
The justices are up very high.
The podium where you stand to argue cases is quite close to the bench where the justices sit.
It's intimate.
You always know who your panel is going to be. It's the same 9 justices.
The petitioners in the case usually go first. In our case, that's us. So I'll speak first. Mr. Chief Justice, and may it please the court, the district has conceded Ava's question presented.
They have 2 minutes of uninterrupted time, and then they have a certain amount of time, usually about 30 minutes, to argue their side of the case, where the justices are going to be interrupting them and asking them questions.
It's usually rapid-fire questions from the justices. The argument doesn't slow down.
I like a hot bench in general, up to a point.
I take their point that maybe you need intentional conduct for an injunction, but I don't even know why you need anything else.
Right. Justice Sotomayor, we agree with that, the impulse underlying that question. I think those are some great questions for the other side. I think what I would say on this is that...
Yeah, but you're here.
Well, let me take a shot at it.
Well, the very first time Justice Scalia was on the court, he just came at me with so much more intensity than anything I had experienced.
Whenever that ends, it's time for the other side to go up. They also have 2 minutes, and then they have the round robin as well.
Mr. Chief Justice, and may it please the court, this court should affirm Monahan. Bare IDEA violations do not support liability under Section 504 or the ADA.
And then you have rebuttal, which is the final part where the petitioner has a few minutes just to make their closing remarks, really what they want to leave the justices with, what the lasting impression that they want to make. Arguments in this case started off pretty typical, but I think by the time that the school district's advocate got up there, I think the legal term for it is it went a bit off the rails. The advocate for the school district, Lisa Blatt, had accused the parents' attorney and the Solicitor General's office, who's on the parents' side here, of lying in the case. And that's something that really rubbed the justices the wrong way.
Do you believe that Mr. Martinez and the Solicitor General are lying? Is that your
an oral argument? Yes, absolutely. It is not true that we
should be more careful with your words.
Okay, well, they should be more careful in mischaracterizing a position by an experienced advocate of the Supreme Court.
Justice Gorsuch admonished counsel to sort of watch her words and later came back to the issue, saying it was still bugging him. And after a very heated exchange, she withdrew her comment. But it was sort of a unique moment in the court that we don't see very often.
Lisa is a take-no-prisoners advocate, and it's fun to watch her. And in this case, I think she just overstepped for a moment.
There was a lot of heat at the argument. The temperature was raised a bit more than usually is the case in the Supreme Court. Lisa has been in touch. She's apologized, have accepted the apology, and we're moving past it. One of the most important moments in the argument was when Justice Jackson was asking my adversary, the district's lawyer, about the implications of the district's position. And she asked my adversary whether it really meant that they were saying that reasonable accommodations are not actually required under the law for people with disabilities.
Is your argument that bad faith should apply everywhere?
Yes, and the statutory text solely by discrimination is the reason for the action is a discriminatory intent standard.
The other side wholeheartedly accepted that that was in fact what they were saying. And I think there was maybe an aha moment there for some of the justices where they really appreciated the breadth and the kind of revolutionary and radical nature of what the district was asking for in the case.
And that would be a sea change, right? It strikes me as a pretty big deal.
Nowhere else have I seen the use of deliberate indifference or gross indifference used to define intentional discrimination.
I think today was a good day in the sense that we really got to make the points that we wanted to make.
It felt really emotional, even just coming into the buildings, and it really felt historic, like we were doing something really important. For a minute, I felt like I could cry. Like it felt, especially when Roman used Ava's name in court. It's like, that's my Ava.
Think about Ava, who desperately needs every precious hour of school so she can learn to communicate with her parents. We ask you to reject those radical arguments, and we ask you to vacate the decision below.
I think that the parents sort of have the upper hand here. I wouldn't be surprised to see an opinion in their favor.
It's dangerous always to, especially in a high-stakes case, to think that you know what's going to happen, and you can really get fooled.
I'm cautiously optimistic, but you never know. We'll have to wait and see what they decide to do.
The case is over. The argument's done. You walk out of the courtroom. It's a mob scene. There are tons and tons of people there.
Once a case is argued in front of the court, the justices will discuss it that week.
And then they'll take an initial vote. The justices who are in the majority, the one who's the most senior, will decide who it is that's going to actually write the opinion, and then that justice goes it alone for a while.
Then they exchange drafts back and forth, as many as 20 drafts sometimes.
They'll get comments from the other justices, the ones in the majority that say, hey, could you tweak this, or could you tweak that, or I don't think I'm going to be able to join this part. Could you just take it out altogether?
Once they all agree and everybody's gotten their dissents in and they're ready to go, they want to get it out as fast as they can.
The opinions are released on, random days.
I'm told that in the 1950s, they had a pneumatic tube, and they would send the opinions down to the press room by the pneumatic tube. That's not the way it is these days.
At 10 o'clock, the justices will be on the bench, and the person who wrote the majority will be reading a summary from the bench.
I try to go.
Going forward.
There's not really a set schedule to when opinions are released. Most people know about the opinions from them being posted online.
We don't find out about the opinion any sooner than anybody else does.
I'm hitting refresh on the website. I'll find out when the world finds out.
Today is a Supreme Court decision day, so starting at 9:55, my colleague Kimberly, who is actually at the Supreme Court, will go into the press office, and they'll bring out boxes of opinions. Each box can have anywhere from 1 to 3 opinions. It's like a ball of nerves, like it's high pressure. It's stressful to have to kind of open an opinion and try to quickly read it and understand what the court is saying and has decided. Okay, here's Kimberly. It's Ames. Ames versus Ohio, right? It's a labor case. And then we just go back to refreshing. This is Smith & Wesson is the next opinion. Catholic Charities, that's mine. One more coming. Oh, it's Blom Bank. That's mine. They're done, right? That was the last one, Seth? I think they're done. Yes. Yeah, they're done. They're done for the day.
So no AGT today?
No AGT today.
It's Thursday, June 12th. It is about 9:57 a.m. The Supreme Court is issuing decisions today. It's a busy day. There's a lot of other stuff going on, but I've tried to keep the 10 a.m. window free for a little bit. But it could be very anticlimactic. We might not get anything, and that's part of the experience too. All right, 10 o'clock. Let's see. So, going to the Supreme Court website here. We'll do a little refreshing. Okay, we got a first decision for the day, not ours. It is Rivers versus Guerrero. Commissioner versus, this is a tax case from Justice Barrett. So this is another page here in the Supreme Court's website showing another way they show the opinions. They have this R number thing. So you know that there are going to be more opinions when they haven't filled in the R numbers for the day. So even though right now Gorsuch is reading, you might think, oh, well, is this the last one or not? And we know it isn't because they are still blank. So that's how the kind of insiders know that there's more to come. No, not us. We're gonna have a good story here about, we got 4 cameras, 3 distinguished news professionals, a light thing, and nothing's gonna happen. I don't know, maybe that's part of the story though. It's like, nothing happens. Then you have to wait for the next time. We have a decision. Our case. It's by the Chief Justice.
Let's open it up. I think we won. All right. And I think it is unanimous with a couple concurrences. This is very exciting. I want to make sure I understand that. I want to understand exactly what they said. This is great. Aaron, how are you?
Hi guys, how are you?
Victory. All right.
Oh my gosh.
Very exciting. This is amazing. So congratulations. This has been a long road for you guys and for all of us. But this looks like a very strong decision. Now, I haven't had a chance to digest it.
I've skimmed it briefly. The majority tracks our briefing very closely and is a narrow decision that's only focused on the dual standards. Justice Sotomayor, in concurrence with Justice Jackson, questions whether there's any intense standard at all. And I'm just perusing Justice Thomas's concurrence now.
So, we had asked the Supreme Court to basically decide the question of whether children with disabilities in the educational context should be subject to a different standard, a more stringent standard. And we did not ask the court to decide what that standard that applies to everyone should actually be. And so we basically said just don't apply a different rule to kids with disabilities in the educational context. That was the strategy, and we were helped in that because what the district then tried to do is they tried to make the case bigger than it was originally presented, and they tried to make it all about what that actual standard should be. And the court didn't buy that. They said the district's changing its position and it hasn't preserved these issues below, and they shouldn't be allowed to inject them into the case now. And so we're going to keep it narrow.
So will this now go back down to lower courts?
So the case isn't resolved. So the case goes back down to the lower courts, and her case gets to continue. So the lower courts said that she definitively lost the case because of this bad faith or gross misjudgment standard. And so that's been reversed. And so we think that under the correct standard, she satisfied that. Now maybe the district is going to say she hasn't satisfied it, and the parties will have to fight out under the correct standard, who should win. But we think that there's a lot of language, especially in the Court of Appeals decision, that supports Ava. This is obviously a very important case for the Tharps and for Ava, but you all have talked to her parents. More important to them was to get the issue resolved in favor of kids with disabilities, so that would be the rule going forward, governing everyone.
Well, I want to thank everyone. To think that initially it was just this case involved kids with disabilities, only to find out that you guys were defending every single person in the United States with a disability before the Supreme Court. And so what was on your shoulders was huge. And the fact that you guys were successful, not just defending the rights of students, but everyone with disabilities. I can't thank you enough. Gina can't thank you enough. And the disabled community cannot thank you enough for everything that you guys have done.
It feels great to wrap it up. First, we were trying to get the Eighth Circuit to change its standard. It's definitely been over a year, maybe a year and a half or so. And so it's been a long road for us. It's really been a great team effort. And to see all that hard work come together, and then to read an opinion that, essentially says, yeah, you guys were right about how you framed the case, how you wrote the briefs, how you argued it. It's a great feeling.
to show that he won't back down in the face of U.S. threats. But I think the real event is what's happening in Brussels today with Merz and Bart de Wever.
And so what are you expecting there?
I don't expect there to be a breakthrough, but it's impossible to underestimate how important this issue of the use of frozen Russian assets is to the outcome of European security. And then coming on the back of this bombshell new U.S. national security document that was published last night.
Julian, give me a sense of what this means for investors. I know investors have, I guess, seen points of stress, and that's translated into oil because of all the geopolitics. But actually, they're now largely, looking through a lot of the tariffs concerns. Could that come back at the forefront when you see big leaders across the world trying to sign deals?
Yeah, clearly, I don't think we're done with tariffs. Of course, we're waiting for the Supreme Court to express its opinion around the reciprocal tariff. It looks like, we're moving into a much more multipolar world, and so you're going to see alliances form in different corners of the world. And the result is you're going to have much more volatility and headline volatility around geopolitics. So this is something that we expect to continue in 2026, but way beyond as well.
Okay, let's also talk a little bit more about, of course, the visit of Vladimir Putin over in India. Our senior reporter, Dan Strumpf, is in New Delhi. So, Dan, just bring us up to date with the developments there.
Hi, good morning. Yeah, that's right. Vladimir Putin arrived here in New Delhi just yesterday. Today, we saw both Putin and Modi in their first bilateral meeting taking place this afternoon. We don't know exactly the outcome of that meeting just yet. We're expecting a press conference to bring some announcements there, which could happen actually just any minute now. But we do know that economic and trade talks are really at the center of this visit. Both sides have signaled that they are very eager to deepen their trade and economic partnerships, as well as partnerships around areas like migration. Is kind of a real way to sort of show that this partnership between India and Russia is alive and well in the face of pressure from the U.S., which both countries are facing quite heavily right now.
But so, Dan, I mean, is this on oil? Because India still needs quite a lot of Russian oil. And is there a danger that actually Washington reacts quite badly by imposing extra sanctions or try to break the two apart?
So Russia has been a growing supplier of oil to India this year. Now, that's been a real source of strain between the U.S. and India. India has been working to reduce its reliance on Russian oil, and that has come down in recent months. Now, what we haven't seen is the U.S. respond with an easing of its really quite debilitating 50% tariffs on India in response. And so what's happening is that India and Russia are looking to expand their partnership beyond these sort of traditional areas around energy and around defense to include a much wider range of trade in other goods. And for India, that really helps to kind of offset the impact of those tariffs from the U.S.
Dan, thank you so much. Our senior reporter there in India, Dan Strumpf. Julian, again, does this show up in inflation data at the margins if we're going to see more geopolitical allies and blocs coming together?
Well, we haven't seen it so far. If you look at what oil price has done year to date, clearly it doesn't feel like we are in this world where geopolitical tensions are quite significant. It will obviously create some tension, especially if we're seeing more tariff being implemented. But I think at this point it's very difficult to expect more tariff to be implemented as we're waiting for this decision by the Supreme Court.
And Tina, I mean, this also comes, there are two other things, right, going on at the same time. Emmanuel Macron is in China. So I want to get your thoughts on what that means for Europe trying to, have a better relationship with China, maybe to counter India and Russia. And the other thing is also the German chancellor is really in a sticky spot. So how much does that weaken Europe?
Europe is caught between coercive powers. We always knew that 2025 was going to be a big wake-up call. But the really astonishing turn of events, again, mentioning this new U.S. national security strategy, is how the United States, Russia, and China appear to be treating Europe as a diminishing concern, despite being the world's third largest trading and economic bloc. And the way that feeds into support for leaders in elections and everything else really matters. What Macron is doing is hedge America. And similarly, Putin and Modi meeting today are also looking to shore up alliances. More volatility, has been mentioned, but what we're talking about is the remaking of the international global power structure, which won't settle into a new pattern. This is going to be messy for an extended period of time.
The other thing, Tina, that I want to ask you about is that you're also writing extensively on this U.S. public discontent with affordability in the U.S. Does that really goes against the Trump administration? Are they being blamed for it?
So the affordability crisis is really, top of the list for U.S. public concerns as we head into this midterm year. We had the Tennessee special election take place, and although the Republican candidate won by a very comfortable margin, that district was won by President Trump by 22 points, and it dropped quite a bit. So there's a lot of panic in Republican corners about affordability. What matters is what the response is. At this point, the Republican National Committee response seems to be double down on MAGA. And you've seen President Trump say that affordability is a Democrat hoax and other kinds of dismissive terms. This reminds me of what the Biden administration was saying when Americans were upset about inflation, despite the fact that his administration achieved other goals. And it turns out inflation is really the most toxic factor in politics in developed markets.
And Julian, so what does that mean? It seems that uncertainty is probably the only uncertainty for 2026. So how do you build on that, given what Tina was saying for the markets?
I think, it's, we've just released our Outlook 2026, and frankly, it was one of the toughest ones to write because there are so many wild cards that having a clear view as to how 26 will play out is very difficult. I think you want to do two things. You want to focus on the really strong underlying trends and build on that. And the second thing you want to do is you really want to be a bit more agile and tactical this year because the narrative is going to keep shifting, whether it's tariff, whether it's the Fed, whether it's geopolitics, and there's no way to predict how this is going to play out. So we have to approach every quarter with a different pair of eyes and see how we're going to position for the next 3 months, and then redo that again. I think that's the only way. So,
Julian, do you actually see opportunities beyond the U.S. and beyond AI?
Yeah, I think definitely you want to be able to diversify away from the U.S., away from AI. One particular part of the market that we think is extremely attractive at the moment is everything that is linked to quality. Quality as a style has underperformed massively. There is no reason why you shouldn't own quality if you're investing for the medium to long term. And we see this is where you want to put your focus on, whether it's on the fixed income side or the equity side. Quality is probably the style that we prefer at the moment.
And Tina, what's your wild card for 2026? Does geopolitics really also work through AI and this massive fight between the U.S. and China to be number one in the game?
Well, I would say this, Francine, but geopolitics does cut across all of these topics because, as you've heard me say so many times over the years, geopolitics is about power and power projection. It's not a negative externality, as economists like to talk about it. So whether it's AI, critical minerals, energy security, or these frozen Russian assets and how they are disposed of, it all comes down to this great power competition and the other countries, middle powers like India, Saudi Arabia, Brazil, for example, really fighting to have their weight and their agency register in the global system. It's tough out there.
Yeah. It certainly is. Tina and Julian, thanks so much for joining us. Julian Lafargue, Chief Market Strategist at Barclays Private Bank, and Tina Fordham, founder of Fordham Global Foresight. Coming up next, we'll be speaking with Brian Moynihan, the Chief Executive of Bank of America. We also have two other interviews you don't want to miss. The U.S. Ambassador to the EU and, of course, a new Lady Mayor of the City of London. Also, a little bit later on in the program. This is Bloomberg. conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, we've had a data blackout after the longest U.S. government shutdown in history. Investors, of course, closely watching the release of key inflation data a little bit later ahead of a widely expected rate cut by the Fed next week. Let's discuss what it means for the U.S. economy and the banking sector on Wall Street with Brian Moynihan, Chief Executive of Bank of America, which also just laid out new financial targets at its Investor Day last month, its first in almost 15 years. So, Brian, thank you so much for joining us. Congratulations on the Investor Day.
Oh, thank you.
I'll ask you about that in just a second. But first of all, how's the U.S. economy doing, actually? How's the U.S. consumer holding up?
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money, our 70 million consumers who's pushed about $4.5 trillion plus in the economy every year. They pushed in about, that month, about 4.5%. And so it was good. And around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good. And it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort of sort the aggregate economic impact of the consumer, our 70 million consumers spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to where they compare it to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
Would a Fed cut help?
A Fed cut helps, and our team believes the Fed will cut next week. They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
And sticky.
It's sticky, although right when they started raising rates, people told me it takes 5 years to actually squeeze out inflation, and people just aren't patient, and so it takes a while. So it's been coming down, and it's sticky. Is that it's not making the incremental progress a little different? But I think the belief is because the labor market's softer, they'll lower rates. That's how our team got there. But we get into the hand-to-hand combat of next month and next week, and this. The question really is longer term. Our team thinks the Fed gets down to about a 3% Fed funds rate. The 10-year rate sits in 4.25%, 4.5%. And that's a more normal rate structure for the United States. And I think that's not a bad thing. If you have a little higher inflation, a little faster growth, and a normal rate structure, then I think the incentives created by very low rates and stuff are out of the system, and I think people can then act on economic incentives.
And so what does that mean? That animal spirits are back in terms of also, IPOs and M&A, or does it take a while to settle? The market was also a little bit of a tissel because of the possible new Fed chair being Kevin Hassett.
Yeah, I think you've got to, I walked the trading floor this morning, you've got to sort out people who worry about 5 basis points on the 10-year versus people who worry about the next 50 years of the United States and a strategic view of the world. But if you look at companies, the activity kicked up after the new administration came in because there are a couple things. One was that you could get deals through the system, get them done, especially the United States, and that's important. So in our industry, which we are not allowed to make any acquisitions deposits by the law, it's been on books for 30 years. But in our industry, as an investment banking firm, our advice is you can get deals done, and you're seeing the time frame to approve a deal drop by half. And that's important because the idea of a deal being open for a year and a half, that's tough on the companies. And so that's good news. Then the second thing is settling out the major policies that you guys talk about every day on trade and immigration and tax. Those are settling in so people can see that. There's still work to do. But I think that means that companies can look and discount cash flows and make decisions. And then even a rate structure that's higher, as long as it's consistent, they can plan into it.
Brian, you know Kevin Hassett, and you've known him for quite some time. Yeah. What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's a lot of commentary about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with, Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say, some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think, again, they're ready to do deals?
Well, generally there's things that you look at, you say, I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much I can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clear that there's sort of 10 to 15% increase is generally across the board result. That's helped business understand it better, and so I think that's been worked into their plans, and that's why you're seeing the relief come off from Liberation Day, where people were very confused, to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique, but I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes, but generally they're more worried about the ability to address markets and drive. And I think one of the things administrations worked on that gets lost in the percentages and count is the non-tariff barriers, and those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States but around the world, because to get access to markets without having to change product is a big deal.
What's your take on the UK? So we had a budget. It didn't 100% go well for all companies, but I think there was a sigh of relief that at least we know what there is. JP Morgan's building, massive building in London. Are you committed to London?
We have 6,000 teammates. We just announced we're adding another 1,000 teammates in Belfast that will specialize in certain areas that we know we can get the talent there and help grow that economy. And so we're in London. We believe in London. We've been here for a long time. It's just part of who we are. I think the UK, London in particular, is a great place for multinational, international operations. So Bernie Menz that runs international is here. And I walked the trading floor today, and the Asian traders and the Middle Eastern traders and the EU traders, and everybody was up and working. And so I think it's a great thing. The key is for the policies to make sure that you distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. Because if you're a good place with the rule of law and the great city that London and the great country that UK is, there's plenty of upside in the world where there's not that many places where people can get young kids to go to work. We're just about young kids. Remember, we bring 2,000 kids in from school every year. They've got to want to work in the cities, and so New York and here and other places have a leg up if they just handle it right.
So what do you tell the Prime Minister?
I tell them to make sure the regulation's fair. And protect, but also materiality is the hardest thing for governments to understand. We have 6,000 teammates here. It's an incredibly important operation. 20% of our revenues are international businesses, growing nicely, but it's 20% of our revenue and things like that. We have hundreds of billions of dollars of capital to make sure things are all right. So if you make it hard to operate, that's when people start to make decisions, or make it uncomfortable for taxation for their workers. That's where they make decisions. Or expats coming in, that's where they make decisions. So I think our advice is be the best place for a non-UK based company to operate, and you'll get companies coming here. And it won't be that people leave. It's just where the next 500,000 people are going to go.
Brian, talk to me about your Investor Day. I mean, this was the first in 15 years. You set up some really ambitious targets. Are you happy with the way it went and the way it was received?
Yeah, it was great. It was a chance to show the hugely competitive advantage we have as a franchise, the moats we have on it, what all the technology spending done. We talked about what we do in AI that people are asking a lot about. We showed that it's actually not theoretical at Bank of America. The Erica will interface with 2 million customers today at Bank of America, which is an AI bot. So we gave that view, and we showed in each of the businesses how the competitive position they have. They're top businesses, number 1, number 2, number 3. They're growing organically, have been. And then the returns come back as the NII and the pricing on the fixed assets. So we're We talked about our net interest income growing at 5 to 7%. The industry's growing at 2 to 3%. That's really coming from the balance sheet, continue to reprice while we generate good organic growth. And it was good. And so we thought the returns would reach 16% return on tangible common equity, moving up to 18, and last quarter we had 15, and we grew EPS like 25-30%. It was a good quarter, and it's the team does a great job for us.
You know, I need to talk soccer or football. Yeah. I may get my nationality pulled away if I call it soccer, but are you now a football guy? I mean, you're sponsoring FIFA. The World Cup is coming to America.
Well, I have to say, as an American, I am a football person. It's just not the same football. Look. The draws tonight, we're very excited. We are a sponsor. We are the major financial sponsor for FIFA, working with Johnny and the team for the last 4 years now on this. Our team has got a set of programs. Just today we announced that if you apply and get a credit card, you get a chance to go into lottery to buy tickets and things like that. And our clients are excited. The cities are hosting are excited. We're working in the cities. We're working with other colleagues, other companies to put fields in these cities, at FIFA and Visa and others. These are all important things because what we're trying to do is bring soccer into places and have it when the World Cup goes away, which will be a wonderful event, to have the FIFA World Cup continue through these fields.
Brian, the most difficult question, who do you support if not USA?
Well, we have to support the USA.
I know, but your second team, do you have a second team?
I've got too many colleagues around the world that have come after me for that.
You're going to get the calls. They hate calls. Brian, thank you so much for joining us. Brian Moynihan, Chairman and Chief Executive of Bank of America. Coming up, our exclusive conversation with Andrew Puzder, the U.S. Ambassador to the EU. We discuss the Russian invasion of Ukraine and, of course, competition and regulation concerns in Brussels. That's next, and this is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking this resource with continued investment.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German Chancellor braces for a key pension vote in Parliament that could signal the end of his coalition if he loses. So let's return to our top story this morning. And Bloomberg understands that the U.S. lobbied several countries in the European Union in an effort to block EU plans to use frozen Russian assets to back a massive loan to Ukraine. Now, U.S. officials argued to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. Well, joining us now for an exclusive interview is Andrew Puzder, the U.S. Ambassador to the EU. Ambassador, thank you so much for joining us. So because of this Bloomberg scoop, can you just run us through the logic or exactly what the U.S. wants?
With respect to the Russian assets loan? Is that what you're asking?
Yes, Ambassador.
Can you hear me?
We understand that some U.S. officials have lobbied several countries in the EU to block EU plans to use some of these Russian frozen assets. What's behind that?
The first I heard about that was when I walked into the studio this morning. I haven't been briefed on it, and I have no idea.
Okay, Ambassador, do you think, is there a concern? I mean, have you heard about some of your officials briefing, or have you had calls from EU trying to understand what the official U.S. position is? What do you think the official U.S. position is on this?
Well, I don't want to speculate on what the U.S. position is, and no, I haven't had calls from anybody in the EU or the administration on this issue. Again, the first I heard about this was when I walked into the Bloomberg studio this morning, so I have no idea if there's been lobbying or if there hasn't been lobbying or who would be doing it.
Ambassador, talk to me then a little bit about regulation. You've spoken on regulation about the need for the EU to pull back its regulatory burden. What specifically are you referring to?
Well, I'd say the two principal areas would be what's called the Corporate Sustainability Due Diligence Directive, the Corporate Sustainability Reporting Directive, and then the Digital Marketing Act and the Digital Services Act. I think those are really contrary to the EU's best economic interests. One of them makes it very difficult for the EU to get inexpensive energy, which it desperately needs, and the other makes it difficult for it to get the cloud services and the sophisticated AI software that they need and the investment they need here on the European continent to participate in the AI economy. So as the U.S. ambassador here, of course, I'm very interested in advancing President Trump's efforts to make America safer, stronger, and more prosperous. But that doesn't mean we have to leave Europe aside. We want to make America great again, but we'd like Europe to be right there with us, particularly in this AI war. And these regulations make it very difficult for Europe to participate in the AI economy.
Ambassador, yesterday, we heard a post that was quite aggressive on X from the Vice President J.D. Vance on the EU Commission's plans to fine X for not engaging in censorship. Again, we understand that the EU, is talking about breaching transparency requirements. What's your take on this? Is it censoring, or is there a way forward?
Well, I will say it's somewhat of a coincidence that every company that seems to get fined with respect to these digital services or Digital Marketing Act violations is an American company, and so I have not the X fine. The news just came out last night. I haven't had a chance to look through and see what the basis of that fine is, but I know the Vice President is very concerned about limits that are unfair against American companies, enforcement of legislation that's really contrary to the spirit of the free trade agreement, where we're trying to eliminate non-tariff trade barriers. When you're singling out American companies for regulatory action, that really is not within the spirit of that agreement. And he's also very concerned with aspects of free speech. The First Amendment is a very important right in the United States, the right to free speech, the right to free expression, and the Vice President is very concerned about violations of those rights.
Yeah, I think the Commission is talking about, accessing data, misleading users with potential fines. That's decided yet. Ambassador, do you think it's targeting U.S. companies, or is it just targeting companies that happen to be American?
Well, they happen to be American because the legislation was drafted in a way that it would basically cover only American companies. I think there's 8 companies that are covered by this legislation. I think 7 of them are American companies. And the only substantial, meaningful fines that have been imposed so far have been against American companies. So at some point, if you're an American company, you've got to sit back and say, look, am I being targeted here? Or is this an effort to try and advantage European competitors over U.S. companies? And if that's the case, it's something that the United States needs to respond to. And I believe the Vice President has been very active in that respect.
Ambassador, let's also look at the Corporate Sustainability Due Diligence Directive. Where do you see this going?
Well, I don't know where it goes. There's 2 problems with it. One, the big problem is that Europe needs energy. If Europe's going to run an industrial economy, it needs inexpensive energy or reasonably priced energy, and it needs abundant energy. And if it's going to participate in an AI economy, it needs even more energy because you have these terrific energy demands that come with these large data centers. If you're going to be a participant in the AI economy, and both President von der Leyen and Professor Draghi have been very adamant that Europe needs to participate in the AI economy, and the U.S. would like Europe to participate. But when you pass regulations that impose net zero mandates on oil companies, and when those mandates reach not only into the supply chain, the direct supply chains, but the indirect supply chains of companies that really have no nexus to Europe, that don't do business here, don't want to do business here, but are somehow in a supply chain of a large multinational oil company or fossil fuel company. When you make those kinds of restrictions, you make it very difficult for these producers to supply Europe with the energy that it needs. So I think it's a regulation that just is not in Europe's best interest and is not in the best interest of making Europe a prosperous and vibrant economy.
Ambassador, what about steel and aluminium? I know EU exporters, for example, are being hit by 50% tariffs, with 400 items now being subject to this tariff rate. Is there any progress or any sign of breakthrough in this?
Well, the idea with the iron and aluminum tariffs, both the United States and Europe now have 50% tariffs. Originally, the United States was concerned that China is dumping steel and aluminum on the market, and we wanted to make sure that these derivative products, the 407 that you mentioned, that they wouldn't contain Chinese steel or aluminum, which could get dumped in America. Now, Europe is saying that's not going to happen. That's not what they're going to do. Our Secretary of Commerce and our trade representative were here in Europe last week and made it clear if we can make some progress on these lawsuits, these regulatory actions against America's tech companies, if we can make some progress there, we can make progress on these derivative issues too. So I think both sides are talking, both sides are negotiating, and I think eventually this will get resolved. I just don't think it's been resolved yet.
Ambassador, I just wanted to go back to Ukraine because today is a very, very crucial day for the EU's plan to tap these immobilized Russian assets to help Ukraine. What do you understand the U.S. position to be today?
Look, this is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. I don't want to comment on this area and have some impact on negotiations I'm not involved in. And so it's really difficult for me to comment on it.
I understand. We're just, if the U.S. were to call European countries to try and tell them, like, look, this is not the right way, do you think there's a danger that the U.S. is trying to force Ukrainians to capitulate to Russia? Is this how you would see it?
Well, I'm not going to comment on a hypothetical. I'm certainly not going to give my opinion on an issue where I could actually have an impact on negotiations that I'm not involved in. That's just not that's not something I would do.
Ambassador, thank you so much for your time, and thank you for joining us. Andrew Pusder, there, the U.S. ambassador to the EU. Now, turning to defense, and Bloomberg's chief Europe correspondent, Oliver Crook, sat down with the chief executive of Rheinmetall earlier this morning to discuss the challenges facing the sector.
I wish that peace is coming in Ukraine because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard to that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that, because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. And if you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunition, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. And but if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
The Rheinmetall chief executive speaking with our chief Europe correspondent, Oliver Crook. Now, coming up, we'll be joined by the new Lady Mayor of the City of London, find out how Susan Langley plans to attract investment to the capital next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
This year, more than 1 in 4 cars sold worldwide will be electric. By 2030, that number will climb up to 40%. ASEAN has everything that the global EV industry needs. Bangkok Bank isn't just a lender. We are a connector. We are building a seamless EV supply chain, from raw materials to final assembly. สามัคคีคือพลัง Together, we are strong.
Welcome back, everyone. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and the HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Baigori. Manuel, how significant would this be?
Francine, it is very significant. Indeed, it's a transformative deal in the entertainment industry, not just in the U.S., but globally, right? Netflix has become such a major powerhouse, and Warner Brothers is such an iconic brand. So it sounds like they're getting closer to the potential sale of the film and TV assets, as well as HBO Max. So that would definitely create a formidable company in that space, and it will also send some shockwaves for other competitors. Comcast, Paramount, among others, were also eyeing these assets. So definitely a big transaction that seems to be just days away from a potential announcement.
Manuel, thanks so much. Manuel Baigori there with the very latest on Warner Brothers Discovery. Now, the City of London remains a global hub for talent and wealth, but but has faced challenges over recent years. Well, someone tasked with improving the outlook is a new Lady Mayor of the City of London, Suzanne Langley, who joins us now. So, Lady Mayor, first of all, congratulations on the appointment. You come adorned with...
I come adorned with, yes, an awfully large badge. Yes, I do.
I mean, an awfully large badge because you have, an enormous job, actually. What do you hope to achieve over the next year in trying to promote London's financial services to the world?
Well, the role of the Lady Mayor is the ambassador for financial and professional services in the City of London and for the UK. And I like to think of the Mansion House as the embassy for FPS. So really, my role is to promote the city, 100 days overseas, travelling as global ambassador, but for the city, we have to focus on matching capital with opportunity, and that's both financial and also human talent.
Yeah, so what will you focus on? How do you attract more talent to the UK? Finally, we had the budget. It feels like it was a long time coming, or certainly there were quite a lot of leaks in the run-up. What can be improved on?
Well, you're absolutely right. There were a lot of leaks in the run-up, and as you know, uncertainty is not good for business. It stops business making decisions. So now we have certainty, we can actually move forward. One of the things for me, well, there were two things for me, really. First is promotion. I mean, I actually think in the UK we are really good at saying what we're not good at, and we are really not good at saying what we are good at, and we're brilliant at things. I think, we're the #1 in the whole of Europe for Fintech unicorns. My sector, insurance, we're the global risk centre of the world. And one of the things we need to do is actually be slightly less British and actually promote the city and the ecosystem around it. And then the second thing with talents, I mean, I'm an East Ender, so this is one of my passions. And you might have heard a phrase has got coined, which is unsquare the square mile. And by that, I actually mean, I think the word square for the city kind of implies something that's closed off, fenced, old-fashioned, and it's neither of those things. It's open to all talent, look at me, and it's not old-fashioned. We build on our history, but we're innovative and forward-looking. We're a fantastic city.
What I hear a lot is the lack of risk-taking, and this could be either pension funds or just the lack of investing, for example, in private companies from, pensions, and I know that's slowly changing. But if you had a magic wand to do something differently for the City of London, to, I guess, increase the capital pool, what would that be?
I'd simplify regulation. So I think the regulators have taken some great steps with the secondary competitiveness objective. But the trouble with incremental change, especially in a fast-paced world, is it's not fast enough. And if we look at some of our competitors, they have some really simple, cutting-edge regulation in certain areas. So personally, if I had that magic wand, I wouldn't incrementally change and peel back the layers, because that's really hard to do. I'd look at certain centres, I'd copy best of breed, and I'd reimagine, not amend.
This is what, for the banks or financial services in general? Is it ring fencing? Is it, something to also keep up with the US?
Yeah, it's financial services in general, okay? So in some areas we're brilliant, okay? Our regulation is great. And also we have a very stable business environment, and regulation gives us that. But if you want to encourage risk-taking, you are going to have to roll back regulation to a degree. It's that balance between risk and progress.
I mean, there's been a lot of coverage about Lloyd's of London and its previous CEO in recent weeks. Does this industry have to change?
See, my experience is no, OK? I've had a fantastic career. I've come from, I call this an accidental career, from East End to chair. I think there's always more to do in this industry. Cases like that always get profiled, but my experience is it's equal, it's fair. I've had a great career, I've had a lot of support through it, and if any women were thinking of coming into this industry, I really would encourage them. It's a great industry to be in.
Lady Mary, can I ask you about what you think of crypto? The crypto world is cozying up to Nigel Farage. Like, what does it mean for London as a financial centre?
I think it's one of the areas where we really need to focus on, because it's one of the areas that some of our competitors have as a real strength. So it's just something, I just think it's something for the city that we need to start working on. We need to get some regulations in and decide what our policy and our strategy actually is. Clarity is always good for business.
Is there, again, danger that actually the crypto world just is seen as cozying up to the more right-wing faction of politics?
See, I don't think business should be like that. Business should be apolitical. My role is apolitical. We work with the government of the day. We will support the government of the day. And for business, business is commercial. It just needs to do what's right for business.
Lady Mayor, thank you so much for joining us. Suzanne Langley there, Lady Mayor of the City of London. I know we'll speak to the Lady Mayor much more often because we're just a stone's throw, but there's also so much that Lady Mayor wants to do. Now, key U.S. inflation data due out a little bit later today, pushing up expectations of a Fed rate cut. Ven Ram, Bloomberg MLife strategist, joins us now. So, Ven, what's the data likely to tell us today?
Morning, Francina. Always great to be talking to you. I think that, the expectations on the street is that, that we will get a milder core PCE reading. But the fact of the matter is that it's going to be, if it comes out as forecast, we'll get a number of 2.8%. Now, if you look at the average for this year, that is exactly where it lands, 2.8%. So, and we haven't had a sub 2% print in more than 4 years now. So we've there's been a lot of progress made on disinflation. We progressively got down from punitively high levels to three handle, and then we have come down to a below 3 handle. But the transition from 3 to 2 isn't quite happening, and that is going to be the big question for the Fed, which meets next week.
So, Treasuries fell after that jobless claims, report dropped to the lowest level since 2022. What's the broader implication of that, Ven?
Well, I mean, what we've been seeing is bits and pieces of erratic data where, we got the ADP report showing a contraction, and then we got the initial jobless claims today. So it looks like the economy is muddling through, and the Fed is kind of expecting average growth, GDP to grow 1.8%. That is smack in line with the trend growth forecast for the U.S. economy in the long run. So if the U.S. economy muddles through, the question is, what is the right level for, say, the 10-year yield? We have been doing 4% plus, and I think that strikes me as the right thing because you've got core PCE, as we just discussed, around 2.8%, holding around 2.8%, and you've got nominal GDP growth of 1.8%. So that suggests that the 10-year yield should be above 4%, which is what we are doing at the moment.
Yeah. Ven, how much do you think, we also had Brian Moynihan of Bank of America. We talked a little bit about Kevin Hassett. He says, first of all, let's see who the president nominates. But what exactly is the market going to be focusing on away from data over the next couple of months?
I think that, they will be keen to find out, what kind of a consensus that Hassett will be able to drive within the FOMC. That is the big question, the immediate question for the markets over the next couple of months, because assuming that Hassett is nominated to be the Fed chair, I think that the question is, there's going to be a radical change to the FOMC committee come February. The composition is going to change. And what kind of a Fed 90-member committee that we will get, and whether Hassett will be able to drive a consensus thereof. And I think that, if you look at the dot plot of September, fully 5 members were already inclined to take rates below 3%. So I think that his job shouldn't be as difficult as the markets envisage. But, that is the big question for the markets going into the first 2 months of the year.
Ven, as always, thank you so much for all of your analysis. Our Bloomberg MLife strategist there, Ven Ram. Up next, Bloomberg Brief. Of course, there is quite a lot going on with the markets. We had a really good conversation with Brian Moynihan talking about the strength of the U.S. economy and, of course, the strength of the U.S. consumer, despite concerns about affordability across the board. Now, this is a picture overall for the S&P 500 futures, actually pushing higher with possibly a new record in sight. We also look at a measure of volatility dropping to the lowest since October, the dollar slipping, treasuries pretty much steady with a rate cut next week largely priced in. And then there seems to be growing confidence that the U.S. economy remains resilient in prompting rotation into stocks that I guess if you speak to investors or people on the ground, portfolio managers, that tends to benefit from domestic strength with investors gearing up for a year-end rally. Now, a couple of other things we're watching out for. Look, there's this rate cut next week, largely priced in the U.S., bets pointing to further easing into 2026. We have a couple of corporates we're watching out for example, Swiss Re here in Europe announcing its first share buyback in 5 years. Warner Brothers Discovery entering exclusive negotiations to sell its film and TV studios, HBO Max streaming service to Netflix. Up next, Bloomberg Brief, and this is Bloomberg.
edge at the
would be beneficial to the treasuries and hence the preference for that 5 to 10 year treasuries.
I am curious about what you were talking about with your colleagues there and what you were seeing amongst client behavior and whether those two things were in conflict with each other.
Yeah, I think our discussions with colleagues centered around what are the different scenarios that are possible. With respect to tariffs, the scenario was around inflation impact. And then the other aspect of the scenario was the growth impact. So the internal discussions with colleagues centered a lot around this trade-off between inflation impact and the growth slowdown impact. And then what we were hearing from our clients were certainly concerns around U.S. policy, certainly kind of discussions around how they would think about U.S. assets. But what we were not getting in the data was any meaningful shifts in the near term. Certainly over the long term, our view was that at the margin, foreign investors would likely start to think about shifting towards home, or whatever that home bias would be. But that does not necessarily mean that would be negative for foreign holdings of U.S. treasuries. And then when we looked at the data in April and in May from the Treasury auction data, what we were observing was that the auction participation by foreigners was nearly unchanged and at the level that was pre-April. So that gave us some confidence on continuing to hold onto the trade and add onto that trade upon weakness.
Our colleague Michael McKenzie doing a great job kind of capturing the drama of the moment as you and your colleagues in London and Newport Beach are going through all of this, meeting more regularly than usual, trying to hammer all of this out. And I'm curious about how you thought about the uniqueness of the moment and the circumstances that we were in and you were in as investors. Was there an historical analog that you were thinking about or thinking through, or was it really new ground that you were trying to trod?
I think there's always something new in that moment. I think we were penciling in an increase in tariffs. I think if you recall, pre-April 2nd, the tariff rate on the U.S. was closer to 2%, and our view was that we will probably get towards 10% in the U.S. But what was announced on the Liberation Day was closer to give or take 20% if you did the weighted average sum of the tariffs that were announced. And our view was that we will settle somewhere in that 15 to 18% range. So we were trying to kind of understand a lot of that and with the help of our policy experts. And then we were trying to figure out, I think what was really different was the potential change in the foreign investor participation or view. And at the same time, what it also meant to us was that we don't have to constrain ourselves to the opportunity set that is in the U.S. Certainly, U.S. markets were weakening, but so were other markets. So what we did was certainly, I think, as you mentioned, Michael McKenzie covered it very well on the U.S. side, but we were able to kind of also look at opportunities that were outside of the U.S., and those have worked out quite nicely as well this year, and they continue to look attractive in certain pockets.
You've taken me right where I want to go. So the income fund returning 10.4%. I wonder how much you're pairing your bets on U.S. debt and what those other countries are where you see opportunity in this moment and going forward.
Yeah, so I think the other countries at the moment. So what we have done is we have certainly reduced some of our duration exposures in the U.S. And the reason for that is that when you look at the U.S. market, the U.S. has been the biggest outperformer, or U.S. Treasury market has been the biggest outperformer relative to other developed market rates, relative to, say, for example, Australia, UK, and then Japan rates have gone the other way. So certainly it has created an opportunity for us to be a little bit more opportunistic elsewhere. So those opportunities are in Japan, Australia, and in UK. We can be patient in the sense that we are not saying that the rates necessarily have to go lower from here. They're starting to look very attractive on those regions, and then if they continue to weaken further, similar to what the U.S. rates were doing in April and May, we will continue to scale up, and I think that could be a good trade for 2026.
What's your general outlook right now, Mohit, as we move into 2026 for volatility, taking as the current levels of volatility as the baseline?
I think the volatility is here to stay. I think, basically what you have is a lot of kind of competing forces at play. On the one side, you have the positive effect on growth from the upcoming One Big Beautiful Bill that will go into effect in Q1 through consumer tax refunds as well as the capex aspect or the corporate capex aspect. On the other side, you have the tariff-related uncertainty and then you add to it the AI capex that is in the works. Now, again, it can certainly materialize to the degree that is expected, but there are scenarios where it may not materialize. So all of these create plenty of volatility just if we focus on in the US. And then you add to it all the other countries which are also going through their own inflation and growth uncertainties. So this volatility is here to stay, but it also creates very, very exciting opportunities for us in fixed income. I think our take is that we can construct a very well-diversified, globally diversified portfolios with a yield of 6 to 7%, which looks very, very attractive for most investors relative to cash, relative to equities, and relative to other opportunities.
Mohit, really appreciate you taking time. A real fascinating read today about just how you guys operate and, of course, the returns that you reaped as a result. Mohit Mittal, Managing Director, CIO of Core Strategies over at PIMCO, as we continue to march to those closing bells. When we come back, a conversation with the CEO of Zoetis, Kristen Peck, going to stop by to talk about how the animal health company is planning to try to turn things around just fresh off the heels of their Innovation Day. Speaking of turnarounds, we're also going to catch up with the CEO of MoviePass. Remember that? Well, he's back, and he's actually got a different business model. You don't want to miss that. That's coming up next. This is The Close on Bloomberg. All right, let's get you to some of the most talked about stories in the world of business, including Paramount's Skydance, the media company actually accusing Warner Brothers Discovery of failing to conduct a fair auction in that sales process, saying that it's become a bit too tainted. A letter to CEO David Zaslav, attorneys for Paramount said WBD favoring a rival bid from Netflix. Warner Brothers responding by saying their board is, quote, fully and robustly complied with their fiduciary obligations. Next, let's take a look at Kroger. Those shares were actually down a little bit earlier in the day. This after the grocery store chain lowered the top end of its full-year sales forecast in the latest earnings report. The move offering a note of caution that shoppers are actually being choosy due to uncertain economic conditions, even for essentials like food. And finally, remember that big outage that we had at the CME last week? We're keeping an eye on that because Goldman Sachs is pressing pause on a planned $1.3 billion mortgage bond sale from the operator of that data center, CyrusOne. CME and CyrusOne, one of the world's largest derivatives exchanges, experienced that major outage hit over the Thanksgiving holiday. It became a wake-up call for investors taking part in the AI data center boom, showing that lease agreements can be breakable in the event of multiple recurring outages. David?
Well, coming up, Ulta Beauty is set to report earnings after the bell today. D.A. Davidson's Michael Baker joins us next with his short list of what to watch. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
This year, more than 1 in 4 cars sold worldwide will be electric. By 2030, that number will climb up to 40%. ASEAN has everything that the global EV industry needs. Bangkok Bank isn't just a lender. We are a connector. We are building a seamless EV supply chain, from raw materials to final assembly. สามัคคีคือพลัง Together we are strong.
Time now for our top calls. Some of the big movers on the back of analyst recommendations. And we're going to start off with the airlines today. A new analyst over at Citi initiating coverage of the group with a new buys on United, Delta, and American Airlines, and a sell on JetBlue. Some neutrals on some of the other smaller carriers, with the main theme in that report talking about the super major airlines primarily being the beneficiaries from an elongated mid-cycle starting in 2026. Most of the airline stocks nevertheless down here on the day. Next, Lumentum Holdings. Rosenblatt upping its price target to a street high $380 on the optical and photonic product makers, up from $280. The analyst calling Lumentum the single best position name in its coverage of the AI scale. Those shares up for a second day to a record high. And finally, another street high price target, this time for Macy's. Jeffrey's going to 26 from 1850, maintaining the buy. The analyst saying Macy's more conservative fourth quarter forecast makes for an achievable near-term setup. Nevertheless, those shares down for a third straight day. And those are some of our top calls. We want to stay in the consumer space right now and turn to Ulta Beauty. The makeup retailer expected to report earnings after the bell tonight. Another data point investors are watching to gauge the health of the consumer as well as their willingness to spend. Michael Baker joins us right now, senior research analyst over at D.A. Davidson. Michael, I always thought that beauty was supposed to be recession-proof, economic-proof. Is it?
More resilient than a lot of spaces, I think. I think we'll see a positive comp when they report. Consensus is about 3. That's probably about right. Maybe a little bit of upside. I don't think it'll be as strong as the 7% comp last quarter, but it should be a fairly strong quarter. One of the issues with Ulta, and we do like it here, but the consensus estimates for the full year are already above the high end of their guidance. So we think they'll raise their guidance. They have to raise their guidance because that's already in the consensus estimates. But we think that there's enough there that they will be able to increase their guidance this year.
Michael, talk a bit about how this company has navigated some pretty difficult headwinds here. And the CEO was profiled in Bloomberg Businessweek a short time ago. She talked about how she wants to expand the geography, the footprint of this company at a time when we know because of tariffs and trade policy, getting materials and doing that kind of building is difficult. How do you square her ambitions for the company, that level of growth, with the amount of caution that we're seeing so many other companies evince?
Yeah, I just think there's a lot of white space there for them. They did have some increased competitive pressures over the last couple of years when Sephora was rolling out their store within a store concept in Kohl's stores. There was about 2,000 of those locations. But that is now behind them. They fully absorbed that. In fact, that's not really growing anymore. So Ulta sees some white space now that Sephora is not growing as much. So they're growing domestically, about 60 stores a year. By the way, they're also growing internationally. They made an acquisition in the UK. They opened in Mexico, and they just opened in Kuwait, believe it or not, using joint ventures or other local partners. So they're growing both domestically and internationally.
Hey, Michael, when you think about kind of like how Ulta came to be, and obviously, it was more than just about going in there and, buying a lipstick or a facial serum. It was about kind of the experience inside the store. I am curious as to how you think they can replicate that going forward as they expand, and more importantly, as they have a much larger presence online rather than in physical stores itself.
Well, it is omni-channel, and we've seen that from a lot of retailers. Customers will start the journey online and then go into the store to be able to test and try on different things. The way Ulta started and their point of differentiation, and I think it still exists, is they're really the only place that has both prestige and mass, at least in a physical location. Certainly they compete with Sephora. But Sephora is primarily prestige product. They compete with drugstores and other mass retailers, but again, they don't have the prestige. Ulta is really the only physical retailer that has both mass and prestige under the same roof. And we think that's still a compelling differentiation for the consumer because she likes prestige for some of her products and mass for other products.
Michael, really quickly here, what can this company do more to get its name out there? You talk about that prestige, but it does seem like in terms of name recognition, Sephora does have something of an edge, at least anecdotally.
Well, I think keep growing stores. Stores act as a billboard. They have one of the best loyalty programs in retail, 40 million plus strong. They do promote advertising. But at the end of the day, I think a lot of people we talk to in our world maybe are more in tune to that prestige customer. Mm-hmm. But again, I think that so that would be more of a Sephora customer. Sure. But they target not just that customer, but also more of a mass customer. And we think they have pretty good brand recognition.
Michael, great to catch up with you before these earnings today. Michael Baker, senior research analyst at D.A. Davidson, joining us here on The Close. Coming up, Zoetis CEO Kristen Peck is going to join us exclusively for a conversation on the heels of the pet care company's Innovation Day. That's coming up here on The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic. We want to talk about healthcare right now, and specifically animal healthcare. Zoetis hosted its Innovation Day earlier this week, trying to convince investors of its long-term growth strategy. Now, it has been a tough year for the shares of the animal health giant as it faces skepticism tied to a faltering pet care business and its pivot away from the livestock category. Joining us here in Studio 2 right now for an exclusive interview, pleased to say, is the CEO of Zoetis, Kristen Peck. Great to see you, Kristen.
It's great to be back, Ramin. Thanks for having me.
It's been some time, and you're back in New York talking to investors, kind of laying out not so much the short term, but really the long term. And I think for any company involved in healthcare, particularly when it comes to drugs and biologics and things like that, this is a long-term story. What is that story?
So we were really excited, as I mentioned, to do our innovation webcast on Tuesday. And it's really about showing how we're shaping the next era for innovation in animal health. We laid out what's going to be 12 blockbusters in a really robust and diverse portfolio that will have us launching and seeing a major launch, every year for the next few years. So in really important areas of unmet medical need in animal health, such as chronic kidney disease, oncology, cardiology, obesity, anxiety. And even over the next few years, that'll be $5 billion in new addressable markets that there really aren't products for today.
When you talk about the diversity of that lineup as you move forward, where is Zoetis going to fit in terms of ranking? Are you going to be like the number one player in each of these categories, or does that not matter?
Well, I think what's most important for us is making sure we launch best in class. Mm-hmm. We have been first to market, and we've created markets, whether you look at the dermatology portfolio we have with 3 products, which is Apoquel, Apoquel Chewable, and Cytopoint, which is a monoclonal antibody. If you look at parasiticides, we have a portfolio in OA pain. We're really excited about chronic kidney disease itself. Will be a $3 to $4 billion market with really no products, that exist today. And we have 7 assets that we spoke about. One of the leading ones should have approval in 2027. So we, really see us as, becoming the leader in this. And we see these as new categories where there really are no therapies today.
Now, for those people who aren't familiar with the structure of your business, basically split in 2, oversimplifying it. Pet care, companion, what you call companion care, but basically the stuff we buy for our pets to treat our pets, and livestock, obviously people raising animals out in the farm there. Talk first about the companion side of the business, because I always viewed that as a part of the business that should be sort of resilient to economic cycles and other things, given the way that most of us value our pets.
Well, you're correct. So we have about 65 to 70% that's pet care, and the remaining that's livestock. And pet care has been growing faster than livestock, historically, both for the industry and for Zoetis. And I think what's really, about both sectors is they're really got structural, fundamental growth drivers. And what really drives the pet care space, as you talked about, is more and more people adopting pets and the humanization of pets, the human-animal bond, where they want to spend more. And importantly, that's being compounded right now with pets living longer. We've extended the life of pets, and so as more pets live longer, they're getting more chronic diseases. And that's why the opportunity in areas such as chronic kidney disease or oncology or cardiology will be even more important. And, people's connection with their pets, even if they're in difficult economic, challenges, they're still willing to spend on those pets. So you can see short-term stress, as we've seen some of the vet clinic visits, in the quarter decline. Mm-hmm. But overall, these aren't structural changes. The structural fundamentals that really drive the growth is more and more people adopting pets, more and more people wanting to spend more on those pets, and those pets aging. And that's not just in the U.S. and in developed markets. We're seeing similar growth rates in pet care across the globe.
And you can think those growth rates will be stable or even continuing to increase over the years to come?
Yeah, so historically, the animal health industry grows 4 to 6%, and you see pet care grow a little faster and livestock grow a little slower. But again, with more and more people adopting pets, spending more on those pets and those pets aging, we do believe that those structural fundamentals will continue.
One of the criticisms of some investors of the strategy that you've taken is that you have put a lot of attention on the pet care business. That's a plus. Mm-hmm. Some people think that it's been done at the expense of the livestock business.
We are very committed to livestock, and we've had our 3rd consecutive year of above-market growth in livestock. We actually printed 10% in Q3 in livestock, so we're very committed. Where we pivoted in livestock, which might be what you're referring to, is to really focus more on preventatives and genetics. Because more and more what we're seeing is consumers don't want to use treatments. They don't want to use antibiotics. They want to have, eat protein that's free of those things. So we're really focused on making sure that we can breed animals less likelier to get sick, and that we can give vaccines and preventatives to keep those animals healthier. And that's really where the above-market growth is in livestock, is in the preventatives and genetic space. So that's why I think you're seeing sort of the above-market growth rates that you've seen for the last 3 years consecutively.
How far along are you, though, in new products, specifically in that space?
We've been doing great. I mean, livestock is a little different than pet care, where we launched blockbuster products, which in animal health are products that are at least $100 million. In livestock, these will be vaccines. So you saw us get conditional license, in the last year I was on your show talking about avian influenza for both poultry and then dairy cattle. We got a conditional approval for Dectomax for New World screwworm. So we're on the leading edge of that, but we're also launching products like Procerta for chickens and Protivity in cattle. So we're constantly launching what we call maybe more singles and doubles in that space, which investors sometimes have a hard time always modeling. But we're getting around 200 plus approvals a year in geographic expansions and life cycle innovations in some of these spaces that maybe don't make the slide as a blockbuster more than $100 million, but are going to consistently drive livestock, which has, as I said, been a significant growth driver for Zoetis over the last 3 years.
With regards to the regulatory environment, I mean, to have this ambition to sort of put out one new big thing every year on that cycle, are you confident in the regulatory process is going to be supportive of whatever is going to match, I should say, the pace that Zoetis actually makes in trying to get those things to market?
Yeah, I think what really differentiates Zoetis is we have a different R&D approach. We call it science to scale. And it starts with a deep understanding of what the needs are, both at a pet owner and a vet space. So we're not just, innovating without a sense of what the market can bear and what regulatory authorities are interested in seeing and are willing to approve. So a lot of the targets we talked about on the call on Tuesday are validated targets already in humans, where we think there's clear pathways for approval for these products. They're monoclonal antibodies, which we're already the world leader in. We recently received approval for 2 more monoclonal antibodies. We got for Lenivia, which is OA pain for dogs. Yeah. We've got approval recently in both the EU and Canada, and Portela, which is OA pain for cats. So we are seeing the regulatory authorities across the globe see the significant unmet medical needs and be approving products. So yes. I
do have to ask you about the share price. I mean, you're coming up on the 6 years anniversary, I believe, as CEO. The first few years, I mean, you did very well in terms of returns to shareholders. You had a big drop in the stock price last year. It's down again here in 2025. What is the conversation that you have with investors who are worried about the lack of return?
Our focus at always as Zoetis is driving top-line growth and driving bottom-line growth faster than the top line. Historically, we've driven about an 8% compound annual growth rate on the top line. We've also done that with great cost management. So if you look at even at Q3, we had about a 72% gross margin and a 42% EBITDA margin. So it's also focused on that. And as my leadership team is focused on delivering innovative therapies, growing the company, and delivering on the bottom line, and that's what we're committed to continuing to do.
All right, Kristen, we really appreciate you taking time for us.
Thanks so much for having me.
That's Kristen Peck. She is the CEO over at Zoetis. All right, when we come back, we're going to go back to the broad market and take a look at the big movers of the day, and that includes Meta. Bloomberg reporting that Mark Zuckerberg planning to cut the budget for the metaverse by up to 30%. That's our stock of the hour, and it's up next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We don't see the robots taking over the jobs from humans. We try to make the job of the humans easier and to have more technical people that are really controlling the robots and especially improving the quality by utilizing those technologies. We have already deployed a first phase of robotics through Boston Dynamics, and we are working on the next phase on how can we facilitate the job of the workers.
All right, time now for our stock of the hour. Meta having a pretty good day here in the wake of a report by Bloomberg News that the CEO, Mark Zuckerberg, is expected to cut resources for the build-out of the metaverse, remember that, by up to 30%. The move higher in the shares indicates possible relief from investors who maybe saw the spending on the metaverse as a bit of a drain and a distraction on resources. Bloomberg Markets correspondent Nora Melinda joins us now to talk a little bit more about that. First, I want to start with the 30% because I saw that number bandied about. What do they mean by a 30% cut? A 30% cut in what exactly?
So there's always about a 10% cut that we see at the top of the year. And this is just for them to readjust and figure out what's going on money-wise to make sure that everything is running smoothly. But this additional 30%, it's expected to potentially hit the Reality Labs division, which we know has really been in focus because of the metaverse. They're the ones that are the behind the scenes. They're the ones that are brains behind this entire thing. But also Ray-Bans and any sort of augmented reality, any sort of virtual reality, that's what that division does. So that's where we're expecting layoffs to hit there in particular in terms of that 30%.
Must be nice to be an executive at Meta. You get flown over to Hawaii and get to hang out at Mark Zuckerberg's manse and have these conversations. What do we know about what was actually discussed, the degree in which there was some introspection about when Meta made this bet, how all in they went on this bet, it seemed, and sort of how they're reckoning with the fact that it isn't panning out the way that they thought they would?
Well, you're clearly seeing investors are celebrating, right? We're seeing the stock is lifted higher. So that's telling you what Wall Street thinks about this. I think on the other end, when you think about the executives, they've had a couple years really to see some sort of returns on this investment. And we're really seeing a lot of push from Wall Street for them to spend more money on AI, whether that is the Ray-Bans that we were just discussing and developing that further, instead of spending too much money on the virtual reality. I don't know if you guys use virtual reality, if you ever decided to go into that, but I don't really have that many friends, nor myself, that are living, shopping in this virtual world here. So they're starting to realize that maybe they were a little bit too early here.
I mean, you probably can't answer this. I mean, I know you're not an expert on AI, but I always thought that there was some overlap between what he was trying to do in the metaverse and what these companies are now trying to do on AI. I mean, there's not some compatibility or symbiosis there?
I mean, I think that's what people are trying to figure out, what trends that they're able to pull over from what they were thinking about doing in the metaverse, which, you know, I think he thought he was ahead of the time when we think about Zuckerberg here and his thought process and pouring a lot of money into it. But they're really seeing that it's not paying off here. So it's about whether or not they're able to redistribute the money that they were putting here into other things to remain competitive.
I feel like, wrong me if I'm, David, if I'm wrong, I feel like we've been through this cycle before with Meta, where they invest a whole lot of money in one thing. Everyone kind of says, okay, they're nuts. And then at some point they stop investing in it. And then Zuckerberg finds another shiny object, rinse and repeat. How does this keep happening? What's happening?
That's a great question. I mean, I still remember how this was debuted and kind of the weird virtual world that he was in. And
no legs.
Feels like yesterday.
No legs.
Yeah.
I remember that.
We were supposed to shop there, work there, eat there, work out there.
Can I ask you to situate this in kind of the broader market? Talk about the reaction that we saw. I mean, the stock really popped as soon as this report.
We did see the stock pop. We really did see some strong gains here, of course, leading the Mag 7 stocks today. So, I mean, when you think about this in the context of the broader AI story here, a lot of people have been worried about the spending on artificial intelligence more broadly. People talking about a potential AI bubble in the market. And when we think about Meta zeroing in there were a lot of concerns about how they were spending money on artificial intelligence. So this is essentially an opportunity that investors are seeing for them to redistribute the money they were spending there into something that they think will actually pay off.
Nora, thank you. Norma Linda here with us in the real world on set in New York. Many thanks for that and that update on the stock of the hour. Coming up, we're going to take you to the closing bell with Berkeley Belknap, head of U.S. portfolio management for Franklin Templeton Investment Solutions. That's coming up here on the close as we move ahead to market close in just a few minutes' time, right here on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
At Virginia Housing, our mission is to help Virginians attain quality, affordable housing. We're one of the top housing finance agencies across the United States. Having a partner like Wells Fargo that is consistent, that we can rely upon, is so important, and it enables us to try and test things that some organizations frankly can't do. Together, we're serving the community. We're serving businesses when they want to come to the Commonwealth. We're serving the future of Virginia.
Welcome back to the close. Just about 10 minutes until we get to those bells here. A mixed day on Wall Street, David. We talked about that, I guess, decent rally that we had yesterday that seemed to suggest a turnaround in the market, but today a bit of a pullback, at least for the benchmark.
Yeah, so we talked about Meta just a few moments ago. Put that up there and see that we've seen Meta here climbing about 3.5%. It was up about 6% earlier today, so we've seen it come in some. But look at the S&P 500. It was flirting with a record a little bit earlier today. We've seen it kind of even out. Not a whole lot of movement there on that index as the day has worn on as we get close to the closing bell. Bitcoin so tied up to this conversation that we've been having about the prospects for tech and risk assets. We see it climbing above 90,000 today, but still down about 1 1/3%. I continue to pay attention to small caps. Russell 2000 here up about 0.75% over the course of the day. Some optimism there still among many corners of this market that we're going to see some movement there in small caps that will sustain.
And, you know, Dave, I'm actually really fascinated by some of the moves we've seen, not only in the small caps, but in the mid caps as well, relative outperformance. And, I mean, it seems to suggest that despite some of the red that we've seen on the screen as of late, that there is more of a rotation going on rather than any type of a sell-off.
And I think some hope for those who've worried about the concentration of this market. That's been the case for so long now. Magnificent 7, 6, 5. You pick your number there, but it's a single-digit one, and I think there's been some optimism here pervading the market that it's going to start to spread beyond those handful of mega tech companies and move to others as well.
Let's get some insights out of Berkeley Belknap. Joining us right now is to count you down to those closing bells, head of U.S. portfolio management for Franklin Templeton Investment Solutions. And Berkeley, I do kind of want to start off with some of the market moves that we saw in November, despite the fact that it was somewhat of a down month, at least those first 2.5 weeks or so. But that big pickup that we saw towards the end of November, and it seems to be carrying over into December, was not at all led by big tech. It was sort of a lot of the other names out there. And I am curious if we can read something into that, something that might be indicative of where things go in 2026.
Yes, I think that's a great point, and thanks so much for having me today. That pullback in November is something that we really did expect to see, given the incredible momentum that we saw in the markets, through the summer and the fall. And those types of moves in the markets are natural, and we do expect them from time to time. We did see the end of the month, the markets really come back, and we've seen positive momentum, headed into what we often call the Santa Claus rally. December is, historically a really strong month. It's the strongest month of the year from a statistical perspective. I think that it's been up about 72% of the time. And as long as there is, continued momentum, we would expect to see a positive December. A lot of that now rides on the Fed and the cut that's expected next week. But to your point about, the diversification that we've seen in terms of performance, you've seen the Mag 7 and the strong growth companies really pull back, and there's been more breadth in performance in recent weeks.
Yeah.
So you mentioned just before small caps, mid caps, number of other types of companies.
So what sustains that, Berkeley? I mean, it can't just be the Fed. I mean, usually when you see bets on these types of companies, it's also a bet on economic conditions holding up.
Absolutely. So the Fed kind of gives us the momentum. It gives investors a little bit more confidence. But obviously, we need to see companies continue to deliver earnings over time. Also, as we start to see the labor numbers that come out, they've been delayed. The Fed's not going to have that information for November when they make their decision next week. But I think we'll be reliant in December on some of the economic data, both on the labor numbers as well as inflation numbers.
Could you talk a bit about how you've been finding your way through all of this, not having that data that you would have customarily? So yes, it's a big issue for policymakers as they make those key decisions on interest rates. But for you as well, how much are you, other portfolio managers, fumbling a little bit here, not having a more holistic understanding here of the state of the U.S. economy and the global economy?
It's been an interesting challenge. And I would say we've relied primarily on private data and then now the lagged government data that's been coming out. But certainly it's been a challenge, and there's some data that we may not even end up seeing. But the November data has been delayed so that it's going to be mid-December before we even have that. From our perspective, we don't see the labor market collapsing. We see it softening. And so the numbers that we've seen thus far support that. And so we would expect that, with the softening labor market and the data that the Fed has thus far, that they will go ahead and cut next week. And I think the market is seeing that and expecting that. And that's been really the impetus for the positive momentum that we've seen in the market.
Berkeley, I was at the DealBook conference yesterday here in New York, sitting up in the rafters, and I watched as the Anthropic CEO talked about the prospects of there being some economic constraints on AI. You're talking a lot about the technological potential here, but recognizing the fact that there are real concerns about the economic promise living up to what I think a lot of people think will happen here. I'm curious, when you look at the surface tension of the bubble or whatever it is, or what you're thinking in terms of your commitment or resolve when it comes to the prospects of AI that's been really driving this market.
it's just been an incredible movement, both from the stocks as well as the investments. The size of the capital expenditures that we've seen from the Mag 7 and big tech companies is really extraordinary. And it's been called a bubble. We think that we're sort of in not the end stage, but the stage where you still want to be invested in a really new and growing technology. But the challenges are there. And the challenges are there both from the extent of the amount of money that is needed to invest in capital expenditures, to produce the facilities and to produce all of the background, everything that's going to be required to make this come to fruition. Yeah. In addition, there are a lot of challenges on the energy side and the infrastructure side. And that in time actually may be the biggest challenge to the growth is just, do we have the infrastructure to support it?
I am curious with regards to kind of the setup into 2026, Berkeley. We talk about the gains that we're seeing in the U.S., but we kind of forget sometimes that a lot of the gains that we're seeing here are actually being outpaced by what we're seeing in Europe and, for that matter, emerging markets. I am curious if you see opportunity for a meaningful allocation to some of those assets at the expense of U.S. assets.
Yes. So as portfolio managers here within our solutions team, we are multi-asset investors. So we invest in multiple asset classes across the world. So we are always having exposure into different asset classes and different geographies. And so always looking at sort of where we see strength. And as we came into 2025, you heard most of the world, or many people talking about, is this the end of the age of U.S. exceptionalism? And we really did not think that was the case. But we saw, really strong outperformance by diversified or developed international countries as well as emerging market countries through the year. And thus far this year, the index that has had the strongest performance has been emerging markets, followed by developed international. So going into, sorry?
Sorry, Berkeley, I have to cut you off here. We're up against a break here, but that's a really salient point, and we've been talking about that a lot on the show. We have to get you back here to expand on that idea as we see the outperformance on a year-to-date basis by a lot of stocks overseas. Berkeley Belknap, head of U.S. Portfolio Management for Franklin Templeton Investment Solutions, as we turn our attention back to the U.S. with those closing bells just about 2 minutes away. A full breakdown of all of today's market action, that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside David Gura taking you through to that closing bell with a global simulcast. It starts right now. Carol Masser in the radio booth. Alexis Christopher is in today for Tim Senovic. Katie Greifeld on assignment. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A mixed day on Wall Street. And a reminder, Carol, the last gasp of this earnings season coming after the bell tonight.
Yeah, absolutely. HPE and Ulta reporting after the closing bell. I got to say, the market just searching for direction. What's interesting, our Bill Maloney was here in studio and said, I'm like, what happened with the market? And he's like, well, I don't know. Bitcoin went down. We saw the market go down. Bitcoin went back up, and we saw the market go back up. But it's really interesting to see the two mirror one another. But I just think we're searching for direction here.
And nothing's really going to happen until next week, folks. I mean, let's get real, right? We've got the Federal Reserve, really the only catalyst on the docket, aside from these few, earnings reports that we still have to get through. By the way, I just want to point out, oil is up today. WTI up better than 1%, Brent up about 1%, and gold, not to be left out, now above 4,200 an ounce again.
Alexis, you bring up the Fed. I think that is the driver here for so many people in this market today. Of course, a lot of news about the personality of the Federal Reserve. What's going to happen with the Fed chair when he leaves that time? Who's going to fill in that job? The reporting from Bloomberg that Kevin Hassett, the leading contender to take that job, be nominated by the president. And then the follow-on news today reported by Bloomberg that there are folks in the administration talking about him moving into that job, and perhaps Treasury Secretary Scott Bessent becoming the head of the NEC. Just a lot of changes in the White House and the Federal Reserve as well. Yeah, I encourage anyone who has a Bloomberg terminal, run the work function on your terminal, and you'll get a sense of what David is talking about, a market pricing in near certainty for a rate cut next week. But beyond that,
Well, it's not even a coin flip here. Nobody really knows what's going to happen next. As for today, we know what happened. You see it on the screen. A Dow Jones Industrial Average is going to finish the day in the red as we wait for these numbers to settle down roughly about 30 points or so. The S&P 500 is going to finish in the green, higher by 7 points or 0.1%. The Nasdaq up 0.2%. And the Russell 2000, which at one point was flirting with a record high, going to fall, come in just short of that. It did rise up about 19 points or 0.8%.
All right, that's the small caps, the Russell. But I'm going to go back to the S&P 500.
Oh, wait, I correct myself.
What?
That is a record high for the Russell 2000.
Ah,
yeah.
That's
I corrected myself before you could.
Mea culpa, very good.
I didn't want to do
Hold
that
it
to you.
out.
See how kind I can be? Yeah. All right, S&P 500, 252 names to the upside, folks. You've got 249 losing ground. 2 unchanged.
And we take a look at the IMAP, the circle as Katie Greifeld will call it here. And it gets to this idea here of the rotation that we've seen over the past few sessions. This idea that it is industrials and it is energy and financials that have been leading the charge. Tech did get a bid in there, but we should point out a big part of the reason why you see tech in the green today is because of that big push up by Meta.
All right, so let's go there because that is my number one gainer. You can see it playing out. It is the number one gainer, in fact, in the NASDAQ 100 stock. Finishing off its highs, at its highs was up about 5.7%, but finishing with a gain of about 3.5% for the Thursday trade. That exclusive by our own Kurt Wagner on how Mark Zuckerberg is expected to cut resources when it comes to building out the metaverse. Remember back in 2021, that's what it was all about. They changed the company name. It was going to be the future of the company. Sounds like they are dialing that back. Executives have apparently discussed potential budget cuts as much as 30% for the metaverse group next year, and that could.
Did you see the joke online now? Everybody's trying to buy up domain names that they think Meta's going to when they change their name to something AI or whatever.
I said to Kurt, "Do you think it's going to be Meta AI?" And he's like, "I don't even want to report
why not,
that up.
man? If it costs a couple $100, you may make a few million."
I love. All right, let's go to Dollar General. As you mentioned, Romaine, we are still getting earnings. We got a lot of that from the retail community this week. This stock pretty much finishing at its best levels of the day, up 14%, number one gainer in the S&P 500. Dollar General raising its full-year outlook, highlighting value-focused retailers are winning over consumers hunting for deals. So interesting when you see people looking for deals, maybe trading down even at a Dollar General. They did cite some share gains in both its consumable and non-consumable categories, suggesting its low-cost groceries are winning over customers. And then one more, something a little different, GE Vernova. This was a top gainer in the S&P 500, up about 4.5%. Barclays analysts coming out, maintaining an overweight, raising the price target from $710 to $720. Some company news, they won a repeat wind turbine order from Greenvolt in Romania. I just thought I'd throw that in, a little extra. Stock is up about 93% year to date. So talk about some outperformance here.
Yeah, well, how about a little underperformance? Because I'm looking at the decliners. Intel leading the pack there for the S&P 500 today. Not a great day for Intel investors. Stock up about 7.5%. But you know what? It's still up about 100% year to date, coming off strong Q3 numbers. But Intel says it's going to keep its networking division in-house. So this reverses plans that it had to spin it off or sell a stake. And it also has ended talks with Ericsson, which we know had been exploring a potential investment in the network and edge group there at Intel. So Intel down more than 7% today. Also among the big decliners, Wynn, not really winning today. Wynn Resorts. There was a warning actually from Marriott earlier today. They were at a conference and Marriott was talking about possible weakness in the U.S. market. That sort of dragged travel-related stocks down. Wynn was one of them. But also Wynn Resorts told investors that almost 90% of revenue from its new UAE project could come from gambling. So I don't know if people love the fact that so much of revenue is going to be,
Everybody loves gambling, it seems.
And we're getting casinos here in New York. So, yeah, I think you're right. By the way, so Wynn off more than 4% on the day. Also down about 4%. Kroger today, it cut its sales guidance. Shoppers get choosier. We keep hearing this theme, increased competition from places like Walmart. Also, they're going to go back to paper coupons at Kroger. And they're also going to expand their private label brands, which we see
Repeat that?
people do.
I missed that part of the story.
Clipping.
That's the future?
Yeah.
I know, get your scissors out.
Everything old is new again, I guess.
Okay, well, I guess my grandmother's sharing that. All right, let's take a quick look at yields. Another move higher pretty much across the curve today. I guess you could kind of call it a parallel shift, 3 to 4 basis points pretty much from top to bottom. And I think, Alexis, you kind of hit it on the head a little bit earlier, this idea that this is a market right now kind of in waiting for next week, next Wednesday, where we do get that Fed decision. And almost near certainty we get a 25 basis point cut, but more importantly, what comes after that, not just with rate cuts, but of course with Fed leadership.
All right, let's go to some earnings crossing. Again, the retailers continue to report. I think this is where Romaine shops. Zoomies up about 8.25%.
My dog loves it.
Just saying.
His hoodies, you know, they're all from Zoomies.
I just want to quickly say third quarter net sales beating estimates. And so investors definitely running into this one, Romaine.
Stitch Fix, Ulta also crossing the wire right now. So too is Hewlett-Packard Enterprise. The share is moving higher. The knee-jerk reaction after the release of the results up about 3%. The company says that in its most recent quarter, adjusted EPS beat pretty handily, 62 cents a share. The street was looking for 58 cents. Server revenue, a key metric that everybody has been keeping an eye on, coming in light, $4.46 billion. The street was looking for $4.7 billion if you round up. Now, going forward, the company says that for the full fiscal year, this is the current year that we're in right now, it is raising that guidance for fiscal 2026 here. It says adjusted EPS will be in a range of $2.25 to $2.45. It had previously seen $2.20 to $2.40, so basically raising that range by a nickel on both ends. As for revenue, $9 to $9.4 billion, and that actually is below street estimates. $9 billion to $9.4 billion is the range that they're giving for revenue for the full year. The street, David, was looking for 9.9.
All right, we've got Hewlett-Packard Enterprise just down about 0.4%. Let's go to Ulta, which is up about 1.6% here in the aftermarket. This company's been outperforming this year, up about 23% year to date. Here's why investors are enthused in the aftermarket. Ulta sees fiscal year comp sales up 4.4% to 4.7%. It had seen a rise of 2.5% to 3.5%. So that is certainly an upbeat forecast. Also sees fiscal year net sales of $12.3 billion. It had seen $12 billion to $12.1. So again, upping its forecast for fiscal year net sales. Company says it sees fiscal year net new stores up 62.6%. Had seen about 63%. That's 62.6, smack in line with what the street's expecting. And just going back to third quarter EPS, big beat, 514 versus an estimate of 461. Third quarter net sales also beat, 286 billion versus the estimate of 2.71 billion. And guys, we've got Ulta up about 3.4%. This was a subject of a Bloomberg Business Week cover story.
Yes.
They've been firing on all cylinders.
All right, let's stay in the retail space. Stitch Fix, much smaller company out. The shares, though, getting a nice little pop. In the most recent quarter, the company is still posting a loss, but revenue did come in slightly above expectations. As far as the forecast goes, the company says expect a first quarter loss, for the second quarter, the company is saying that it will actually flip that loss to a profit on a continuing basis. Also says that it sees revenue in the current fiscal second quarter of 335 to 340, the low end of that range, well above the average of street estimates.
It's a huge week for retail earnings, and I think at a moment we don't have a whole lot of data. We're getting dated data as it comes in here. This insight that we get into the consumer is just fascinating. And again, from both this company and from Ulta Beauty, you see that there is still a willingness, it seems, among a lot of consumers to go out and buy stuff, despite all uncertainty and concern about the economy.
And also, I think Stitch Fix, you know, as more and more people look to save on clothing and as apparel companies have to deal with tariffs, I think that this, you know, news from Stitch Fix is actually to be applauded.
Yeah, I mean, listen, I think for all the retailers, what we have been hearing a lot is about consumers. They're out there spending, but they're being cautious and careful about how they do it. Hey, as we say goodbye, Ulta up about 4.3% here in the aftermarket. HPE also just out with earnings. They're down about 2.8%. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. David and Romaine continuing there over on the TV side, and Alexis and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time. Well, I'll be actually off tomorrow.
She loves long goodbyes.
I won't see you till Monday.
This will go on for a couple more minutes.
Shush. We'll see you guys later.
And our coverage does continue here on Bloomberg Television. A deeper dive into some of those earnings, including HPE. Patrick Moorhead going to be joining us after the break. Stick with us. This is The Close on Bloomberg.
The count.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Down is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romain Bostic here. Just about 12 minutes ago, the markets closed, and it was a mixed bag here. We take a look here at the big board. There's the S&P 500 up about 0.1% on the day, but the Russell 2000 was really the star of the show. Outperformance for yet another day, 0.8%, 25.31 and change. And you know what, folks? That's actually a record high. The Russell 2000 getting back to its highs before the S&P, before the NASDAQ, before the SOX, and that really is representative of the rotation that we've seen in this market away from some of those mega cap, the big winners of the year, and into, well, some of the laggards. And the big question will be whether that continues into next year. Yields will be a big part of that picture. They are moving higher instead of lower, unfortunately, up to about 4.1% on the 10-year, though that could change in a big way once we get the Fed meeting next week. As far as some of your individual movers, Meta having a very good day here on the back of a shift in its spending on the metaverse, saying that it's going to actually, based on a Bloomberg report, could pull back some of its spending in that space by about 30%. Applied Materials also having a good day. In fact, 9 straight days, longest daily win streak for that stock going back to 2016, closing today at a record high. And look at this, Wells Fargo and actually all the banks actually doing pretty well. Wells Fargo up yet again for yet another day here. And we talk about this idea of where the benefit is coming from. And of course, for a lot of people, they're looking at rates and that shift in the rates market. Wells Fargo, I should point out, closing the day at a record high, and Campbell's just can't get out of its own way, down for a third straight day now at its lowest levels since 2009. Meanwhile, we want to go back to some of the moves and the after-hours trade. Hewlett-Packard shares have been bouncing between gains and losses, now down about 3.5% after coming out with earnings and, more importantly, a sales forecast for the current quarter that falls short of what analysts have been looking for. A lot of questions right now about the high expectations investors have for AI sales. Patrick Moria joins us right now, CEO and Chief Analyst at Moore Insights and Strategy. And Patrick, I mean, the numbers themselves, I don't know if they tell the whole story, but there is a bigger issue even coming into today about not only what the AI spend is, but who actually is benefiting from this. And I just want to know, where does HPE even fit into this conversation?
Yeah, so HPE fits pretty nicely into the AI discussion. First of all, they've got a very unique solution for what people are calling sovereign AI cloud. And that's countries and even specific customers who want the AI goodness on premises under their control. HPE is also, quite frankly, the supercomputer leader out there. If you look at the top national labs that are using a combination of AI and high performance computing, most of those systems are based on HPE. And then the final piece is the connectivity, right? One of the biggest gating items here in AI is the ability to move data inside of the AI server rack, but also across and then between data centers. And HPE's networking hits all of those check boxes.
There's been a big question about whether the investment and the potential growth in top line revenue is actually going to translate into bottom line numbers, basically higher profitability, wider margins. Do you see that coming?
So the HPE trade, the AI trade, particularly with these largest customers, these largest build outs with neo clouds, these giant sovereign clouds, very lumpy business. And ultimately, I do believe that the math will work for HPE, and quite frankly, it has. And if I look at across the line of everybody who plays in here, typically the margins are a little bit lower, directly related to the size of the deal. But if you look at the value add on top that HPE has that, let's say, other companies don't have, they have the networking play, which very much is a margin adder. And if HPE can include networking in those big AI deals, it is margin richer than just selling a server and storage on its own.
You know, Patrick, one of the reasons why I wanted to talk to you today is because you really are a nice bridge between kind of, I guess, the last big sort of boom in tech and the current one we are. I mean, for those that don't know, you actually worked at, what was it, Compaq, right, which eventually became a part of Hewlett-Packard. You were at AMD for a lot of years. So you've had a front row seat to the build out of the internet and all the hardware that went along with it. And now this big build out in AI and whatever infrastructure goes along with it. What are the parallels, if at all, that you see?
Yeah, so I was actually at a .com in between the Compaq and the AMD during .com. We were the high flyer search engine. I will tell you that the math looks a lot better here in the age of this agentic AI build out than it did in the internet. We had dark fiber that wasn't being used. We had 92% of that wasn't being used. And we can talk about, building, the end benefit of the technology versus building, the bricks and mortar. The bricks and mortar days weren't even that big, even though companies like Sun and Cisco. Right now, we've got pretty much every GPU and every XPU being used, and where AI is being implemented, real benefit that is either increasing revenue for end customers, lowering costs, or improving the stickiness with their customers. It's hard to believe that we're only 2.5 years in and seeing the benefits that we are. Because quite frankly, during the internet age, there wasn't a whole lot of meat that we were seeing 2.5 years in to the build out. We really didn't see the huge benefit until we got into the e-commerce age that was probably 5 or 6 years after the internet first hit and that gigantic build out had started.
All right, Patrick, I have to leave it there. I'm a huge history buff, so we have to get you back sometime for a longer conversation about what you've seen over the years. Patrick Moorhead, one of the smartest people in this space here, a lifetime of experience, CEO and chief analyst over at Moore Insights and Strategies, as we keep an eye on shares of HPE down about 4% right now in the after-hours trade. Meanwhile, a quick check on some of the other movers in the after-hours trade here on this Thursday afternoon. A bit of a pop here for Ulta Beauty, up about 5% here on the day. Meanwhile, DocuSign, which just reported a little while ago, missed on a couple of key metrics. You're seeing those shares move just a touch lower, down by about 4%. And keep an eye on Stitch Fix. That stock has kind of been oscillating all year long, maybe trying to get its mojo back here. Pretty decent report. Beat and raise quarter for Stitch Fix, up about 4%. This is the close on Bloomberg.
Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking this resource with continued investment.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
All right, well, from the public markets to the private and the $1.7 trillion private credit industry, which has been under threat. Lower interest rates, competition from Wall Street, biggest banks, and all adding pressure, with private loan margins falling to a median of 500 basis points in the latest quarter. That's according to Wells Fargo. Joining us right now is the head of macro credit research at BlackRock. Amanda Lynham joins us right here in Studio 2. Great to see you.
Thank you for having me.
Let's talk a little bit about what's actually going on in private credit, because I guess it depends on who you ask. I mean, some people will say that, it's basically just, some ticking time bomb. And then, you had this full-throated defense the other day on Bloomberg by Mark Rowan over at Apollo, basically saying that people aren't really valuing what private credit is, what the industry is, what the structure of it is properly. What do you see?
I think there are a couple things there. One, at the end of the day, credit is just credit. So there are a lot of consistencies actually across public and private credit in terms of focus on fundamentals, focus on structuring. I think private credit does a few things that are attractive for borrowers. One, it gives them certainty of execution in periods of episodic market volatility, which is very valuable. And I think the other kind of game-changing dynamic, even post-pandemic, so not that long ago, is that private credit can now fund larger borrowers, many of which have demonstrated access to the public markets. The reason is that private credit has grown to be scalable enough that it can write those larger checks and fund those larger transactions. Said differently, it's no longer reserved for these niche financing solutions. So for investors that can actually take some illiquid risk, they can earn an additional spread premium on that attractive asset class, in our view. But at the end of the day, a lot of the same elements of dispersion, fundamental credit quality that we watch in the public markets are also consistent in the private markets. And so So really, underwriting expertise, manager experience, having been through a cycle, that's all very important.
And I know that it doesn't matter what corner of the market you're in. There's always going to be outliers, the idea that some people aren't doing it right here. But when you see the fears publicly articulated, what do you think about that? Is it misplaced or?
Well, actually, we've done deep dives on U.S. and European private credit over the past couple of weeks. And I would say at a high level, what we see is an environment of dispersion, but not widespread market disruption. When you look at aggregate metrics like interest coverage, covenant defaults, they've actually been improving in both regions. But under the surface, there's a fair amount of dispersion. Take EBITDA growth, for example. If you isolate by dimension of company size, company sector, there are very different outcomes. I think you said it well. There are tens of thousands of issuers in these markets across liquid and private credit. As we kind of go through a choppy market environment with that episodic volatility, there's bound to be defaults. That's not a surprise. But really for private credit, what matters is how do you maximize recovery on the other side? How do you work with the borrower to actually protect your position? And that's what's really key.
And based on what we know, those potential recovery rates are relatively high.
You can see that in the realized loss rates, that actually the realized losses in private credit are actually below the historical average right now. And certainly that can vary by strategy or focus. But really, that's ultimately what we focus on, not so much the headline default level, but actually what is the realized performance. And I think what's even more attractive in our view is that the yield backdrop is still pretty compelling versus the realized losses. And that's true both on an absolute basis and relative to liquid credit.
Pushing ahead, what does that yield backdrop look like for 2026?
Our view on monetary policy for the Fed is that maybe they have one or two more rate cuts left, but we think
just one or two.
Well, yes, we think it's actually going to be more of a nuanced decision for the Fed, given that we're now approaching the high end of some estimates of neutral, given their dual mandate on how much they cut from here. So we've all along for 2025 been forecasting a normalization of monetary policy, so removing that degree of restriction as opposed to a sharp easing. What could change that view?
Does that take into account the potential change in leadership at the Fed in May?
I mean, I think in general, the Fed, the committee will still need to navigate this dual mandate. They have a tough job ahead of them for sure. But I think in general, it's difficult for us to see an easing below neutral absent a sharp downturn in growth. And that's not our base case. Actually, we see scope for a reacceleration in growth in 2026. So yes, to answer your question, in both liquid and private credit, that yield backdrop should remain robust.
Have there been any reservations amongst you and your team about the potential changing of the guard at the Fed?
I mean, I think what we're watching is that how is the committee navigating what is an increasingly complex environment with the dual mandate. So really, it's about, to, in our view, how are they maintaining an eye on the labor market deterioration versus inflation that's been above target for a couple of years. And I think that's a challenging backdrop for them.
I am curious what new issuance looks like next year, with the assumption that at least we know the Fed funds rate will likely be lower than where it is as we sit today, and presumably Treasury yields.
I think there's a case for actually new issue supply to be slightly above the kind of, call it 1.8, 1.9 trillion that we've seen in USIG this year, coupled by a few things. One, companies getting ahead of upcoming refinancing and actually pre-funding years in advance, which we've seen historically. And then two, the case for M&A. We've already seen an acceleration in strategic M&A volumes. We think actually sponsor volumes have some room to catch up. There will be financing associated with that. And then, of course, the CapEx spending across the AI universe, both in liquid and private markets. We see a lot of activity there, I think, and that's really a multi-year trend.
With regards to the AI CapEx activity and the borrowing we've seen in that space, does that almost become a little bit of a distraction for the rest of the market? Does that basically suck the air out of the room for anyone who isn't in AI?
No, I think there's a significant amount of demand for high quality spread duration product across the board. It actually reminds me of some sectors like healthcare, for example. Back in 2009, 2010, some of these companies were very highly rated. They methodically added debt to their capital structure to fund strategic initiatives. Seems very similar in our view, although what's happening in artificial intelligence is a much larger scale. But no, I don't view it as a crowding out. And I would say even some of these sectors, they're still small relative to some of the largest sectors like financials and USIG. So there's a lot more room to run there.
All right, Amanda, always great to catch up with you. Amanda Lynham, one of the best in the business, head of macro credit research over at BlackRock. Stick with us. A lot more coming up on the big program. You remember MoviePass? Well, it's back, and they're actually out with a new strategy. We're going to talk to the co-founder and now, once again, the CEO of MoviePass, Stacy Spikes. He joins us in just a second. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Hesitancy creeps back into the market, but so too does opportunity. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Boston.
And I'm David Gura. We are kicking you off to the closing bell here in the U.S. Let's start by looking at the equity market, starting with the S&P 500, which has been flirting with records as markets have been over the course of the day, but stalling out some. The words from the Anthropic CEO yesterday talking about the technical capabilities of AI, but raising some questions about the economics of it, still reverberating through the market over the course of the day, of course. Paying close attention to Bitcoin as well. It rising above that 90,000 threshold, but still something to pay attention to going forward here. Meta. Bloomberg News reporting this morning that Mark Zuckerberg and his colleagues at Meta looking closely at the future of the metaverse, thinking about making 30% cuts to that part of the business, of course, which was so integral to what Mark Zuckerberg said the future of Meta was going to be. We saw that stock shoot up on that news, coming down quite a bit from sessions highs. It was around 6% earlier today. Then paying attention here to the Russell 2000 at small caps. There, as you know, Romain, there's been this roiling debate over whether we're going to see a run in small caps. Gone back and forth over these last many weeks. We see it up for about 1% today, so something to pay attention to here going forward as well.
Yeah, in fact, that leads us backwards to a big theme of the month of November, which, of course, was the old mega cap market leaders passing the baton to the laggards, a rotation that did open up a lot of new opportunities out there that have been benefiting the Russell 2000. Those small caps as an index perch close to a fresh record high, while the S&P Infotech Index, the NASDAQ 100, the SOX, they're all drifting in the opposite direction, further away from their recent all-time highs. Now, some of this is indeed pro-cyclical, a bet on economic conditions, but also a big bet on the Fed, rate cuts. That's priced in firm for next week, but beyond that, it gets a lot more complicated. Since it was reported back on November 25th, Trump acolyte Kevin Hassett has been the front runner for the Fed chair. Benchmark Treasury yields, they've actually gone up, not down, up 10 basis points, in fact, over that stretch. That jump, along with that long stifled rise in the term premium, a reflection, if you will, of investor anxiety that a reshaped Fed may be just a bit too dovish and maybe a bit too beholden to the White House for comfort.
The markets are focused on what happens next. And what happens next is the new Fed chair, the new composition, and quite candidly, the meddling of the administration in Fed affairs.
And if investors thought that the data for a data-dependent Fed could act as a shield, I kind of hate to break it to you. That data is about as wishy-washy as Aladdin's brother. A week ago, we were pointing at data showing a weakening job market. This week, today, in fact, we're getting data that suggests, David, a labor landscape that's still a bit fluid.
Well, let's take a look here at a chart showing that we had initial jobless claims today, and we saw them falling to the lowest level that we've seen in more than 3 years' time. And one has to have a lot of sympathy for Federal Reserve policymakers as they gather around that table in the Eccles building next week to make this decision. There is a dearth of data. There is data that's outdated. Here, just one example of a labor market that seems to remain more resilient than I think a lot of folks expected here. But as we heard from Jay Powell at the last meeting and the one before that, there is a concern now among policymakers about cracks in the labor market. We'll see what they make of this when they look at that panoply of data again when they sit around the table next week in Washington.
Kicking us off to the close here in Studio 2 is Roger Hallam, Global Head of Rates over at Vanguard. And Roger, when you take a look at the data, what does that tell you about the potential direction of rates?
Yeah, when we look at the data and we think about our forecast for next year, we think the economy is going to expand about 2.25% next year. Inflation will subside from the high levels, 3.1, where we're in this year, to sort of 2.6, but at the core PCE level by the end of next year. That, to us, suggests an economic outlook that's okay, and one where the Fed is likely still to ease policy, obviously, next week and perhaps incrementally again next year, but it's not one that requires substantial monetary policy easing. Our core view would be that we don't realize those full 4 Fed rate cuts that are in the price over the next year. That could put a little bit of upward pressure on bond yields.
Well, then I am curious, as just from an allocation and from even a strategic allocation perspective here. Is there a tradable opportunity in this, or is that kind of past?
I mean, our broad view on, at the 10-year yield point is we're in a range. We're 375, 425. So, I mean, you can see movements within that, but from a big picture perspective, that's one where investors can be confident investing in bonds, and bonds have an important role to play in clients' portfolios as a ballast, as a diversifier. It provides some offset if we did see any volatility in equity markets.
You're paying attention to policy. You're also paying attention to personnel. It's a funny moment in that way. And I'm curious sort of how you're thinking about the way that the composition of this Fed will change here in the months to come. Heard from Greg Peters just a moment ago talking about how this is a body of experts, of Fed presidents and governors, all of whom have a say, and it's the duty of the chairman to kind of make them coalesce as much as they can. Your thoughts on that, the degree to which a new chairman is going to really fundamentally change or could fundamentally change the direction of this Fed?
The Fed has a long history of a strong and independent institution, and that's served the U.S. economy really well. It's also, as you say, the chair is an important voice on the committee, but it's just one vote. So I think by the time the new Fed chair is in the seat, we'll have policy that's closer to our estimate of neutral. And I think the broad committee will be guided by the data with the objective of achieving their mandate of price stability and maximum employment over the medium term. It's possible you do see more dissents next year. That should become a feature we get more accustomed to. You look at the Bank of England, 5-4 votes are a common feature of the Bank of England. I think it's possible you do see a greater frequency of dissents. I think the market can get comfortable with that, as long as it's because there's a debate in the FOMC around should they be prioritizing the labor market, where, as you said, the data's still a little wishy-washy in terms of which direction we'll go. Inflation is coming down towards target. It's not yet at target. And if we're right, the growth outlook is still firm. Different members are going to weigh those different factors differently, and that can generate different policy views.
Let me ask you about growth, because we've been stuck in this kind of crucible of uncertainty dealing with what's going to happen with trade policy, the effect that that's going to happen. We've seen a lot of multinational institutions revising their growth forecasts up. Mm-hmm. I wonder if you're doing that in kind, and how you're thinking about your ability to see through the uncertainty surrounding trade policy and how that means for the prospects for growth in the U.S.
We very recently just upgraded our growth outlook for next year to 2.25% from 1.5%. The principal driver of that upgrade is actually a more optimistic view on CapEx for next year, which we think contributes about 1% to growth next year. We think we're past peak trade uncertainty, and the focus shifts more towards how does CapEx lift the growth outlook for next year. We're pretty comfortable that recession risks are low, and if anything, around our forecast, we think the risks are skewed to the upside.
Are there any risks, though, to that upward trajectory in CapEx spending?
We think it's pretty certain. You listen to the multinational companies, the hyperscalers, their investment plans feel pretty certain. You say if there was a disruptive technology that came to pass in the next months that could disrupt plans, but we think those plans are pretty set in the absence of that surprise, certainly through the first half of next year.
With regards to the interplay between what we've been seeing in the corporate debt market, particularly with the borrowing around AI and the potential that crowds out some of the potential opportunities in the Treasury space, is that something meaningful, at least from a long-term perspective, that you would worry about?
You've seen a little bit of upward pressure on bond yields around some of that long-dated debt issuance over recent weeks. We do think as we go into next year, that start-of-year issuance surge, along with potentially some global term premium pressures, that could put a little bit of upwards pressure on bond yields to start the year. But no, we don't think it drives yields substantially higher from current levels.
All right, Roger, always great insights. Roger Hallam there is the global head of rates over at Vanguard. A closer look at what's been going on in the rate space. And if you're a fixed income manager, you've actually had a pretty good year. In fact, one big bet that has paid off this year is U.S. bonds, especially for PIMCO. And, well, it's kind of an unlikely winner. PIMCO actually resisted that big sell America trade, in quotation marks, earlier this year in favor of sticking to 5- and 10-year U.S. Treasuries. Joining us right now is Mohit Mittal. He's managing director and CIO over at Core Strategies over at PIMCO. And a great story on the Bloomberg terminal, Mohit, about you and your team and really just the decision-making you guys had to make back in April, back in March. And, well, a lot of people were bailing, or at least thinking about bailing on U.S. assets. You stood firm and you've reaped the benefits. Explain why.
Yeah, thank you, Romain. Thank you, David, for having me. Yeah, I think the context is at that time there was plenty of uncertainty, and the view was that this tariff-related uncertainty will further add to the challenges that consumers as well as businesses are already experiencing. On the consumer side, higher costs will lead to lower spending. On the businesses side, the uncertainty around tariffs would likely lead to a slowdown in hiring plans as we go further out in the summer months, because if they are paying for the tariffs, they'll have to figure out a way to cut costs and reduce costs elsewhere. And one of the ways they could do that is adjust their hiring plans. So our view was that as we go into later portions of summer, and you should start to see a growth slowdown, which would be beneficial to the treasuries and hence the preference for that 5- to 10-year treasuries.
I am curious about what you were talking about with your colleagues there and what you were seeing amongst client behavior and whether those two things were in conflict with each other.
Yeah, I think our discussions with colleagues centered around what are the different scenarios that are possible. With respect to tariffs, the scenario was around inflation impact. And then the other aspect of the scenario was the growth impact. So the internal discussions with colleagues centered a lot around this trade-off between inflation impact and the growth slowdown impact. And then what we were hearing from our clients were certainly concerns around U.S. policy, certainly kind of discussions around how they would think about U.S. assets. But what we were not getting in the data was any meaningful shifts in the near term. Certainly over the long term, our view was that at the margin, foreign investors would likely start to think about shifting towards home, or whatever that home bias would be. But that does not necessarily mean that would be negative for foreign holdings of U.S. Treasuries. And then when we looked at the data in April and in May from the Treasury auction data, what we were observing was that the auction participation by foreigners was nearly unchanged and at the level that was pre-April. So that gave us some confidence on continuing to hold onto the trade and add onto that trade upon weakness.
Our colleague Michael McKenzie doing a great job kind of capturing the drama of the moment as you and your colleagues in London and Newport Beach are going through all of this, meeting more regularly than usual, trying to hammer all of this out. And I'm curious about how you thought about the uniqueness of the moment and the circumstances that we were in and you were in as investors. Was there an historical analog that you were thinking about or thinking through, or was it really new ground that you were trying to trod?
I think there's always something new in that moment. I think we were penciling in an increase in tariffs. I think if you recall, pre-April 2nd, the tariff rate on the U.S. was closer to 2%, and our view was that we will probably get towards 10% in the U.S. But what was announced on the Liberation Day was closer to give or take 20% if you did the weighted average sum of the tariffs that were announced. And our view was that we will settle somewhere in that 15 to 18% range. So we were trying to kind of understand a lot of that, and with the help of our policy experts. And then we were trying to figure out, I think what was really different was the potential change in the foreign investor participation or view. And at the same time, what it also meant to us was that we don't have to constrain ourselves to the opportunity set that is in the U.S. Certainly, U.S. markets were weakening, but so were other markets. So what we did was certainly, I think, as you mentioned, Michael McKenzie covered it very well on the U.S. side, but we were able to kind of also look at opportunities that were outside of the U.S., and those have worked out quite nicely as well this year, and they continue to look attractive in certain pockets.
You've taken me right where I want to go. So the income fund returning 10.4%. I wonder how much you're pairing your bets on U.S. debt and what those other countries are where you see opportunity in this moment and going forward.
Yeah, so I think the other countries at the moment, so what we have done is we have certainly reduced some of our duration exposures in the U.S. And the reason for that is that when you look at the U.S. market, the U.S. has been the biggest outperformer, or U.S. Treasury market has been the biggest outperformer relative to other developed market rates, relative to, say, for example, Australia, UK, and then Japan rates have gone the other way. So certainly it has created an opportunity for us to be a little bit more opportunistic elsewhere. So those opportunities are in Japan, Australia, and in UK. We can be patient in the sense that we are not saying that the rates necessarily have to go lower from here. They're starting to look very attractive on those regions, and then if they continue to weaken further, similar to what the U.S. rates were doing in April and May, we will continue to scale up, and I think that could be a good trade for 2026.
What's your general outlook right now, Mohit, as we move into 2026 for volatility, taking as the current levels of volatility as the baseline?
I think the volatility is here to stay. I think, basically what you have is a lot of kind of competing forces at play. On the one side, you have the positive effect on growth from the upcoming One Big Beautiful Bill that will go into effect in Q1 through consumer tax refunds as well as the capex aspect or the corporate capex aspect. On the other side, you have the tariff-related uncertainty, and then you add to it the AI capex that is in the works. Now, again, it can certainly materialize to the degree that is expected, but there are scenarios where it may not materialize. So all of these create plenty of volatility just if we focus on in the US. And then you add to it all the other countries which are also going through their own inflation and growth uncertainties. So this volatility is here to stay, but it also creates very, very exciting opportunities for us in fixed income. I think our take is that we can construct a very well-diversified globally diversified portfolios with a yield of 6 to 7%, which looks very, very attractive for most investors relative to cash, relative to equities, and relative to other opportunities.
Mohit, really appreciate you taking time, and real fascinating read today about just how you guys operate and, of course, the returns that you reaped as a result. Mohit Mittal, Managing Director, CIO of Core Strategies over at PIMCO, as we continue to march to those closing bells. When we come back, a conversation with the CEO of Zoetis, Kristen Peck, going to stop by to talk about how the animal health company is planning to try to turn things around just fresh off the heels of their Innovation Day. Speaking of turnarounds, we're also going to catch up with the CEO of MoviePass. Remember that? Well, he's back, and he's actually got a different business model. You don't want to miss that. That's coming up next. This is The Close on Bloomberg.
CPA. 3 letters that stand for limitless possibilities. Because a CPA Australia designation makes you a trusted advisor in tomorrow's economy. Gives you leadership qualities for a seat at any table. And expertise to create a sustainable future. With the letters CPA after your name, you will always be limitless.
At Virginia Housing, our mission is to help Virginians attain quality, affordable housing. We're one of the top housing finance agencies across the United States. Having a partner like Wells Fargo that is consistent, that we can rely upon, is so important, and it enables us to try and test things that some organizations frankly can't do. Together, we're serving the community. We're serving businesses when they want to come to the Commonwealth. We're serving the future of Virginia.
All right, let's get you to some of the most talked about stories in the world of business, including Paramount Skydance, the media company actually accusing Warner Brothers Discovery of failing to conduct a fair auction in that sales process, saying that it's become a bit too tainted. A letter to CEO David Zaslav, attorneys for Paramount said WBD favoring a rival bid from Netflix. Warner Brothers responding by saying their board is, quote, fully and robustly complied with their fiduciary obligations. Next, let's take a look at Kroger. Those shares were actually down a little bit earlier in the day. This after the grocery store chain lowered the top end of its full-year sales forecast in the latest earnings report. The move offering a note of caution that shoppers are actually being choosy due to uncertain economic conditions, even for essentials like food. And finally, remember that big outage that we had at the CME last week? We're keeping an eye on that because Goldman Sachs is pressing pause on a planned $1.3 billion mortgage bond sale from the operator of that data center, CyrusOne. CME and CyrusOne, one of the world's largest derivatives exchanges, experienced that major outage hit over the Thanksgiving holiday. It became a wake-up call for investors taking part in the AI data center boom, showing that lease agreements can be breakable in the event of multiple recurring outages. David?
Well, coming up, Ulta Beauty is set to report earnings after the bell today. D.A. Davidson's Michael Baker joins us next with his short list of what to watch. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We have in Singapore the state-of-the-art technology, and then we export that technology into our Meta plant in Georgia.
The Smart Factory brings software-defined manufacturing to life using digital twins, AI, and automation.
Our Meta plant was the largest investment of the company outside of Korea, at 3,000 acres, with an investment of $12.6 billion for a capacity of 300,000 cars a year.
Time now for our top calls. Some of the big movers on the back of analyst recommendations. And we're going to start off with the airlines today. A new analyst over at Citi initiating coverage of the group with a new buys on United, Delta, and American Airlines, and a sell on JetBlue. Some neutrals on some of the other smaller carriers, with the main theme in that report talking about the super major airlines primarily being the beneficiaries from an elongated mid-cycle starting in 2026. Most of the airline stocks nevertheless down here on the day. Next, Lumentum Momentum Holdings, Rosenblatt upping its price target to a street high $380 on the optical and photonic product makers, up from $280. The analyst calling Momentum the single best position name in its coverage of the AI scale. Those shares up for a second day to a record high. And finally, another street high price target, this time for Macy's. Jeffrey's going to 26 from 1850, maintaining a buy. The analyst saying Macy's more conservative fourth quarter forecast makes for an achievable near-term setup. Nevertheless, those shares down for a third straight day. And those are some of our top calls. We want to stay in the consumer space right now and turn to Ulta Beauty. The makeup retailer expected to report earnings after the bell tonight. Another data point investors are watching to gauge the health of the consumer as well as their willingness to spend. Michael Baker joins us right now, senior research analyst over at D.A. Davidson. Michael, I always thought that beauty was supposed to be recession-proof, economic-proof. Is it?
More resilient than a lot of spaces, I think. I think we'll see a positive comp when they report. Consensus is about 3. That's probably about right. Maybe a little bit of upside. I don't think it'll be as strong as the 7% comp last quarter, but it should be a fairly strong quarter. One of the issues with Ulta, and we do like it here, but the consensus estimates for the full year are already above the high end of their guidance. So we think they'll raise their guidance. They have to raise their guidance because that's already in the consensus estimates. But we think that there's enough there that they will be able to increase their guidance this year.
Michael, talk a bit about how this company has navigated some pretty difficult headwinds here. And the CEO was profiled in Bloomberg Business Week a short time ago. She talked about how she wants to expand the geography, the footprint of this company at a time when we know because of tariffs and trade policy, getting materials and doing that kind of building is difficult. How do you square her ambitions for the company, that level of growth, with the amount of caution that we're seeing so many other companies evince?
Yeah, I just think there's a lot of white space there for them. They did have some increased competitive pressures over the last couple of years when Sephora was rolling out their store within a store concept in Kohl's stores. There was about 2,000 of those locations. But that is now behind them. They fully absorbed that. In fact, that's not really growing anymore. So Ulta sees some white space now that Sephora is not growing as much. So they're growing domestically, about 60 stores a year. By the way, they're also growing internationally. They made an acquisition in the UK. They opened in Mexico, and they just opened in Kuwait, believe it or not, using joint ventures or other local partners. So they're growing both domestically and internationally.
Hey, Michael, when you think about kind of like how Ulta came to be, and obviously, it was more than just about going in there and, buying a lipstick or a facial serum. It was about kind of the experience inside the store. I am curious as to how you think they can replicate that going forward as they expand, and more importantly, as they have a much larger presence online rather than in physical stores itself.
Well, it is omni-channel, and we've seen that from a lot of retailers. Customers will start the journey online and then go into the store to be able to test and try on different things. The way Ulta started and their point of differentiation, and I think it still exists, is they're really the only place that has both prestige and mass, at least in a physical location. Certainly they compete with Sephora, but Sephora is primarily prestige product. They compete with drugstores and other mass retailers, but again, they don't have the prestige. Ulta is really the only physical retailer that has both mass and prestige under the same roof. And we think that's still a compelling differentiation for the consumer because she likes prestige for some of her products and mass for other products.
Michael, really quickly here, what can this company do more to get its name out there? You talk about that prestige, but it does seem like in terms of name recognition, Sephora does have something of an edge, at least anecdotally.